Thank you so much.
Thank you.
Yeah, we'll take Miss Archishma. Yeah, Miss Archishma from Money Control.
Sir, congrats on a good set of numbers. I just had one question. I just wanted to understand the traction that the bank would have gained from the ECLGS 5.2 scheme. How much has been dispersed, and how many people have sort of approached the bank for these applications, and what is the pipeline for the future?
See, we have eligible base is around 40,000 crore, which the people are eligible. And total application which we have received up to 20,300 crore now, up till now.
Right.
In that, we have given the sanction up to 15,856 crore.
Alright, then there you go. So that's the update coming in terms of PNB numbers, and that's the management talking about that as well. Some places where they don't see some concerns about line items, but let's also talk about HDFC Bank that's reported its numbers. Now, when you talk about the net profit figure, there's an uptick of about 5% coming in on a year-on-year basis that you're looking at. When you talk about NII, that's risen 6.7%. So healthy growth coming in terms of the NII as well. And that's when you talk about the gross NPA figure as well, 1.17% versus 1.15%. Net NPAs at 0.41% versus 0.38% as well on a quarter-on-quarter basis. And when you talk about just the provisions as well, you're looking at somewhere close to 3,000 crore rupees versus 2,600 crore on a quarter-on-quarter basis. And when you talk about on a year-on-year basis, that compares with that 14,400 crore odd figure on a year-on-year basis for provisions as well. So that's the number that you're looking at. When you talk about HDFC Bank as well, and there's ICICI Bank that's also reported its numbers. But, first, when you talk about HDFC Bank, it's quite in focus on the back of that profit figure as well, with that 5% uptick really coming in. And when you talk about some of the expectations as well in terms of the numbers, now what we were expecting in terms of the credit deposit growth was to be in double digits and the NIMs to broadly remain stable around 3.5%. Some of the key monitorables, of course, are the NIM guidance. That's something we're going to be watching out for, and the CEO reappointment as well. But before we do that, we'll also get in Piyush with some of those details as well in terms of how the numbers are looking broadly, Piyush. And it's looking like a very interesting set right now. When you talk about that profit figure as well, that really stands out in terms of that 5% uptick there.
Absolutely. HDFC Bank, a strong set of performance. In fact, NIM has risen as against the expectation that it could contract by a few basis points. So the bank has been able to grow its net interest margin quite good in this quarter. The estimate was 4.18. It has come at around 4.36%. Now, the bank has also beat the estimates when it comes to the net interest income, which is the difference between interest earned and expended. The estimate was that the NII could come in around 23,813 crore, and the actual NII growth was NII stood at around 24,385 crore. HDFC Bank's this was for ICICI, my bad. HDFC Bank's NII grew 6.7% to 33,534 crore in Q1. The provisions also have risen. It is at around 3,060 crore versus 2,610 crore. Gross NPA, a slight uptick, like we have seen in the case of Axis as well. Even in Kotak, gross NPA ratio has risen slightly, but this is also, we have to understand that, over time, the private banks' GNPA, the headline numbers have gone to such low level that, a few basis point uptick, we can't really, and HDFC Bank has a lot of loans, on its book. 20-30 odd lakh crore. So relatively a strong performance. NII growth is strong, NIM has improved, and asset quality largely stable.
No, absolutely, and that's what you're looking at in terms of some of the numbers as well. Now, Piyush, like you mentioned, it's actually quite important to watch out for that NII growth number as well. That's remained quite resilient at nearly that 7% despite the rate cut environment. So that's something that you're looking at. And we'll get you some more insights in terms of the NIM trajectory and what's the kind of expectation that's really building up when it comes to that as well. When you talk about asset quality as well, you do have the gross and net NPAs, like Piyush mentioned, that inched up, sequentially. But the emerging stress in specific portfolios is something that really needs to be looked at closely as well. That said and done, let's also talk about ICICI Bank, because this is the day when you do have some of those banking behemoths reporting their numbers. And when you talk about the numbers, in terms of the comparison versus estimates, it's shaping up to be quite an interesting set for ICICI Bank as well. When you talk about the net profit, that's risen about 16% and that compares with somewhere close to 12,700 odd crores in terms of the year-on-year figure. When you talk about NII, you're looking at 13% uptick coming in, so quite the double-digit uptick coming through. When it comes to this one, gross NPA, it's about 1.38% versus 1.40% as well, and compares with an estimate of 1.45%. When you talk about net NPA as well, you're looking at about 0.35% versus an estimate of 0.37% as well. Quite the interesting set of numbers here when you talk about this one as well, Piyush. Let's talk about the fine print and how it really compares, measures up against some of these expectations.
So above estimate results again for ICICI Bank, the gross NPA, this has come down below the expectation. It's good. It's at 1.38 against the estimate of 1.45%. The net NPA also has come down below expectation. It is at 0.35%. The operating profit has risen handsomely, which is before the provision, pre-provision operating profit has improved to 20,386 crore versus the Bloomberg estimate of around 19,278 crore. NIM again has improved for ICICI Bank, one of the few lenders which has been able to keep up its NIM and post above estimate NIM at 4.36%. Asset quality wise, the bank has done well. The growth in both loans and deposits have been in double digit and margin has improved. So overall a good set of numbers for ICICI.
No, absolutely, and that's what it's looking like at the first cut as well, Piyush. When you look at ICICI Bank in terms of some of the numbers as well, it's actually quite interesting to watch out for some of the commentary coming in when it comes to the NIMs as well. That's something that we've been hearing, that it's going to be quite important as well. When you talk about some of the key parameters to watch out for, there's actually a bunch of things that you've seen as a theme also emerging across banks as well. And the deposit growth seems to be improving. The NII seem to be largely resilient, and that's been the case. When you talk about HDFC Bank, when you talk about ICICI banks as well, some of the biggest banking names also reporting that strong resilience coming in despite the rate cut environment, despite all of the complexities that you had coming in this particular quarter as well, and the asset quality also definitely in focus. So really a lot to watch out for, Piyush, when you talk about some of the commentary as well coming in. Of course, the NIMs, something to watch out for. The business growth for sure is going to be something to watch out for. And when you talk about HDFC Bank, apart from the GNPA and NNPA figure, you do have some of those line items that would remain in focus as well.
In fact, Shreyansi, absolutely. HDFC also has this big overhang on its head that who will be the CEO, because Mr. Shashidhar Jagdish, the current CEO's term ends in October, and it was expected that the bank could, recommend his name to the RBI. We are not aware if it has done so. At least it has not reported that on exchanges. But HDFC Bank, sure, the CEO, this clarity is needed. The bank management guidance on NIM, like you rightly mentioned, will be keenly eyed. HDFC Bank has seen a phase of slower growth, after the CD ratio inched up after, absorbing erstwhile HDFC with itself. High cost borrowing had gone up. The bank had seen, the NIM come down. Historically, HDFC's NIM has been above 4%. The bank has been struggling to go to that level. But so the NIM guidance by management, the deposit accretion, whether the bank will open more branches to, mobilize more deposit, and how much it has gained from the FCNRB scheme. These are some of the important monitorables for HDFC.
No, absolutely, and lots of pointers to really watch out for when it comes to this one as well. Piyush, when you talk about the profit growth, that's remained largely robust, and that's across businesses that you're looking at. When you talk about ICICI, the NII has outpaced some of those expectations despite the rate cycle. Like I mentioned, the margins are expanding despite some of those easing interest rates as well, and that's why the margin figure is also in focus, in addition to the asset quality remaining broadly stable as well. In fact, we have Mayuresh Joshi joining us yet again. Mayuresh, thank you so much for taking time out. It's a very, very interesting set that you're looking at when you talk about HDFC as well as ICICI. First, let's talk about the expectations that we had for HDFC Bank as well, and how you're looking at the first flush of numbers.
No, pretty much in line with estimates. So I think if you probably look at both the banks, they've delivered in-line set of numbers, and that is what the street will probably take relief from. That there is no significant deterioration as far as asset quality is concerned. NIMs broadly remain in line with expectations, and generally, I think the trend probably seems to be on track as far as the street expectations largely as a consensus, if to be believed.
Mayuresh, when we talk about HDFC Bank, sure, the numbers are in line as per estimates. Do you feel this CEO, uncertainty about this current CEO continuation, will this have an overhang on the bank's shares when trade starts Monday?
No, so I think it will have. I mean, that is probably an overhang, and that will persist till you hear some announcement. And there is a game of roulette going on as we speak among banks, as there are a lot of there's a lot of shuffling happening as far as the top management is concerned. It remains an overhang, but I don't see that to be a concern on a structural front. So I think as and when this probably gets resolved, I think it should probably revert back to how core earnings will probably move.
On the asset quality front, we were just discussing, the numbers, GNPA, NNPA ratios are so low, even 2 bips uptake, how should we look into it? Because Q on Q, the HDFC's GNPA has risen by around 2 basis points to 1.17. Is there any material, concern over here, or this is business as usual and numbers are still good?
No, I think that it should not be a concern at all. I think it's just a very, very marginal take. Looking at the base and the size of the bank it operates out of, I think that absolutely will be taken into stride. So I think this number is absolutely of no concern in my opinion.
Right. What would you watch out for from the management commentary, whether it would be on deposit growth or on succession? What would be your focus?
No, so 2-3 things, right? One, the succession plan thereof, I think, and the timeline that they're probably expected to do the same. The second, obviously, I think as a common thread that I discussed earlier as well, I think is also going to be deposit growth, because that is going to be extremely critical at the juncture at which all these banks probably are. The slippages, I think, how are the slippages placed as we speak? The sectoral exposure in terms of risk-weighted assets. And therefore, I think the kind of provisioning and a marginal hit in terms of NIMs that can probably happen in a phase if aggressive riskier lending probably takes place over the next 2 quarters to probably balance growth in a more sustainable manner. And therefore, I think these 2-3 factors is something that will be a common underlying thread for most of these large private banks.
Absolutely. And speaking of common threads, let's also put all of this into perspective as well, Mayuresh. When you talk about ICICI, it seems to be leading on profitability, HDFC on scale. Let's also get in that sense going in terms of ICICI Bank margins as well expanding, while HDFC margins largely remain stable. Let's talk about ICICI Bank in terms of those numbers as well. How are you looking at all of this? How do you think they measure up against the estimates as well?
I think very decent set of numbers, and they're having a very calibrated approach in terms of growth versus risks, and that is obviously starting to play out very decently over the last few quarters as well. So I think a very, very decent set that has probably come through. Sort of the large banks, I think, if I could stack it up, I think ICICI Bank probably seems at this juncture prima facie to be one of the better numbers at play.
Absolutely. And, when you talk about the entire gross NPA improvement as well on a sequential basis, you do have the net NPA that is also edged up. Provisions increased sharply on a quarter-on-quarter basis. Are you looking at this as a prudent normalization then of provisioning, or do you think it reflects a little bit of emerging stress in any specific loan segments, any line items that you're watching out for in the commentary as well there?
So honestly, I think I haven't looked at the broader presentation that the bank has probably given. So I might need to look at that before I probably comment on this. So not really sure in terms of how the sectoral trends are probably played out.
Absolutely. But then in terms of just the commentary as well, and we've been talking about this for a bit right now, Mayuresh, in terms of some of the other banks, and you've highlighted some of the things that you're really watching out for in terms of their commentary as well in the con calls that are lined up later in the day, and there's quite a few of them. But, when you just talk about ICICI Bank as well as HDFC Bank respectively, what are the kind of, monitorables that you have in terms of the management commentary there?
No, so 2 things. One, I think the banks have got an extremely heavy base now. So I think how and in what aspect is the growth going to come from? Sustainable growth, calibrated growth, so without creating stress and pressure on the balance sheet is obviously something to be watched out for. Second, I think in terms of maintaining their NIMs to a large extent, I think that prudent treasury management is going to be extremely critical in periodicities where volatility will probably be key, at least over the next few months. And the third aspect, obviously, I think we're talking a lot about the management changes, etc. I think you need to have those aspects clear off over the next few months so that you have a very clear vision on the management strategy coming forward. And last but not the least, I think in terms of expectations of growth, are the banks probably looking at calibrated growth and not taking a riskier approach to expand their balance sheet in a very aggressive fashion compared to the competitors and peers who might be doing that? So I think the bank which probably sustains all these factors put together, in my opinion, might actually emerge as a winner in this sector over the next few quarters.
Absolutely. And Mayuresh, right before we let you go, there's been a lot of numbers that you've been passing through as well when you talk about across some of the segments as well of banking as well. And when you talk about your closing comments, just quickly wanted to get a sense of what you're thinking about the key monitorables that we've talked about earlier on the show as well, that being NIIs, NIMs, and some of the trends and what they're reflecting for the entire banking space as a whole, and anything that you're specifically watching out for come Monday.
I think the common thread is pretty clear. It has remained strong. It is expected to remain strong. But at what expense does this credit growth come, right? I think that is one key monitorable to be watched out for. Asset quality largely seems to be stable for most large private sector banks. So I think the risk management probably seems to be on track. Obviously, in terms of implications of how the NIMs will probably play out, in an environment like this and with global volatility around, I think the NIMs are expected to be reasonably stable as we speak, with prudent treasury operations also. I think the expectations in terms of reasonable balance sheet growth for most private banks, or the banks which have probably reported today, seems to be a base case scenario. And therefore, I think the markets will take these results, in my opinion, quite positively as we open up on Monday.
Absolutely, and especially the two biggest names as well, some bit of resilience that we're seeing against otherwise very difficult odds stacked against them. Thank you so much, Mayuresh, for taking time out and joining us this afternoon. So there you go. That's HDFC Bank as well as ICICI. You do have ICICI leading on profitability, HDFC on scale as well, and margins expanding when it comes to ICICI. It remains stable against an otherwise difficult environment when it comes to HDFC. Time for a very quick break. More news and updates on the other side.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
India Inc.'s most respected names chose India Inc.'s best and brightest.
I'm delighted to be chairman of such distinguished fellow businessmen, bankers. It's lovely to be back on this NDTV jury. I have been a fan of NDTV for a long time.
Many of the nominees are extremely close together in terms of what they've done.
I think it's also important that how they are reshaping the industries, commercial activities which they are into. And it's a very judicious mix of people to choose from. My compliments to the team.
Who will earn India's top business honors? Find out at the NDTV Profit Business Leadership Awards. India's unshakable news habit. NDTV.com is India's #1 English news website.
I got to learn a lot because, to just get a point of view as to how different jury members were looking at various participants, and, the rigor that they brought in to the whole process, I thought was astonishing. Not only was there a lot of trust elements in on who they chose, but also that they had consistently delivered on it. They had thought about change. They had thought about resilience in their own businesses. So the soft factors that they eventually chose the winners with is something that stood out for me. In fact, when we were actually doing the work, if there was a governance concern or any of the nominees, they were struck down.
Forward.
First, I will give you the number, which is sanction, which we did last year and before the previous year. And in that, how much disbursements are pending. If you recall, we had mentioned that last year, total corporate loan book sanction was 4 lakh crore. And 24-25, the sanction was 2 lakh crore. Out of that 2 lakh crore and 4 lakh crore, the disbursement which is pending is 78,700 crore. And this year also in the first quarter, we have given a sanction of 95,500 crore in the first quarter itself. And there also 58,000 plus, I think 58,800 crore disbursement is pending. So if I see the number which is pending for the disbursement, as on today, it is 1,37,500 crore. That is the disbursement is pending for which the sanctions are already there now. So bank has got a good pipeline, and still we are having around 25,000 to 30,000 crore in the kitty, which we are going to give the sanction in the next week. So weekly our committee sits and give the sanction. This year also we will be crossing more than 4 lakh crore of corporate loan book. And we have shown a growth also. You see the growth is around 10% in the corporate loan book.
Okay. And my second question is regarding the ECLGS scheme. So how much has been lended under that scheme, and any targets for this portfolio going forward?
We have eligible cases under that scheme is 40,000 crore. That is the customers, they are eligible up to this amount. And we have already given the sanction of 15,800 crore. In that, disbursement is already happened to the tune of 12,335 crore. But still, I think another around 20,000 crore is yet to come.
Okay. Okay. Thank you.
Okay. Thank you.
Thank you.
Yeah, Mr.
There you go. So that's the commentary also coming in terms of PNB management as well, talking about the growth outlook going forward. But let's also shift away from the entire gamut of earnings that we've reported when it comes to the banking space. Talk about the IPO market now that is showing signs of life again after months of being selective. That is, investors seem willing to write checks once more, strong listings, healthy subscription numbers, and a steady pipeline of new issues that have lifted sentiment across the primary market. And it's not just the main board space. You're talking about SME IPOs that are seeing renewed interest as investors are chasing growth stories and listing gains. In fact, Sharad Dubey gets us all of the buzz in the primary markets as well.
So welcome to the IPO jungle, and why I'm saying this is because IPO market is roaring back, right from what it was like a meow 2 years ago. Now it's roaring back. Why is it doing that? That's important. Let's have a look at it. SBI funds, recently we're talking about the IPO. The bid which has come in, that's 3 lakh crore rupees. Again, there is fire in the IPO markets. Of course, Reliance Power was the highest, 7.5 lakh crore, followed by LG Electronics and Bajaj Housing. Another important data I would like to talk about is the SME market. The IPO sentiment is back in the SME space as well. Recently, Millworks Tech came out with its IPO, and second highest ever bids have come in, and the amount is 22,000 crore rupees. Can you imagine that for an SME IPO? And the BSE SME IPO index, interestingly, that has also gone up almost 35% from March lows. That means the sentiment is roaring. Also, what are the factors, helping this primary markets roar back? Strong DIFI support. Companies are focusing more on path to profitability. Even valuation cuts are happening. Astute investors, mutual funds, family offices, they are taking positions in SME IPO. Also, the appetite for larger IPO issues is increasing. That means not so much of a liquidity concern and fairly priced IPOs and the grey market premium, which is what we are seeing in the markets. Also, the merchant bankers, that's where we see that number has also gone up. Just compare that for the last 26 years, the merchant banking registrations is 244, and look at the issues, it has doubled up in the last 26 years. We have been comparing these numbers. but what lies ahead, that's also important. What are the key IPOs to look forward to? And this year is going to be very busy for us as well as the entire ecosystem in the primary markets. And look at the larger names: Reliance, Jio Platforms, NSE, Zepto, Parle Products, Manipal Health. All of them we'll be tracking and showing you that primary market is back and the jungle is roaring.
Absolutely, and the good news is that the jungle is roaring. Lots of work for you there, Sharad, and thank you so much for getting us that update as well. It's time to wrap up the show right now. Quite a power-packed show. Thank you so much for tuning in.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
From a PwC standpoint, we actually set up criterion for each of the categories that we discussed with NDTV. A criterion was set up. Different KPIs were adopted for different categories. These are of course discussed, internally. We challenged ourselves, etc., and we made sure that the data sources are all very robust, so that the trust could be built in. So I think that's what defined, and of course, we eventually went through the jury process, and I'm glad the KPIs, if I may call it so, for the winners were ratified by the jury. In some ways, that's a ratification of the choice that we made.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
The news, Ayush. Since when do we do scripts? Fair point. Picture this. The biggest stage. Floodlights. Wow. 4K. The works. Where's the hook? There's going to be celebrities and guaranteed eyeballs. Where's the hook? Think about this. Front page advertisements and hoardings. Bro, where's the hook? Cross-platform, digital first, virality. Without a hook, no way. The message is clear. It's 2026. You gotta be real in a world of reels. You gotta be original in a world where everything seems generated. That's it. That's what we're looking for. The best campaigns, the hottest trends, the smartest brand moves on our new show. But wait, what do we call it? The Hook.
He has been tracking markets for over a decade. Spots.
Vikash Kumar Jain, Managing Director, Head of Research and Strategist at CLSA India, joins in right now on the show. Vikash, thank you so much for waiting by. We wanted to start this conversation maybe a few minutes earlier, but I think there was an interview going on which had some technical glitches and therefore we had to finish it. But good talking to you today, Vikash. And I wonder, if 3 months is a lifetime in the current scenario, and is your belief around what equity markets the world over and equity markets in India might do as a result of this being out? Because I remember, Vikash, the last time you made this comment that some of the global guys are telling you that, hey Vikash, even if you don't attend the office, we will not notice you that you've missed the office. So has that changed now?
Yeah, thanks for having me, Neeraj. Yes, it has changed, and the easy part about that answer is you don't have to talk to me to get that answer. You can see that on the screen. And the way you see it is actually not that obvious, because if you look at the last quarter, India is still a rank, April to June, a rank underperformer when it comes to EM and Asia ex-Japan. But that headline hides much more than what it reveals, because if you go a little deeper, then and look at all large markets in the world, and there are of course these two markets which are on their own, in a different orbit altogether, which is Korea and Taiwan. If you strip that off, India has done better than all other EMs, other than Thailand, which is slightly better than India. So every other EM, which is China, Brazil, all the others are right on the other end of the spectrum, did not do very well in the last quarter. India did much better than all of them. So I think from the point of time where if we looked at this same number in the Jan to March quarter, India was the rank underperformer. Only Indonesia did worse than India. So that's a huge improvement. Yes, around the time of early April, when after about 18 months or so we turned bullish, at least when we were talking to our foreign clients, I was finding comfort in the fact that I don't have to put myself into their shoes when they ask me that, will India outperform EM and Asia? And I used to say that my job is to ensure that your India money outperforms the benchmark. The difficult one will be whether it outperforms Korea and Taiwan, and that's how it has been. But our opinion has all from that point on turned that if you want to find anything beyond the very obvious AI trade, when I say Korea and Taiwan, it's largely 3 or 4 companies that we are talking about. So India did better than those largely 3 or 4 companies. Is great improvement the way I see it. So, but a large part of that, in fact, in the June month, India has now outperformed EM and Asia ex-Japan benchmark for the first time in 5-6 months. So yeah, we are turning the corner, but we're doing it quietly. And that's why, you're not seeing such big headlines yet.
Vikash, hi, Alex here. Just wondering, in the context, and you've spoken about the relative performance of India and South Korea, people are worrying, right? Investors there because of the way that things are devolving very, very quickly. But having said that, the macro setup as things stand right now in the middle of July looks significantly better than it did look even 2 months back for India, doesn't it? And from that perspective, with earnings ramping up with the pace that they're coming through, and if the initial suggestions are accurate and more companies will surprise on the upside than not, then the path ahead for FY27 doesn't look so bleak on the earnings front too.
Yeah, I think some of those reasons, Alex, were the reasons why we turned constructive and quite bullish on India at the start of April. I would say that yes, you make a comparison versus 2 months ago, but I think the macro setup has slightly deteriorated from where it was about a month ago. About a month ago, when we were talking of a peace deal and a clear setup and no worry around that, then the setup was far more clear. We were far more bullish, and it was an easier thing to know the sectors to bet on. Right now, it's got a little bit more clouded because the uncertainty on when this peace deal is off for sure. Now, when will peace actually return? Is that uncertainty? So, from a perspective of portfolio construct, yes, we need to be bullish, but there is a far bigger need to hedge our portfolios than how we were feeling, say, about a month ago, when peace had started and it appeared like it would be more durable. So yes, we've gone through this volatile kind of a setting. Sometime in April, May, things look really, really bad. India did a pretty good job in terms of holding itself together in the middle of that crisis. In fact, we did pretty well in terms of managing that crisis. June onwards, things started looking up quite a lot. And July It's again got a little bit more clouded, nowhere close to as bad as March, April yet. But yes, we need to be a bit more careful.
Cash, there's an internal debate that we've been having, and I invite you to weigh in on that. My view is that as uncertain as things are, and you're right, it's this current peace deal is off. It's not going to get as bad as it did when you had crude at 120 and fear of nuclear war and the Gulf states getting bombed, etc. We learn to live with this version of it. Do you think that's being overtly optimistic?
So, Tamanna, I would like to say that there are times in the market when you can say that I cannot speak for this in a lot of confidence. I think this is one of those questions, and therefore, I would not want to ignore the implications of that when building my portfolio. So I would say that I am far less comfortable on the lasting nature of this trouble ending as I was in the middle of June. And the reason for that is we are far less protected now if this continued for another 2 months or so. Because of the way we've aggressively eaten out of the inventories in the developed world. If this continues for the next 2 to 3 months, then I think consequences can be really dire. So we cannot ignore that. The other thing is the intensity of the language and the way it has turned when both of these countries are talking about each other just makes me a little bit more worried. And finally, if, because we're dealing with, on the one side, a democratic nation where there could be important elections coming up, and the other side knows about it, that if it can just hold on closer to that elections, then it might be able to create more trouble. That just makes the situation that much more complicated. So all that I'm trying to say is that I would definitely want to be, I remain optimistic, remain positive, but I would still want to guard our portfolios from those potential risks. Basically, on this point, I would just want to say that maybe I don't want to take a call, and I'm a little unsure about it.
Yeah, fair enough. Okay, in that backdrop, so turning constructive on India relatively, this uncertainty prevails. What looks like a good idea to you right now, Vikas? Are you looking at some of the IT results and saying that, hey, maybe there's a turnaround there? Are you looking at BFSI and saying there's a safe spot? Are you looking at sectors maybe that the government wants to give a boost to, like we've seen with EMS players today?
Sure. So if we look at the setup that is likely to sustain for the next few months, there are two parts. One, of course, we just spoke about, which is we need to protect our portfolios from those potential risks. On that bit, definitely, I would say that we need to have some exposure to commodities because at the same point of time, what has happened is some of these commodities, which are, you can say, more war-sensitive commodities, which is, say, crude oil or which is aluminum, they've corrected quite a lot, and some of these commodity-related equities are actually pricing in even, levels where I would say even if the World War II had, they would not see a lot of downside. So that's the part of the hedge part of the portfolio. Then if you look at the other part of the portfolio where we kind of start seeing a more improved macro domestically, the first thing that comes to our mind is the setup around financials. Now, this is a very interesting point where what might happen is that chances of an RBI rate cut looks quite unlikely. And at the same point of time, RBI might take time to maybe have any kind of a rate hike as well. So we are in a bit of a pause where all the rate action has already got priced in terms of NIM contraction for large private banks. And on the other hand, now, because of some bit of increase in inflation, you could see higher credit demand in terms of working capital, etc. So that's a great setup for private banks. And rather oddly, this is also not a bad setup for NBFCs if the war situation doesn't go out of hand, because that will mean that yields cool off. So we will have no rate cuts, but we will have some kind of a cool off in yields, and that might also help some of the NBFCs as well. So that's a very that's a not a typical kind of thing which happens concurrently, but that's the kind of setup that we are in terms of financials. So financials is a space that we like. I would say, other than that, selectively trying to pick discretionary names where, number one, the dependence on war isn't really that much, and number two, I would say they are more protected in terms of margins. So that could be some bit of auto names, some bit of quick commerce and retail names, where they're not so dependent on war-related inflation. Those could be other areas that we are looking at. And finally, if markets are all right and some beta returns, then we'd want to play that beta through real estate. That's how we are positioned in our portfolio, and that portfolio has done a reasonably good job in the first half of this year.
Vikash, let me quickly ask you, and you've described all of this pretty well and all of the rationale as well, but this whole data center compute, give me a count. Right, we're joined here by the Ministry of Electronics and IT, the Secretary for the Ministry, Mr. S. Krishnan. Thank you so much, sir, for taking time out for NDTV Profit. We're, of course, here to discuss a myriad of issues. The first and the most recent being the development around the cabinet approval for two schemes roughly worth 2 lakh crore rupees, the larger one being of course the Semicon 2.0 that has come out. Sir, talk to us about what learnings we've picked up from the first Semicon and what are we going to implement in the second iteration of this much larger scheme that the government has now come out with.
I think Semicon 1.0, the biggest success was that we were able to establish that India could be a location where advanced manufacturing can take place, particularly of semiconductors. It's the first time that in India, large-scale commercial manufacture of semiconductors is being successfully done. And that actually lends a lot of credibility for India as a location and as a destination for investments in semiconductor manufacture. I think that is significant not just for the country but for the world as such, because it diversifies the supply chain. So that is the first and most important message that I would like to highlight. Further, the need to take an ecosystem-based approach to semiconductors was the other important learning. Third important learning was that in the design-linked incentive scheme, it is essential to provide larger volume of support, not necessarily as a grant or as a subsidy, but even as investable resources. We need to crowd in more investable resources in order to enable some of these companies to really grow. Otherwise, they would just be absorbed by global entities and other companies, and therefore it's important that we provide them an opportunity to truly grow. So these were the 2 or 3 key learnings which we have brought into Semicon 2.0 in its design itself.
To that last point as well, to that effect, the government is also co-investing with certain chip design startups. That is also a difference in approach that has come up, because that is essentially to boost domestic ownership as well in these companies that, like you said, might get absorbed in the larger scheme of things. Very interesting one, sir. The other one is, of course, the MPMS, the mobile manufacturing scheme that has come out. Talk to us about, sir, is this PLI 2.0 that we're talking about when it comes to smartphones? What's the difference now? Why have we gone with a different thing?
No, I think the idea is that the emphasis in this scheme is a little different. The way it is structured is different. Again, we've learned lessons from the first scheme as to what has worked and what has not worked. Okay. And we believe that this would be a more focused scheme intended to build competitiveness in India as a location where manufacture of an advanced electronic device like a mobile phone can actually take place. I think the fact that India is a location, is the second largest mobile phone manufacturer in the world, and many leading mobile phone brands are actually made in India and labeled as such, is something which has truly lifted the perception about the country globally. And I think it's important to preserve that, and it's important to maintain competitiveness in that sector. So I think that is one of the key objectives behind this particular scheme, to preserve the competitiveness. And the second thing that we have sort of focused on specifically in this scheme is to ensure that we try and support an Indian brand, at least 2 or 3 Indian brands to come up. Since, as you're aware, Indian brands did have a role till about 6 or 7 years ago, and then slowly their market share has been declining. Part of it is because they've not kept up to date with the latest technology. So I think today we now have greater capacity to actually manufacture in India through not just manufacture, but to design an Indian brand and make it sell globally. So in that sense, that is the second pivot that we've made in this scheme. If you look at the way things worked, say in China, I mean, it was after the ecosystem of Apple got built up there that other manufacturers and other Chinese brands developed. There's no reason why India can't follow a similar path.
Interesting. So more brand India, more brand Bharat phones is what we can expect from this particular scheme. Very interesting one, sir. The other issue that has come out in terms of India's digital ecosystem is, of course, the usernames issue. The MeitY has sent out notices. You have received responses, sir. I understand it is currently under examination, but what has been your sort of initial assessment so far? Have you asked for more?
Different companies have given their lines of reasoning and different aspects. So we will have to consider it in the light of that and seek any further clarifications if we need them before we finally take a call on that aspect.
Right. So with Meta, another aspect on CSAM, child sexual abuse material, has come up, and in an investigation that NDTV did, what we found was that for as low as 50 rupees, access to such material is widespread, and this is across platforms, across all sorts of big tech platforms. Now, we have enough laws, right, to govern all of these. How do we, again, hold them to what standard they should be held to?
You see, there is zero tolerance as far as CSAM material is concerned. The law outlaws it. I mean, there is clearly section 67B of the IT Act, under which it is not permissible to carry material of that kind. There is no protection of safe harbor, etc., when that kind of material is carried. And if anybody finds it, they should immediately report this as a cybercrime, as a violation of the IT Act, and action will be taken, strong action will be taken.
So the entire point, sir, is that the fact that the user has to report it means that it has already reached, or it has already potentially caused damage to certain people, right? Don't you think with the systems that these companies have already, with the sort of valuations also that they command, that they should be able to nip this in the bud better?
They are expected to do it.
Okay.
And if they fail to do it, then they, as much as the person who posted it, is liable.
Exactly. All right. Sir, what we also have coming up, and what you've also hinted towards, is a separate law to around artificial intelligence. Could you give us some sort of a contour around what the government is thinking around that?
See, I think the important thing you have to realize is globally there is increasingly a belief that there needs to be some regulation on what happens in AI. Now, if you recall, about a year ago, the loudest voice against any kind of regulation of AI was the United States.
Yep.
But today, when they restrict access to certain types of models, then clearly that's an act of regulation. So it sort of gives us a signal, clear signal, that globally we need to start thinking about these aspects, saying what are the kind of safeguards that different models need to have, what are the guardrails they need to follow, and when are they safe to be used, what are the risks if they fall into the hands of bad actors. So all of these aspects need to be considered. So which is why I think increasingly it's a global recognition that some form of regulation would be necessary. Of course, I think our stance still is that regulation should not stifle innovation, and innovation should go on, which is why it needs to be a very carefully calibrated set of measures, and also something which will keep pace with technology, which is not something which will be overtaken by technology very quickly, and at the same time will not stifle the growth of technology. So it's a very, it's a very fine line that we need to tread, and which is why designing such a law is a challenge and will take some time.
So we're also taking very active part in Pax Silica, for example, engaging with the US and that set of countries. We're already in talks with the EU, TTC. Are these AI law conversations that are happening abroad as well? What are we taking from those?
I think we are very much part of global fora which are looking into these issues relating to how technology is used, the way we can collaborate on technology, and an incidental aspect of this is what would be the kind of regulation. So I would not say that regulation is a single dominant feature of these conversations. In the case of Pax Silica, it is basically building capacity and making sure that resilient supply chains are built around semiconductor chips, AI technology, and critical minerals and so on, so that we have a very stable and resilient supply chain. Likewise, with the European Union, many of the conversations are, how do we do capacity building in both countries? How do we share technology? All of those are the more constructive and immediate aspects we're dealing with. Incidentally, as part of these conversations, we also exchange notes on the status of where they are on regulation and what their thinking is and how they go about doing it.
Right. So talking about another global sort of regulation that is coming up, and talking about safeguarding younger users, is the proposed social media ban for those under 16, and a lot of countries have implemented it. The Prime Minister was recently in Australia. He said that India is learning from Australia on that front. What's the thought that the government has on that front?
I think clearly we need to study what the experiences across various countries are in terms of what they have attempted to do with social media. It's a matter of concern. It's a matter of global concern. We find this raised in many fora, globally and in the country. Globally, in our conversations with our interlocutors from Europe and other parts of the world, clearly there are concerns on the way that social media has emerged and the risks that it poses. Within the country, in parliamentary standing committees, with various other organizations tasked with protecting human rights or protecting child rights, all of them have been raising concerns about exposure to social media and what can be done to limit it and so on. So we will have to, it's clearly an issue which is very uppermost in people's mind. So how exactly this needs to be approached is something that we will have to examine. We are in the process of discussing with a range of stakeholders to understand how this can be handled.
Very interesting. Lastly, sir, you have a lot of in the past, you've mentioned that India will be stress testing its system against these various models that have come up, much more advanced models that detect various flaws in cybersecurity. Where are we when it comes to having already stress tested it with whatever we have access to already?
We have been at that exercise for more than a month now, and Certain has set up a sandbox through which where they have put in about 9 to 10 models, open source models plus 1 or 2 Indian models, and those are then posed against the various kinds of software and code that we have for many government applications. Close to about 500 different applications have been tested or in the process of being tested. A number of vulnerabilities are identified, then the concerned agencies are informed of the vulnerabilities and they're asked to address them. So it's an ongoing process.
Interesting. All right. Thank you, sir. Thank you so much for your time. Viewers, this was MeitY Secretary S. Krishnan talking about myriad issues, talking about India's electronics manufacturing roadmap as well. Stay tuned to NDTV Profit.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
That are propelling India to what we call the Viksit Bharat stage. Those are demographics, democracy and digitization. These three things are instrumental in creating what we hope is a new India, a more bold India, a more braver India in the next few years.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
The news, Ayush. Since when do we do scripts? Fair point. Picture this. The biggest stage. Floodlights. 4K. The works. Where's the hook? There's going to be celebrities and guaranteed eyeballs. Where's the hook? Think about this. Front page advertisements and hoardings. Bro, where's the hook? Cross-platform, digital first, virality. Without a hook, no way. The message is clear. It's 2026. You gotta be real in a world of reels. You gotta be original in a world where everything seems generated. That's it. That's what we're looking for. The best campaigns, the hottest trends, the smartest brand moves on our new show. But wait, what do we call it? The hook.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information blitz into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight.
Welcome. You're watching Your Money Matters here at NDTV Profit. I'm Mahima Vachrajani, and this is a show where we talk about personal finance a lot more beyond stocks. We talk about mutual funds, insurance, etc. And today we're going to talk about international mutual funds. You know, with every social media post, with every reel, we've heard as to how you can go ahead and invest in these funds. But it's also important to discuss as to what are the routes via which you can do it. But at the same time, you know, as per recent developments, we've seen that international mutual funds have kind of cooled down in terms of where the rally goes. Of course, in the past, they've given stellar returns, but their momentum is kind of cooling off. And to take this conversation ahead, we're now joined by Rushabh Desai, who's the founder of Rupee with Rushabh Investment Services, joining us now. Rushabh, always a pleasure speaking to you and having you on the show. I think I'll ask by, I'll start by asking the question with regards to international mutual funds, right? Ki if the momentum has been reduced, what is the reason behind it, and what should one look at right now if they are foraying or exploring international mutual funds?
Hi, Mahima. First of all, thanks so much for having me on the show. As you correctly pointed out that, of course, yes, the momentum has been lost, particularly the upwards momentum in most of the emerging and developed economies, including the US. Now, there are 5 key reasons why the upwards momentum has been lost in the international markets. Number one, of course, as you also pointed out that, over the past 1 to 2 years, the rally has been stellar. The returns what international mutual funds have delivered has been exceptional. So number one is the stretched valuations. Okay, valuations have gone way above their long-term averages. Unfortunately, the earnings growth have not been able to catch up as per the current stretch valuations. This is number 2. Number 3, the market breadth has been quite narrow. What I mean by this is that liquidity has been pumped in only a handful of mega tech stocks. Okay, so the overall market breadth, if you see, has been quite weak, but there have been very few sectors and very few stocks within those sectors, particularly the tech sector and tech stocks, where there is a lot of liquidity and there has been an immense upside rally over the past 6 to 12 months. Number 4, Wall Street banks have flagged rising froth in the valuations and the risk of correction. That is why a lot of institutional investors have become quite cautious at this point of time. And importantly, the Iran-US war has spiked oil prices, and the lingering tariff uncertainties, all of this put together has kind of stopped the upwards momentum rally in most of the international funds.
Got it. So, I think you mentioned valuations, Rishabh, and that's not just one thing that people are looking at in the international space, right? There's also volatility. I mean, just talking about how Kospi has done over the last so many days, right? There's been so much volatility. That's also one thing that people need to consider when they are considering international mutual funds, and that's because of course, geopolitical developments also happening in a lot of markets. If somebody is looking at these funds, considering that they are losing momentum, what should their decision be right now? Because it's always suggested that at least some portion of your portfolio should have international exposure.
No, absolutely. I completely agree with you that some portion has to be given to international mutual funds, especially the US markets. There are 2 specific reasons to this. One is that, of course, the uniqueness of the companies what the US markets possesses. US markets are, I don't need to describe, is the mother of all economies at this point of time. And of course, let's not forget that the dollar has been strengthening by leaps and bounds. Today, as we speak, the dollar, if I want to purchase $1, I have to spend 96 rupees to get $1. So of course, the earning growth, the returns growth, what US markets are giving, and plus the dollar appreciation, all of this put together, some 10 to 20% allocation needs to be given, definitely, yes. But at the same time, see, why would anyone want to invest in the stock markets? The major reason is to get returns, right? Now, if someone is unable to get superior double-digit risk-adjusted returns, then there is no point investing in those particular stocks or sectors or that area, right? Now, the best way to get superior double-digit risk-adjusted returns is to time it well. Of course, we cannot predict the market cycles, but we can definitely time it. Now, by timing, what I mean is that when valuations come close to their long-term averages, when there is a price correction pocket, when there's a time correction pocket, that is the time you need to invest in those mutual funds, in those sectors, in those geographies. That is the time you will make money down the line in the next 5 to 10 years. So at least at this point of time, I don't see margin of safety in international economies, particularly the US markets, and I don't see a lot of upside opportunity from this point of time as well. This is the right time to stick with India because India has underperformed over the past 2 years. Indian returns have not delivered that much. If you see, the Nifty 50 has been more or less flat for around 20 to 24 months. So I think if you want to make returns from this point of time, I see immense margin of safety in the Indian economy, and I see immense upside opportunity over the next 3 to 5 years. But at least at this point of time, I'm not recommending any of my clients to invest in international markets because of the stretched valuations as we speak.
Okay, and then for somebody who already has exposure, do you also reckon to the fact that I mean, this is not via mutual funds, just deviating a bit, but if they have stock specific exposure, it's time to book out?
Absolutely. If the returns in their portfolio, whether it is mutual fund stocks or any kind of offshore product through GIFT City or LRS, if returns have jumped to around 20, 25%, 30% CAGR, then absolutely this is the right time to book profits. But again, if you are particularly talking about the US economy, if your time horizons is say another 5-7 years or so, then just stay put. But if your time horizon is coming near, and if you need liquidity in hand, then this is a great time to book profits. Don't delay a single minute.
Okay, all right. The other aspect is, Rishabh, that that people have been talking about is the route swap, which, if at all they want to consider, investing in international mutual funds or international stocks. What is that route? If you can give us that entire perspective to our viewers, what is that route? What are the limits in place? There is, of course, LRS that comes into picture, and what should one keep in mind while doing all of this?
Mahima, there are three main routes to invest offshore. One which you just mentioned, which is the LRS route. Second, under the LRS, there is a unique parallel route via the GIFT City. And third is the mutual fund route. Of course, mutual fund route is the most convenient route for practically all investors out there. But unfortunately, there is a $7 billion limit in mutual funds that all investors put together across all AMCs cannot invest more than $7 billion. If the limit has been exhausted, then you cannot invest. At this point of time, as we speak, that 90% to 95% of international funds are not taking money because the limit has been exhausted. There are very handful of mutual funds, international mutual funds, which are taking money. And even within the handful, most of them are taking money via SIP route, not lump sum. So if someone wants to take proper exposure in the offshore market, in the international market, then the best way to go is via the LRS route and the GIFT City route, because there is $250,000 of limit per person per financial year. So someone wants to invest, they can conveniently invest $250,000 per person per financial year. But again, as I mentioned before, that if you're investing in the equity markets abroad, this is not the right time. But if you want fixed income instruments in the US markets or in the real estate area, then of course someone can look into it. But equity, international equity is a big no, at least.
Okay, and this is from let's say 1 to 2 year perspective that maybe you are talking about. Correct me if I'm wrong here, but from a long term perspective, because I was looking at this HSBC global report which said that in the last 10 years, if we take a look at how different indices in the world have performed and as to what the 10-year CAGR looks like for Nifty Try and BSE Try, the average returns have been around 12 to 12.5%, right? This is the 10-year CAGR that I'm talking about. Only two indexes have outperformed the Nifty and the Sensex. That is, one is of course Nasdaq and the other one is Nikkei. Nasdaq with around 17% CAGR and Nikkei with around 13% CAGR. So just wanted to get a sense that from a long-term perspective, because we've also talked about this, right, that you must have some exposure to international markets in your mutual funds. So somebody who is doing mutual funds from a long-term perspective, what portion of allocation should they look forward to, and what markets should they explore?
Mahima, this is a great question, because now there is a plethora of mutual funds, international mutual funds, what we have out there, and there are lots of new products via the GIFT City and LRS route which are coming up by different PMS players and different AMC players out there. So I think keep it very simple. I think the key is to keep it very simple, Mahima. There are only two economies what I am recommending to my clients. One is from a core portfolio point of view, and one is from a tactical bet point of view. From a core portfolio allocation point of view, I think the US economy is the only economy what I would recommend which has delivered consistent outperforming returns on a 5, 7, 10-year rolling returns basis. So if you're looking from a long-term perspective, then US economy via S&P 500 or Nasdaq 100 should do the job. But if someone is looking for a tactical bet kind of investment, then Greater China region is something what I would recommend, which is China, Hong Kong, and Taiwan. As you would have already observed that Taiwan market on a 1-year basis has given around 150% returns. I mean, if you just look at around 2 months or 3 months back, the returns would have been probably around 200%. But keeping the correction in mind, even with the current correction, the 1-year returns in the Taiwan market has been around 150% or so. So I think tactical bet, keep it simple, China, Hong Kong, and Taiwan. From a long-term perspective, then US economy, which is S&P 500 and Nasdaq 100, is something what I would recommend.
Got it. The other factor, Rushabh, is that when anybody is kind of investing in international markets, there are certain things that he or she should be definitely tracking. Though it's from a long-term perspective, and that you might think that you're just going ahead and investing in mutual funds, but I think it's important for anybody and everybody who is taking that exposure internationally should keep certain things in mind. Is there a checklist in place that one must consider?
There are a couple of things, Mahima. Number one is don't get carried away by looking at the past return. That is absolutely very important. See, if you want to make money, then you have to take contra bets, okay? So always play contra across geographies if you want to make returns. Now, what I mean by contra bets is that, say, for example, currently as we speak, US, Taiwan, many other emerging economies have delivered some superior returns. Around, say, 57% on returns on an average has been delivered over the past 1 year. And if you look at the 3-year returns, many of these international funds have given anywhere between, say, 20 to 40% CAGR, which is phenomenal, right? So if you are wanting to invest and make money, look at economies which are underperforming with strong fundamentals. So, for example, currently as we speak, the Nifty 500 index has delivered only 0.5% returns over 1 year, 1 year returns, 1 year point of view. And from a 3-year point of view, the Nifty 500 has only delivered 12.5%. So I feel that at least at this point of time, India is an economy one should definitely look at because it is underperforming. There is immense margin of safety and immense upside opportunity from this point of time. So play contra across different geographies, number one. Number two is don't go overboard. Because see, India is the fastest growing economy. So you will see more consistent returns in the Indian economy and in the US economy. Other economies would be practically more cyclical comparatively, more cyclical and more volatile. So if you are, investing abroad, look into two things. One is that core investment, consistent investment, which should be the US economy. And one is tactical allocation, which should be, China, Taiwan, Hong Kong, and other economies out there. So I think being very clear, not going overboard, playing contra, and I think sticking to your goal, risk appetite, and time horizon is something what I would highly encourage and recommend, Mahima.
All right, Rishabh, thank you so much for putting those thoughts so clearly. I think for anybody who's looking at an international exposure now probably has answers to all his or her questions. So thank you so much, of course, for taking out the time and speaking with us.
Thank you so much, Mahima.
All right, with that, viewers, it's time to slip into a very, very short break. But on the other side, we're going to talk about two very interesting mutual funds. We're going to compare Bandhan Small Cap and Quant Small Cap. So do stay tuned in.
India Inc.'s most respected names chose India Inc.'s best and brightest.
These kinds of awards from the jury lineup, you are truly giving it the right weightage. I think it's heartening to see talent that there is in across India Inc. We should be awarding companies and individuals who have focused not only on growth but also on bringing good governance.
Be part of jury and vote on the people, the men, the women, the companies in India who have the right stuff is a great opportunity for us.
For us, the biggest thing is trust. That's what we provide. We need leaders in India that can help take India being a global superpower.
We've got a fantastic jury and we've left all decisions to the wisdom of the jury.
Who will earn India's top business owners?
Welcome back. You're watching Your Money Matters here at NDTV Profit. Now we're going to talk about two small cap funds that probably every other person in India holds in their portfolio. We're talking about Bandhan Small Cap and Quant Small Cap. We're going to try to differentiate between the two and try to understand as to which one is more riskier, which one is more dynamic, etc. And to take this conversation ahead, we're joined by Harsh Kumar, who's a CFA and managing partner at Zwest Financial Services LLP, joining us now. Harsh, always a pleasure speaking with you. I think I'll start by asking the very basic question first, because when I was seeing at both of these, from my opinion, I think Bandhan is something which is more slightly process driven, whereas there's Quant, which is more dynamic in nature. What is it that differentiates the two as to when strategy comes into picture?
Right, Mahima. So just to clarify, both the funds follow a process. So let's start with that. So, so before comparing these two funds, I think it's worth understanding why this category has attracted so much investor attention, because everyone is talking about this category. Now, let's see the flows first. So if I look at last financial year, FY 25-26, small cap category received second highest net inflows among all the equity categories, accounting for nearly 15% of the total equity net inflows. And it was second only to flexi cap category. If I go 1 year prior to that, FY 24-25, again we saw small cap being among the top 3 net inflow categories. Now, what is the reason? Why so much of interest of investors in this? And the simple answer is recent performance. Now, if we look at the period from Jan 2008 till Jan 2020, which is a fairly long period of 12 years, Nifty small cap TRI delivered a return of only 3.1% CAGR, which is in fact lower than the saving bank rate of interest which you would have got during that time period. However, if you look at the return from the lows of March 2020 to the peak of September 2024, you won't believe the number. The index in itself generated 6-fold return, and which was a CAGR of 48%. So if I look at last 18 years journey, a substantial part of return or wealth creation in small cap has happened in only 4.5 years. And this 4.5 year period, which has just gone by, is the reason that investors are so excited about it. Now, before I get into these two funds, let's look at the category also. So there are total 36 funds in this category. Total AUM is around 4.3 lakh crore. And the biggest fund in this category is Nippon, with an AUM of around 78,000 crore. Now, this category has a fairly long tail. And when I say long tail, let's see the numbers. A handful of mutual funds have become very large in this category, but there are only 13 funds which have AUM of more than 10,000 crore. Now, you may always say that, a lot of funds have been launched in last 2-3 years, and that could be the reason. But even if I look at marquee fund houses, ICICI Prudential, Aditya Birla, Sundaram, these 3 fund houses have small cap funds for last 18 to 20 years, and still the AUM is less than 10,000 crore. So setting this context makes us believe that Bandhan and Quant have done a fairly good job. Now let's understand what similarities and dissimilarities they have. So first look at the similarities. Both of these funds are fairly large in terms of their AUM, not just in terms of absolute AUM, but as a relative percentage of the fund house also, they are fairly big. So for example, if I look at Quant, the AUM of Quant small cap is 33,000 crore, and the AUM of Quant mutual fund in entirety is 95,000 crore. So you see here, this is the fund which is 1/3 of the total AMC. Similarly, if you look at Bandhan at 28,000 crore, it is the biggest equity fund which is with Bandhan Mutual Fund. And that's the reason that these two funds are also managed by the CIOs. Now, in terms of vintage, if you look at paper, you would see that Quant shows that it's a 30 years old fund, but that is not a true picture, because the recent investment philosophy and investor association has been only for last 7 to 8 years, because Quant acquired Escorts in 2018, and from there on, the philosophy of this fund changed, and from there on, we started the AUM accumulation also. Bandhan Small Cap was launched around 6 years back. So in terms of similarities, they're both managed by CIO. They both have similar kind of an AUM, and the vintage is also similar. Now let's look at where the differences are. So Bandhan follows a predominantly bottoms-up, fundamental, investment approach where they rely a lot on primary research. They rely on companies with strong long-term earning potential. While Quant, on the other hand, as the name suggests, it plays a lot on quantitative methodologies. It is very dynamic, like you mentioned. It has a momentum tilt to itself in the way it's managed, and the fund repositions itself fairly quickly in comparison to what Bandhan does. And if I look at the portfolio construction also, there is a difference. So if I look at Bandhan, it's very, very broad fund. The current holding in this is around 251 or 252, which is even higher than the number of holdings in small cap 250 index. Quant, while on the other hand, manage around 100 stocks, making it a relatively concentrated portfolio. And so is the allocation pattern. So if I look at Bandhan, it maintains 85% in small and mid cap, while the rest is cash and large cap. Quant historically has been more flexible. While we speak, Quant is having 66% in small cap, which is just 1% above the basic regulatory requirement. And the top 10 holding in Bandhan is around 20%. For Quant, it is 36%. So to cut the long story short, while Bandhan and Quant both operate in the same category, they both generate long-term wealth, and they have done quite well. The route which they have taken is very, very different.
Got it. And a quick one, Harsh, here, because, Quant, if I'm not wrong, has delivered better returns as compared to Bandhan. If I'm not wrong, I might be wrong here, so correct me if I'm wrong. But in terms of how, the portfolio churn stats, that's slightly higher in Quant, is that correct?
So yes, so I'll take both the parts. So first is about the performance. So if I have to meaningfully compare the returns, we have a time period of 5 to 6 years to compare. Correct. Because like I mentioned that, both the funds have a vintage of that duration. Now, there are two ways in which we can look at return. First is let's look at the trailing return. So both the schemes, if I look at that way, have comfortably outperformed their benchmark across all the meaningful trailing periods, starting from 1 year to 5 years. So irrespective of which fund an investor would have had in the portfolio, both have generated significant alpha over the benchmark for the last 5 to 6 years. Now, within the category, Bandhan has emerged as one of the strongest performers over last 3 and 5 years period. Now, Quant also has ranked better, but it has not been as good as Bandhan for last 3 to 5 years period. If I look at last 1 year, and 1 year is a very short time period, in that time period, both the funds have not been in the top 7 or 8 funds, but Quant has outperformed Bandhan. Now let's look at the calendar year, which gives us a very, very interesting picture. Let's look at 2021 and 2022. These were the exceptional year for Quant, and this was a time when Quant became very, very popular. It was not just in quartile 1, it was the top performing small cap fund in this category, and the return was quite significant, whereas Bandhan was at the bottom of the pack. Now the narrative started changing in 2023. Coincidentally, that's also the time when the current CIO of Bandhan, Manish Gunwani, he moved to Bandhan and he started managing this fund. And the story changed meaningfully. From 2023 till 2025, Bandhan was in top quartile in all the 3 years. Quant, on the other hand, had a reversal of story. So it was in top quartile in 2021, 2022, and 2023, and it slipped to third quartile in 2024, which was its weakest relative performance in the recent year. However, it subsequently recovered because in 2025 and 2026, it's been in quartile 2. So, both have had different phases. Post-COVID, Quant did really well. But for last 2 to 3 years, when the market has been more of a range bound, Bandhan has done well. Now, coming to the churn or the portfolio turnover ratio, you are right. Bandhan has a portfolio turnover ratio of around 0.22, while Quant has historically run a turnover ratio which is 2.5 to 3 times higher than that. I don't intend to say which strategy is better because these are two different styles of managing. But for somebody who's looking at more of a buy and hold portfolio, Bandhan ranks better. But for somebody who wants a little bit of momentum, little bit of sentiments to play in the portfolio, their Quant runs better because they are able to churn their portfolio at a much faster rate than what Bandhan would do.
Got it. Okay. Harsh, in terms of, just one last question, because small caps ideally are considered to be risky, right? So how much portfolio exposure should you have in small cap? That is one question. And the second is to whether somebody is taking positions in small cap mutual funds, what are the risks that they need to watch out for sure?
So first thing first, in terms of how much allocation should be there. So I would purely rely on NSE 500. If I'm a growth investor and if I want to just replicate the broader market, which is NSE 500, the current ratio stands at 60% large cap, around 20 to 21% in mid cap, and 21 to 22% in small cap. So that should be the ratio in my portfolio also if I am just replicating the broader market. And this number has changed significantly in last 12 to 13 years. Large cap used to be 82 to 83% a decade or so back, and now it has come down to 60%. And the reasons are obvious because of earning growth, a post-COVID rally, and all these reasons. That is answer to part number one. Second, when somebody is looking at this category in terms of risk, one should be very, very clear about the time horizon one needs to give to this. Like we discussed that for last 18 years, if I look at the return has come in only a patch of 4.5 years. So if you are getting into this category, you should at least have 8 to 10 years of time frame. That is part number one. Second, the volatility of this category is inherently higher than large cap, hybrid, and other categories. So if you are a person who doesn't like too much of a volatility in the portfolio, then this is not the category for you. But if you are looking at a longer term time period and the volatility doesn't bother you, then I think you can look at this space. Third, and the most important tool here, is that fund selection is very, very important. Now let's look at the universe. If you are a large cap fund manager, you have 100 companies. These are well-researched companies. Sell side cover these companies really well. So you can construct a portfolio with a good amount of ease. If you look at small cap, many of these companies are undiscovered. Many are not even covered by sell side. So you have to rely on the primary research. So I would strongly recommend to look at small cap only from the fund house, which has the ability to invest in research. Second, where the fund manager is more seasoned. And while we speak, among the top fund houses today, many of the small cap funds are managed by the CIO. If I look at HDFC managed by CIO, so is the case with SBI, so is the case with Bandhan, and so is the story with Quant. So give a credit to the fund manager who you are betting on. And lastly, don't try to over allocate basis the past return. You should go by your asset allocation, look at your profile. I said growth investors should look at 20-21% allocation in this. If you are a defensive investor, you can have 5 to 10% allocation, but maintain that.
Got it. Okay, Harsh, thank you so much, for taking out the time and helping us understand, of course, first the difference, and then as to how much exposure should one take in small caps, and of course, taking out the time and speaking with us at NDTV Profit.
Thank you so much, Miriam. Pleasure is mine.
All right. With that, viewers, completely out of time on this edition of Your Money Matters, but do stay tuned in for more news and updates on the other side of the break.
India Inc.'s most respected names chose India Inc.'s best and brightest.
These kinds of awards and the jury lineup, you are truly giving it the right weightage. I think it's heartening to see talent that there is across India Inc. We should be awarding companies and individuals who have focused not only on growth but also on bringing good governance.
Be part of jury and vote on the people, the men, the women, the companies in India who have the right stuff is a great opportunity for us.
For us, the biggest thing is trust. That's what we provide.
We need leaders in India that can help take India being a global superpower.
We've got a fantastic jury, and we've left all decisions to the wisdom of the jury.
Who will earn India's top business honors? Find out at the NDTV Profit Business Leadership Awards.
I got blooded in the stock market in the early 90s when Narayan Murthy and Infosys went public, and forever after that we've been spoiled. We look for businesses run by entrepreneurs like Narayan Murthy who have boldness, who have vision, and a great sense of corporate governance. So some of the qualities that we admired in the stocks we invested, we also look for those in the entrepreneurs that we invest in. So those are the best qualities to look for.
The news, Ayush. Since when do we do scripts? Fair point. Picture this. The biggest stage. Floodlights. Wow. 4K.
Good evening, you're watching Profit 360 with me, Shreyansi Singh, and this is the show that's going to get you a highlight in terms of all of the earnings that have been reported today, as well as some of the other updates as well that you should keep in mind. And speaking of those updates, let's talk about the IPO market that is showing signs of life again. After months of being selective, investors seem willing to write checks. Once more, strong listings, healthy subscription numbers, and a steady pipeline of new issues that have lifted sentiment across the primary market. And it's not just the main board space IPOs that you're talking about SME IPOs as well, that are seeing some of that renewed interest really coming in. But we'll get you that update in a bit. Right now, we should be tuning in to ICICI Bank's con call that is currently underway.
ICICI Bank, our strategic focus continues to be on growing profit before tax, excluding treasury, through the 360-degree customer-centric approach and by serving opportunities across ecosystems and micro markets. We continue to operate within the framework of our values to strengthen our franchise. Maintaining high standards of governance, deepening coverage and enhancing delivery capabilities with a focus on simplicity and operational resilience are key drivers for our risk-calibrated profitable growth. Our board has approved the financial results of ICICI Bank for the quarter ended June 30th, 2026. I would like to highlight some of the key numbers. First, moving on to profit and capital. 1. The net interest income grew by 12.7% year-on-year to 24,384 crore rupees in Q1 2027. Net interest margin was 4.36% in Q1 2027 compared to 4.32% in Q4 2026. Fee income grew by 23.5% year-on-year to 7,286 crore rupees in Q1 2026. Operating expenses grew by 10.4% year-on-year to 1,574 crore rupees in Q1 2027. Core operating profit grew by 15.6% year-on-year to 20,235 crore rupees in Q1 2027. Core operating profit excluding dividend from subsidiaries grew by 18.3% year-on-year to 19,125 crore rupees in Q1 2027. Provisions, excluding provision for tax, were 1,260 crore rupees in Q1 2027. Profit before tax, excluding treasury, grew by 20.9% year-on-year to 18,975 crore rupees in Q1 2027. Profit after tax grew by 15.9% year-on-year to 14,805 crore rupees in Q1 2027. Standalone ROE was 17.1% in Q1 2027. At June 30th, 2026, the bank had a net worth of about 3.5 lakh crore rupees. CET1 ratio was 16.19% and capital adequacy ratio was 16.84% at June 30th, 2026. Moving on to deposit growth. The total period end deposit increased by 14% year-on-year to 2.2% quarter-on-quarter at June 30th, 2026. Average deposits increased by 14% year-on-year and 6.1% sequentially during Q1 2027. Average current and savings account deposit increased by 12.1% year-on-year. Bank opened 97 branches during Q1 2027 and a network of 7,608 branches and 12,190 ATMs and cash recycling machines at June 30th, 2026. Moving on to loan growth. The total loan portfolio grew by 19.6% year-on-year and 5% quarter-on-quarter at June 30th, 2020. The retail loan portfolio grew by 12% year-on-year, including non-fund outstanding. The retail portfolio was 41.1% of the total portfolio. The mortgage portfolio grew by 14.6% year-on-year. The personal loan portfolio grew by 12.9% year-on-year. The credit card portfolio declined by 1.9% year-on-year. The rural portfolio grew by 35.4% year-on-year. The business banking portfolio grew by 28.2% year-on-year. Growth in the domestic corporate portfolio was 18.5% year-on-year at June 30th, 2026. About 71.9% of the corporate loan portfolio was rated A- and above as at June 30th, 2026. Now moving to asset quality. Net NPA ratio was 0.35% at June 30th, 2026 compared to 0.33% at March 31st, 2026 and 0.41% at June 30th, 2025. During Q1 2027, there were net additions to gross NPAs of 2,707 crore rupees. Gross NPA additions were 5,552 crore rupees in Q1 2020. Recoveries and upgrades of NPAs excluding write-offs and sale were 2,845 crore rupees in Q1 2020. Gross NPAs written off were 1,673 crore rupees in Q1 2027. There was sale of NPAs of 239 crore rupees for cash in the current quarter. Provision coverage ratio on non-performing loans was 74.7% at June 30th, 2026. Total fund-based outstanding to all borrowers under resolution as per various extant regulations was 1,363 crore rupees. Loans and non-fund based outstanding to performing corporate borrowers rated BB and below were 3,485 crore rupees at June 30th, 2026. The total provisions during Q1 2027 were 1,260 crore rupees or 6.2% of core operating profit and 0.32% of average advances. The bank continues to hold contingency provisions of 13,100 crore rupees at June 30th, 2026. At ICICI Bank, customers continue to remain at the heart of every initiative. I would like to share some of the latest updates on AI that we are making to make banking simpler, safer, and more convenient. ICICI Bank has established a structured and disciplined approach to scale AI with the focus on long-term value creation, risk management, and enterprise-wide adoption. The bank has invested in enterprise AI platform which serves as a secure environment for development, hosting and development of AI and generative AI use cases. The bank continues to invest in AI and generative AI use cases across areas such as portfolio monitoring, customer onboarding, fraud detection, document extraction and summarization, and customer servicing, amongst others. These capabilities empower the bank to enhance customer communication, improve efficiencies, achieve faster turnaround time, support decision-making across functions, and deliver seamless customer experience. Our approach places emphasis on information security, data privacy, and responsible AI. We have implemented a comprehensive framework of guardrails, including defining ring-fenced areas for AI usage, human-in-the-loop oversight, stringent data access control, and effective model governance protocols. Parallelly, the bank continues to invest in internal capability building with focused upskilling initiatives across businesses, digital and technology teams intended to strengthen enterprise-wide readiness and support sustainable scaling of AI capabilities across the organization. Going forward, we will continue to operate within our strategic framework while focusing on micro markets and ecosystems. The principles of fair to customer, fair to bank, one bank, one team, and return of capital will guide our operations. Focus on building a culture where every employee of the bank serves customers with humility and upholds the values of brand ICICI. We aim to be a trusted financial services provider of choice for our customers and deliver sustainable returns to our shareholders. This, I conclude my opening remarks, and I will be happy to take on your questions. Thank you.
Thank you. Thank you very much, sir. We will now begin the Q&A session with Mr. Batra and Mr. Banerjee. Anyone who wishes to ask a question may press star and one on their telephone. If you wish to remove yourself from the question queue, you may press star and 2. Today's announcement is on the bank's financial performance. Hence, we would like to request you to ask questions related to that. Please write to the corporate communications team separately for any other queries. Due to time constraints, I request all of you to ask 2 questions at a time. If you have additional queries, you may join the queue again if time permits. Thank you. We'll take our first question from Ritu Singh from CNBC TV 18. Please go ahead.
Good evening, Mr. Batra and Mr. Banerjee. First I wanted to start by asking about your margins that really stood out, especially compared to almost all other banks that have reported numbers today. This further expansion you've been able to achieve now at almost 4.36%. Is this the normalized rate we should look at? How sustainable are these levels? Do you have levers to further expand? That was the first part. Second, this rise in slippages that we've seen, substantially in the quarter, from about 4,200 odd crores to about 5,500 crores. How much of this is seasonal? And are you seeing any stress on account of what's happening in West Asia? Because this is the first quarter when we'll see some of that impact come through. And if I may add a question on loan growth as well, which has been pretty strong. Corporate also seems to be doing well. What are the segments, of course, within your risk-calibrated, in your view, that you think are seeing higher credit demand that you believe will drive incremental credit growth for the bank?
Thank you, Ritu. There's lots of questions. I think, first of all, I'll start with the NIM question that you asked. As you're aware, as we have reported, the NIM increased by about 12.7% year-on-year and about 6.1% sequentially. This quarter, we had the benefit of income tax refunds, which helped in the margin improvement. This was about 8 basis points compared to about 5 basis points in the previous quarter and 7 bips in the Q1 of last year. The margins in Q1 are also reflective of the benefits due to repricing of term deposits, impact of higher interest refunds, offset partially by higher interest on reversal of KCC portfolio. To your point on outlook, I think the NIM trajectory would depend on a number of factors, which includes, of course, the geopolitical developments, monetary policy, liquidity, loan growth, and loan pricing. Our expectations of NIM is that in FY27 it should be range bound, assuming no rate movements. Of course, there will be some impact on account of FCNRB deposit program and loans against FCNR deposits, which could be sort of slightly NIM dilutive. But overall, as a bank, we would continue to look at leveraging, growth, and as you rightly pointed out, risk-calibrated profits through optimizing various levers where NIM is clearly one of them. Coming to your point on slippage, I think it will be better if you compare that number over Q1 26 over Q1 27. I think there are seasonality impacts. If you look at that number, in Q1 2026, it was about 62 billion, which is now down to 55 billion. Moving on to loan growth, as you are aware, you're seeing loan growth across all the segments. In particular, corporate loans, we have seen some amount of sequentially pick up, which has been largely due to, from our point of view, we continue to have active engagements with our corporate clients, and we continue to seek opportunities whichever meet within our risk and reward thresholds. During the current quarter in particular, I think there was a little more demand on account of working capital, and also we have seen some kind of a moderation in the bond markets and equity markets, which has been an opportunity for us to capitalize.
Mr. Batra, if I may, you didn't answer the reason why there was a sequential rise in slippages, and even on FCNR, since you bring it up, what's the target you think? How much could the bank raise, and what kind of leverage?
That is seasonal. The first one is seasonal, so I don't think so. I would like to call out anything specific on the quarter. So it's just a question of seasonality. If you have to look at, and most of it is, the difference is because of Kisan credit cards. So on FCNRB, since we are talking about the subject, I think we are. It's a great measure from a government point of view. And of course, it is early stages yet, and this will evolve over the couple of months. And as you are aware, we are going to continue to focus. We will be tapping on the Indian diaspora. You are aware that we have got a large international presence, and we will leverage all our international branches, especially those in West Asia. We have also tied up with various partners for providing leverages. We'll be raising bonds. This amount we do expect the momentum to pick up as we go along. And of course, we are committed to make this initiative of RBI a success.
But no amount, Mr. Batra, you could share?
No, we can't. It's very difficult to say at this point of time.
All right. Thank you.
Thank you. Next question is from Siddhi Nayak from Bloomberg. Please go ahead.
Hi, sir. Am I audible?
Yes, please go ahead.
Yes.
Hi. I just wanted to take some of Ritu's questions forward. The 20% loan growth that we have seen for you, I think it's among the highest in the last few quarters. I wanted to understand how sustainable is that, and if you could, are you foreseeing any risks that could hamper this kind of credit growth for ICICI and for the banking sector as well?
No, I think growth is reflective of the continuous momentum of economic activity and also the impact of various policy initiatives which have been taken by the policymakers. From our point of view, we continue to see growth across segments, whether it is mortgages, rural portfolio, personal loans. We have also seen healthy growth in business banking, and for this quarter, as I already mentioned, there has been a good sequential pickup in corporate loans. So we continue to engage with the entire spectrum, and wherever we get opportunities which meet our risk thresholds and meet the pricing framework that we have, we are happy to lend. And from our perspective, it's not only about the loan growth. We look at customers on a 360 basis and the overall relationship with the customer, and within that framework, we take various calls. So this is. So we do have a strong balance sheet, and we will continue to look at various opportunities as they come along.
Understood. On the FCNR part, if I may ask, so what is the kind of leverage that you're offering, and what is the indicative demand looking like? I mean, there are some conflicting reports about inflows being very slow. Some say we have received a lot of inflows. You being the second largest private bank in the country, what is the demand on ground that you're seeing for FCNR flows? And if you could also share the leverage that you're offering, sir, through this product.
So we will offer leverage based on the customer profile and whatever leverage our partners are willing to offer. So we're not giving any specific numbers at this point of time. But rest assured, I think the customers will get a reasonable return. And from our point of view, we are, as I did mention, we are committed to making this scheme of the government and RBI a success, and we will continue to remain focused on it. I think the rates will evolve over a period of time. If you are reading various newspaper reports of various competitive activities, from our point of view, we look at, as I mentioned, we are looking both as leverage from our partner banks as well as raising bonds from our side, and which will help our customers. And we do expect a decent pickup to happen over the next couple of weeks and months.
So lastly, is there scope for you to raise? Do you see the need to raise these FCNR deposit rates because beyond 6%, that's on 5 years?
At this point of time, I don't think so there is any need. We will see how it goes along.
Sure. Thank you so much.
Thank you. Next question is from Sangeeta Mehta from Economic Times. Please go ahead.
Thank you, sir. Sir, wanted to know what is the estimated provision for ECL, and other thing is that what is the corporate pipeline looking like, because you've already had 20% in first quarter. So specifically corporate pipeline, and third is that what is the max leverage that ICICI would be willing to provide to the best rated customer?
No, ECL is effective from 1st of April next year.
So
I don't think there is anything specific. No, we are. I mean, those are the numbers that we will start sharing from a next year basis. At this point of time, we do not see a material impact on an ongoing basis. As we mentioned in the last call, there would be some marginal impact during the transition period, which we have got adequate. Adequate provisions are already in place. We will see. That is as far as ECL is concerned. The second question was on
pipeline.
As I mentioned, we have been engaging with our corporate customers over a long period of time, and whenever we get opportunities which meet our risk and reward thresholds, we are happy to lend to them. So there are adequate opportunities which are there, and this quarter did open up fairly good number of opportunities. So we will continue to engage with our corporate customers, and as I have always mentioned, it is not necessarily about the loan pipeline. We look at the overall 360 relationship with all customers, and in particular corporate customers, and look at the whole ecosystems and take a decision based on that.
And so what is the max leverage that you would be willing to offer?
We have not called that out at present.
Well, it will be, it'll be quite calibrated, and it will be at calibrated levels, and we will look at whether what is the leverage that we will provide, as Sandeep mentioned, what partner banks may provide, and there will of course be some unleveraged inflows as well.
Have you tied up any line of credit or bilateral loans in the last 1 month? Or any plan to?
These are all evolving things, and this is an activity which has started effectively only towards the end of June, once all the FAQs, etc. had come out. So it will evolve over, the second quarter, and of course when we do the second quarter results, we will have a full picture.
Okay. Just one last thing. Can you share how much you have raised so far in the last 1 month under FCNRB?
As I said, these details would be shared, in the second quarter, maybe at some point of time during the quarter as this evolves, because it is still very early days. Maybe some systemic numbers will start getting published, but from our perspective, it's a quarterly result item.
Okay, thank you.
Thank you. We'll take our next question from Shivam Killer from NDTV Profit. Please go ahead.
Yes, my question is on the corporate loan book growth target. So what could be the corporate loan book growth target going forward? As you have mentioned that the corporate lending has seen a better business due to the working capital requirements. So what could be the growth rate that the bank is targeting?
Shivam, as we have always said that we do not have any targets across any segment, and in particular corporate loan as well. We look at opportunities and at the cost of repeating, whenever we find opportunities which meet our risk thresholds and risk and reward and pricing thresholds, we are happy to lend, and we are focused on customer 360 and try to access the overall ecosystem.
And so my second question is regarding the margins trajectory going forward, as management was expecting that the margins could be in a range bound level previously, but recently the margins have been seen a slight improvement. So what could be the margin trajectory going forward from here on?
As I mentioned earlier, this is going to be range bound, and I think I've already responded to that question. So that the cost of repeating, I'll mention, we do expect to be range bound, and of course it's going to get impacted by many things like monetary policy, liquidity, etc. It could well be a little bit dilutive given the FCNR borrowing and deposits, because of the FCNR deposits that we are going to be raising. But we will continue to leverage. As far as we are concerned, we are looking at increasing the risk-calibrated profit and using all the levers which go into it, and in particular, NIM is an important part of that.
Yes, sir. And sir, if I could squeeze one more question in regarding the cost of funds. Do you see the cost of funds trajectory declining going forward?
It's very difficult to make that statement. It is again depends on all the things that I really talked about. At this point of time, we expect this to be range bound.
Thank you.
Thank you. Next question is from Mayur Shetty from Times of India. Please go ahead.
Thank you. I had a question on gold loans. Could you share the size of your gold loan book and also the year-on-year growth rate?
Mayur, we do not give specifically, but this is part of our rural portfolio. Substantial part of our rural portfolio is actually gold loan. This gold loan portfolio, the overall rural portfolio has grown by 35% year on year. And from our perspective, the loan product is just a product. Gold loan is just a product. We are focused more on the customer. And whenever we get opportunities to give loans to good customers, there are various products and options which are available. So this is part of that overall customer-centric approach that we have been talking about.
So it's not part of the personal loans segment?
No, it is part of the rural portfolio that we are giving, and a substantial portion of that you can attribute to gold.
Okay.
All right, then there you go. So that's the commentary coming in from ICICI Bank in terms of their numbers and the path forward from here. It's time for a very quick break. More news and updates on the other side.
India Inc.'s most respected names chose India Inc.'s best and brightest.
I'm delighted to be chairing the committee of such distinguished fellow businessmen, bankers. It's lovely to be back on this NDTV jury. I have been a fan of NDTV for a long time.
Many of the nominees are extremely close together in terms of what they've done.
I think it's also important that how they are reshaping the industries, commercial activities which they are into. And it's a very judicious mix of people to choose from. My compliments to the team.
Who will earn India's top business honors? Find out at the NDTV Profit Business Leadership Awards. India's unshakable news habit. NDTV.com is India's #1 English news website.
Access to capital, faster regulatory pathways, and market acceptance to create value. And if we get the pieces right, I think we can move from being the pharmacy of the world to being the most innovative lab of the world.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
The news, Ayush. Since when do we do scripts? Fair point. Picture this. The biggest stage. Floodlights. Wow. 4K. The works. Where's the hook? There's going to be celebrities and guaranteed eyeballs. Where's the hook? Think about this. Front page advertisements and hoardings. Bro, where's the hook? Cross-platform, digital first, virality. Without a hook, no way. The message is clear. It's 2026. You've got to be real in a world of reels. You've got to be original in a world where everything seems generated. That's it. That's what we're looking for. The best campaigns, the hottest trends, the smartest brand moves on our new show. But wait, what do we call it? The hook.
He has been tracking markets for over a decade. Spots the
Welcome back. Thank you so much for staying tuned in. Let's also talk about Kotak Bank that's reported a largely inline set of numbers. Now, when you talk about the net profit, that's largely jumped on the back of that lower provision number that you're looking at. Asset quality remained broadly stable, keeping in line with that trend as well when you talk about some of these other banks as well. So you're looking at the earnings quality that is largely good, driven by both the core income growth as well as the sharply lower credit costs as well. Like I mentioned, asset quality slightly improving, and some of those lower provisions and reduced fresh slippages are case in point here. When you talk about the growth as well, largely healthy and balanced. So you're looking at deposits almost keeping in pace with the advances as well. And when you talk about the entire provisions figure, that's coming in on a year-on-year basis at 668 crores versus 1,200 odd crores. When you talk about that on a quarter-on-quarter basis, you're comparing the 668 crores with 516 crores, and that's why it's in focus as well. When you talk about some of these other numbers as well, you do have the profit growth that was, like I mentioned, helped by the lower provision. So any commentary coming in from the management when it comes to the entire profit growth figure is something to really watch out for. Investors are going to be monitoring whether the NII growth is going to be accelerating in the coming quarters as well. So any commentary really coming in when you talk about your NIIs is something to watch out for. All in all, when you talk about the NIIs, it is actually a healthy figure, just, bordering on double-digit NII growth as well, with that 9.2% uptick coming in with the NIIs as well. And when you talk about how this keeps in check with some of the broader trends as well, when you talk about some of these other banks as well, you did, of course, have ICICI Bank reporting double-digit NII growth as well. And when you talk about HDFC as well, in terms of the NII, 6.7%. So that should put it into context in terms of how that number really stacks up against some of its peers as well within private banking. But let's go across and listen in to that bit of commentary that we're really watching out for right now.
What is most heartening is that strategy is working and the results are steadily coming through. Quite simply, all our engines are firing. The one exception was our capital markets business, which felt the impact of the prevailing geopolitical situation. But even there, we have a very strong pipeline for the remainder of the year. Let me start with the bank, where our profits grew a healthy 26% year on year. Our focus on the 4 customer segments continues to deliver. Customer assets grew 16%, led by our SME and institutional franchisees. This quarter, we were also very encouraged to see the early sequential signs come through in our unsecured retail book in both credit cards and microfinance. Average deposits grew 14% year on year, driven by steady growth seen in the high net worth and core India segments. I had mentioned that driving efficiencies through automation and digitization would be a key priority for this year. In Q1, our cost base grew by 8% on a year-on-year basis, but cost to total assets has come down from 2.83 to 2.66 year on year. We will continue to drive this effort on an ongoing basis. With this, our operating profits grew by 10% on a year-on-year basis. Credit costs remained well under control at 46 basis points. As you would have seen, we also entered into definitive agreement to acquire Deutsche Bank's India retail, private banking and wealth management businesses for rupees 281 crores. This will bring in about 150,000 customers, along with 29,000 crores in advances, 16,000 crores in deposits, and about 10,500 crores in AUMs. It is a clean strategic fit with our affluent and SME franchise and is expected to be return accretive and opens up meaningful cross-sell activities. This is precisely the kind of disciplined bolt-on opportunity our inorganic philosophy is built around. Turning to our subsidiaries, profitability continues to be strong, with profits growing 20% year on year. With standout performance from Kotak Asset Management, Kotak Prime, Kotak Securities, and our alternative asset businesses, Kotak Life too had a great quarter. As I mentioned, geopolitical tensions did dampen the capital markets businesses and weighed on our investment bank, though we go into the coming quarters with a very robust pipeline. And this is where the real uniqueness of our conglomerate model comes to the fore. We own 100% of our subsidiaries, and this quarter they contributed 33% of our total profits. That is the power of owning the full suite of financial services and being able to move with the trends as they shift through cycles. With all of this coming together, our consolidated book value per share grew 14% year on year. The operating environment remains dynamic, with several factors still to play out, and that will continue to demand agility from us. But the strategy is clear, the results are coming through strongly, and from here on, it's all about relentless and consistent execution against our long-term goals. With that, let me hand it over to Devang to take you through the financial numbers in greater detail.
Hi. Thank you, Ashok. Good afternoon, everyone. Let me start with key highlights of the bank standalone and consolidated performance for Q1 FY27. On standalone bank performance to start with, net advances grew 15% YOY to 5,21,249 crores for the quarter Q1 F25. Our customer assets grew by 16% YOY to 5,70,901 crores for the first quarter. Our total average deposit grew 14% YOY. In average CA and average fixed rate SA grew 15% and 16% respectively, taking CASA ratio to 40.33% as at 30th June. Average term deposit grew at 14% YOY. On a YOY basis, bank delivered a strong performance during the quarter, with profit after tax growing 26% to rupees 4,123 crores, supported by a 10% YOY growth in operating profit of rupees 6,131 crores. The key contributor to profitability were net interest margin at 4.53% and cost of funds was stable at 4.46%. NII grew 9% on a YOY basis. Fee income growth was at 11% on a YOY basis. Consistent improvement in cost reduction resulted in cost to asset ratio reduced from 2.83 to 2.66% on a YOY basis. Significant improvement was noted in the asset quality, leading to reduction from the credit cost from 93 bips in Q1 FY26 to 46 bips in the current quarter. The gross NPA was at 1.18%, down from 1.48 in last year first quarter, and the net NPA ratio is 0.27 versus 0.34 in Q1 26. As a result of all of this, the ROA of the bank increased by 20 bips to 2.14%. Our capital position remains strong with a capital adequacy of 22.8%, with CET itself at 22.4%. At 30th June, the bank's net worth was 1,40,924 crores. Overall, the quarter was characterized by stable margins, continued improvement in operational efficiency, and normalization of credit cost. Let me now move to the consolidated results. On a consolidated basis, our customer assets are 6,45,812 crore, which grew 16% on a YOY basis. On a group, customer AUM increased to 8,05,531 crores, reflecting a 8% YOY growth. The consolidated net worth of the bank is at 1,88,214 crores at 30th June, with book value per share increased to 189 rupees per share, which is a 6-year CAGR of 17%. Capitalization at the group level also remains strong, with total capital adequacy at 22.9%, in which CET1 itself is 22.6%. For Q1 27, the consolidated ROE was 11.9%, and consolidated ROA was at 2.18%. The consolidated profit after tax for the group is 5,480 crores, which grew 23% on a YOY basis. Coming to the performance of select subsidiaries, the profit after tax for Kotak Security for this quarter was 533 crores, up 14% on a YOY basis. Kotak Security also gained market share and it's now at 13.8%. Kotak Mahindra Prime profit after tax is at 354 crores, which is up 30% on a YOY basis. Kotak Asset Management and Trusteeship Company PAT for the quarter was 399 crores, up 23%, whereas the average equity AUM was at 3,91,208 crores, which grew at 18% on a YOY basis. Coming to the Kotak Mahindra Life Insurance Company, the PAT for the insurance company was 336 crores, which is up 3% on a YOY basis. We continue to have a strong solvency ratio of 2.2 in the Kotak Mahindra Prime. With this, I hand back to Prasanna. Thank you.
Thank you, Devan. We will now first move into the Q&A session. Before we begin, questions will be taken on a first-come basis. Please use the raise hand feature before you ask over Zoom. Once called upon, unmute yourself to ask your question. Kindly state your name and the organization that you represent. Please mute yourself after your question. More importantly, please keep your questions brief and allow time for more participants to question. With that, we'll pass on to the first question, which comes from Ritu Singh from CNBC. Over to you, Ritu.
Hi, thank you so much, and good evening, all of you. Mr. Vaswani, if you will, I have to start by asking you about the announcement that you made about stepping away from the bank come end of December. It was a very, very brief note, which was a clarification to exchanges, and I believe the street is looking for some clarity on why the reason for you to move on and have some successors, at least internally, been identified, and how quickly would the bank move to submit that application to Reserve Bank of India? That was the first question. On the performance itself, margins have seen some pressure in the quarter that has continued. Despite you talking about, costs remaining stable, if not coming down. What's happening there? When do you see this picking back up? On your asset quality as well, was it largely seasonal, the impact, which is why we saw some sequential rise? And lastly, on FCNRB deposits, is there a target that the bank has set how much it could raise, and therefore would that reduce your reliance on bulk deposits, help with the cost going forward? Thank you.
Wow, Ritu, that's like a half an hour session. Anyway, let me try and do it. First thing is on margin, Ritu. Actually, our margins are been flat for 3 quarters, like literally a 1 basis points move for 3 quarters. So margins have been kind of flat. As far as credit costs are concerned, they're significantly down, as Devang mentioned, 93 basis points to 46 basis points. Yes, they're up from 39 basis points in Q4, but that is a seasonal trend that we normally see in the tractor business, where Q1 and Q3 are the highs, and then Q2 and Q4 are the lows. So there's nothing there which is unusual, and credit costs are well under control. FCNRB deposits, yes, it is something that is a very interesting opportunity. I think we will give it our best. Of course, the NRI customer demand is very strong because it's such an attractive opportunity. It's our ability to kind of get the supply side done, which is going to make the difference. But we feel pretty reasonably good about it, and we'll see how it kind of pans out over the next month or two. At a personal level, Ritu, there's never a good time to call it a day, but the last 3.5 years have been spent doing a lot of hard, heavy lifting, as you well know. You're aware of the technology embargo. You're well aware of rebuilding of the entire management team. You're well aware of how we've cleaned up the personal loan book, how we've cleaned up the credit card book, how we've cleaned up the microfinance book, how we've got our liability engines all cracking. So I think the bank and the group, we have a good unified strategy across the group. And I think that, we are very well set now to accelerate our journey. So, may not be a bad time to step away. At a personal front, also, Ritu, I became a grandfather. My daughter's in San Francisco. So San Francisco calling, daughter calling, made it all the more compelling.
Congratulations on that, sir. But, I'd still push on to ask if there's a timeline for when, the bank would be submitting these names, and if there's any reason beyond, of course, you becoming a grandfather and for personal reasons for you to step back, because, you're the first non-founder, non-promoter CEO that the bank has had. So, this is something the street was looking for clarity on.
Yeah, maybe second, because Deepak Gupta was the first for a short period. And, from a timeline perspective, Ritu, there are clear regulatory guidelines, right? And the board and the NRC are very very conscious of the guidelines, and will make the applications entirely in line with those timelines.
Thank you very much. If there's time, I'll come back later. Thank you.
Sure.
Thanks, Ritu. We move on to the next question, which is from Hamsini Karthik from Money Control. Hamsini.
Hi, Hamsini.
Hi. Finally, Prasanna unmuted me. Thank you. So just wanted to ask you two important questions. Again, in line with what we're seeing as a trend with most of the banks, is that your corporate engine is also beginning to really rev up a lot. Does that give you more? Does that also mean that you guys are getting better pricing, better value for money from your corporate clients, more versus having to do a lot of drilling down in the retail portfolio? If you could help me with some color on this, I'll come back for my second question, sir.
Sure. Paritosh, you want to deal?
Yeah. So Hamsini, the last quarter gave us an opportunity to build on the corporate book, because the capital market started offering better spreads, and that is why you would see on the credit substitutes we grew 38% quarter on quarter, and it was purely opportunistic. Same was the case on the loan portfolio. Last quarter we had slowed down because the yields were not right enough for us to continue to lend money, and this quarter we saw an opportunity. So we have a small portfolio of short-term loans which we modulate and calibrate in line with the kind of pricing we get. So it was more opportunistic that we took advantage of the yield curve and built the corporate book just now.
Is it possible for you to turn this opportunistic moment into a strategically sustainable possibility, or are we stretching it too much?
See, on the credit substitute side, we look at the yield curve and our cost of fund, and if opportunities are right, we build it. For instance, if you look at the large amount of money which is likely to come in through FCNRB, we will see an opportunity that the investment book will grow from here.
All right. My second question is actually linked to FCNRB. What is the kind of portfolio that Kotak Bank has built on FCNRB thus far in the last 1 month? Is there any internal targets that you all can guide us? Are you partnering with foreign banks? How much are you exploiting Gift City to ensure the inflows that you're targeting? From this scheme. I would also be tempted to ask Ashok a question regarding the surprise he threw us on the 18th, but I'll come back for that. Yeah.
Yeah. So answering on FCNRB, it is a very interesting opportunity for us, and it's obviously important for the country as well. We are going to do our part, and we'll do it out of Gift City and the IFC where we've got presence. It's early days as yet, and we don't really talk about goals other than internally. So let's see how this all kind of pans out. We will partner with banks in Asia and Middle East and other parts of the world to try and enhance our proposition. And we'll see how this plays out in the next month or so.
You're still in the process of partnering. There aren't firm commitments yet. Is that an understanding correct?
No, we are. It's pretty good, pretty advanced work in progress. Let's put it that way.
Okay. Ashok, was it something that was running in your mind that you were going to call it a quits in December this year for a while? Was it a sudden decision? As the previous question did put forth, it did take us all by surprise. And would your NRC also look at external candidates, because there isn't regulatory clarity whether an external name should also be provided or it's only internal? If you could help us understand all that a little, Ashok.
Yeah, so answering frankly, the NRC will do what is right for the group.
Right.
And obviously they will look for the best talent there is available. I would say that internally we have a very strong bench, but I'm sure the NRC will look broader. And as far as I'm concerned, I mean, these decisions obviously are not taken overnight. These are kind of well thought through. And that's the way it should be. And I take it actually as a compliment that you thought of it as a surprise and that I was, working like nothing else was happening.
Thank you. It was a surprise. Yeah.
Thank you.
Googly well bowled.
Yeah. Thank you for remembering. Yeah.
Thank you. We move on to the next question. Before I jump into the call and the details, I have a couple of questions from our journalist friend from UNI, Bapu Narayankar, and I'll just read it out for Ashok and the team. He's got two questions. The first one is, what extent was the 26% increase in Q1 profit driven by the sharp decline in provisions rather than an improvement in the bank's underlying operating performance? And how sustainable is the trajectory? The second question is, your loan book expanded 15%, but NII grew only 9%, while NIM fell for the second straight quarter. Is Kotak sacrificing profitability to maintain growth? And how do you plan to reverse this trend?
Hi. Just to answer the question on this operating profit versus the provision. So I think if you look at it, while the profit did grow at 26%, even without the provisioning effect, the operating profit actually shown a growth of 10% on a YOY basis. So it's not just the credit cost coming down, which is contributing to 26%. Without that also, there is a 10% increase in YOY. And even that credit cost, if you see, has been consistently falling over last year, each and every quarter, right? So that's the first part. Second part, the question is on the NIM. I think we need to clarify, and we had clarified earlier that Q4 NIM of 4.67, every time in the last quarter of the year, because of the number of days, there is an anomaly. And actually, adjusted for that anomaly, the NIM is actually 4.54. So if I look at the adjusted 4.54 NIM of Q4, as Ashok mentioned, it is actually consistent with the NIM which was in Q3, Q4, and this Q1 is exactly same. There is a flat. So there is no as such a reduction in the NIM. It's just the anomaly created because of the number of days. every year in the Q4. So basically and the question was NII growth of 9% is effectively the asset growth multiplied by the NIM reduction is what the NII growth is. So obviously last year because of the repo rate, the NIM was falling, which has now stabilized. So on a YOY basis, obviously you will see the reduction in NII largely due to the NIM reduction because of the repo rate.
Thank you, Devang. The next question is from Subrata Panda from Business Standard. Subrata.
Hi, thank you. Couple of questions. First, on the FCNR front, what is the leverage you're looking to offer NRI customers? Also, will the FCNR deposits be margin dilutive going forward? Additionally, are you looking to tap the overseas bond market to, under the RBI's concessional swap window? And if you could help us with your plans on the acquisition financing front.
Okay. So on the FCNR front, yes, we are going to offer leverage, but we offer leverage for deposits of over a certain size, and that depends upon the partner banks. It depends upon our capabilities and our raw material availability in GIFT and DIFC. So those things are kind of being worked through. The returns, actually, there are multiple perspectives to it. One is, of course, what are you going to do with 3 or 5 year fixed rate money? In our case, like I've mentioned before, our deposit book is relatively short tenor. So this will effectively help us elongate our deposit book to some extent and create a greater degree of stability, which is something that we were desirous of doing in any case. Paritosh, you want to take the question on acquisition finance?
No, acquisition financing, we have adopted the policy basis RBI guidelines on acquisition financing, and whenever the opportunity comes, we will kind of start building on that basis.
On the overseas bond market front, if you can help with that.
Yeah, we'll look at that kind of opportunity. That is an opportunity we are looking at. No final decision has been made as yet, but it's something that we are considering very seriously.
Sure. Thank you so much.
Thank you, Subrata. Before I move to the next one, I have a question from Mayur Shetty from Times of India. What is the size of the gold loan book and what is the growth rate?
Anup, you want to take that?
So, gold loan book for us is still very small. However, this is a focus segment for us, and we are expanding our branch coverage on gold loan, and it's growing quite healthy as against the overall book. But from a relative size, it still remains small and very profitable.
Thank you. We'll move to the next one, which is from Shrishti Sharma from ETBFSI. Shrishti.
Thank you. Good evening, everyone. You all have already discussed FCNRB deposits. Another aspect to it is UAE circular that came restricting the representative officers of Indian banks. Now, West Asia is also one of the hotspots of garnering NRI deposits. Is RBI or Ministry of Finance in talks with the UAE government to uplift some of the restrictions? That's one. Second question on the...
I didn't get it, but Anup, maybe you can answer that question.
Yeah, you can go ahead with the second question.
Okay, I'll complete my questions. Second question on the credit card portfolio of yours. It's finally seeing an uptick. Where do you see it going? You've also acquired the Deutsche Affluent banking portfolio. And in your annual report, one of the remarks was you'll be open to more of inorganic acquisitions. Now, what areas do you see yourself going about such acquisitions? Third point, you're also one of the private banks for whom the headcount has seen reduction in the previous fiscal. AI is also one of your focus areas. Do you see the headcount reduction trend ongoing? That ends my questions. Thank you.
So on your first question on FCNR and UAE, of course, we are watchful on this situation. As of now, we don't see a specific issue through our DIFC or GIFT. As Ashok said, things are looking very encouraging on FCNR. That's the first question. However, things remain volatile to that extent. Coming to the credit card point, yes, we have started finally growing the credit card book. Though, if you see the spend
quarter on quarter is now positive. In terms of the credit cost, it is significantly down. What we have done on the card is we have fully restacked the product from a right product for right customers. Basis our two core segment, which is the affluent HNI, which we call as the solitaire segment, and the core India proposition in terms of Air Plus and Air and cashback. So that's where it stands. We would grow it at a focused manner, and largely the focus is on existing customers. So from a credit quality standpoint, that remains robust. So that's the second one.
Headcount.
On the headcount, if I think about it, if you see employee cost has grown 7%, that also includes the retiral and annual increment. Otherwise, through the automation, digitization, and decongestion projects, which we have been driving as a bank, we do see significant productivity enhancement, which has started coming in, and that's a direction we have a lot of more work to do, and we do see great opportunity in quarters to come. So yes, we would remain largely flat on headcount. Unless we see specific area where we need to invest, we'll still invest. So it's not that we don't want to invest on headcounts.
And on credit cards, do you have some target for FY27 since you were starting to grow again?
So we don't give a forward guidance to it, but as I said clearly that it's a great product for the banking customers from a long-term relationship point of view. So we would give more and more cards to our existing customers, to their families, and ensure that the overall relationship value is enhanced, and build a very profitable cards business.
All right. Another point I'd also added was Mr. Vaswani's message in the annual report to inorganic opportunities. Would you have some commentary to make on what kind of areas do you foresee, tapping onto?
Yeah. So look, our inorganic strategy and framework, I think I've spoken about it a lot. It comes down to three questions that we ask. We look at every single opportunity that comes along. Three questions. Number one, does it strategically make sense? Like, for example, Deutsche makes a lot of sense, right? 150,000 high net worth and SME customers, exactly the kind of customer segments that we're trying to go after. Number two, is it financially accretive, financially attractive? Again, we bought that business for 281 crores. It clearly will be return accretive. So that's a good thing. So answer one, yes. Answer to question one, yes. Answer to question two, yes. And answer to question three, which is really, will this create management distraction or require too much bandwidth? And with these kind of bolt-on tuck-in acquisitions, the management distraction is relatively speaking low. So if it's a yes, and no, it then becomes a very attractive thing to do. And we will try and do as many of these as we can. And we've been doing it. We did it with Sonata. We did it with Standard Chartered. We're now doing it with Deutsche. And we will continue to look for such opportunities in the marketplace.
Thank you.
Thank you, Subhana. We move on to the next one, which is we're moving on to Subhana Sheikh from NDTV. Mint, sorry. She's moved to Mint now.
Hi, sir. Good evening. Sir, on FCNR, you just said that, you're looking at a certain deposit size. It depends on that, your tie-ups and all of that. I wanted to ask, how cautious is the bank, in giving leverage and, giving that much exposure to certain clients? And also, sir, I wanted to ask, you said that this would elongate your, deposit book. Any idea as to how much this would contribute to your overall deposit book in Q2 probably? Given that you have your internal targets, I understand you don't want to share that, but how much it could contribute. And my second question, sir, is that while your asset quality has improved, sir, your credit costs have gone up sequentially. Slippages have also increased a bit. You said that, if I'm not wrong, you said that your investment banking business has suffered because of the situation in West Asia. So has the any impact you've seen on particular sectors because of the war, and are you still cautious going forward?
Wow, that's again a lot of ground to cover. Like I said, FCNR, look, the customer demand is very strong. It really is a matter of how much we can tie up with partner banks to provide the leverage. That's what will determine the quantum of leverage. That determines at what size we give leverage. It's still very, very early days. Let's see how it pans out. But like Anup also mentioned, we are quite encouraged by what we are seeing. And we'll see what happens. Obviously, the quantum of deposits we get will be in the 3 and 5 year kind of bucket, and that's what's going to help us elongate the deposit tenor. Today we have deposits worth about roughly 5 lakh crores. You add some amount to FCNR. It's not going to completely move the needle, but it will have some kind of impact. As far as the geopolitical situation is concerned, like we've kind of talked about it, supply chain disruption has happened and keeps happening. I mean, this is a very, very fluid situation, and suddenly, we are in ceasefire mode. Suddenly, we are on war on mode, affecting the traffic through the Strait of Hormuz. So clearly, supply chain disruption has happened. Now, generally speaking, industry has managed this very well because of the stocks they've had, because of the alternate supply chains that they've kind of established. But some level of supply chain disruption has definitely happened. Certain level of inflation has definitely come through, and you heard the RBI governor talk about that as well, right? So some impact of supply chain disruption and inflation will happen. We are obviously hoping it's not going to be severe, and we are constantly, very closely monitoring all our portfolios to see if we can see any sign of stress. As of now, we are seeing no sign of stress. But are we cautious? Yes, we are cautious. We don't want to be caught out and miss it. In fact, the fact that we are not seeing anything is a little more worrying, because you keep asking yourself, are you missing something? On the credit side, like I mentioned, the credit costs are purely gone up from 39 basis points to 46 basis points, which is just clearly the tractor kind of seasonality. It goes up in Q1, goes up in Q3, comes down in Q2, and comes down in Q4. So that's purely seasonality, nothing else. And on the investment banking side, capital markets, because of all of these certain things, a lot of IPOs have got postponed out, but we've got a very, very robust pipeline. And our investment banking business, as you know, is in many ways a jewel in the crown. We are number one on the league tables, and the team has done a fantastic job. And I'm very confident that the other quarters will play out very nicely.
Thank you. We move on to the next one from Piyush Shukla from NDTV Profit. Piyush?
Good evening. Hope I'm audible. Thank you for taking the question, Vaswani sir. I wanted to understand, towards the start of the conference, you mentioned how you've got on familiar personal reasons you took this decision. I just want to understand, how do things move ahead? You did mention the bank has internal talent and will get the best of the best. But in terms of timelines, what are we looking at? Because we're in July and your term ends in December. So can we expect an announcement in the next month or so? And secondly, I would also want to understand, would you be able to share the amount, the quantum of FCNRB inflows that the bank has got till now, if there is any target on that front? And lastly, on the margins, if you could give some guidance on, because we've seen some moderation in this quarter, both Q on Q, YOY. How do you see the margins going ahead? Any sort of guidance you have on that front?
Yeah, on the management succession, there is a timeline which, frankly, the RBI lays out, and the board and the NRC is very, very confident that they'll meet those deadlines. So there should be no issue on that front. On FCNR, like I said, it's early days. We find it very promising, but we don't share, internal targets. It's not appropriate to do so. But we are quite excited and quite encouraged by the opportunity. And as far as margins are concerned, like I mentioned, margin literally has been pretty flat, 1 basis point up or down for the last 3 quarters. And, honestly, with all of these kind of variables like FCNR, like ECGLS and all of that, giving guidance will not be appropriate.
On ECGLGS, if I can ask you, sir, how many loans have been sanctioned under the scheme or disbursed? And is there any, headline figure that you're looking at to disburse under this particular scheme?
So till as of 30th of June, we have disbursed about 3,000 odd crores. Number of loans I don't recall. It's largely distributed given to our MSME and SME customers. So number of loans would be very large, but in terms of amount, it is about 3,000 crore. And there is no target. We are addressing the requirement of our customers. Whosoever asks for ECLGS facility and they are eligible, we are going ahead and providing it to them.
Thank you, sir. Thank you so much.
Piyush, our next question is from Achishma Iyer from Money Control.
Hello, sir. I hope I'm audible.
Yeah.
Yes.
Sir, just wanted to understand. I just had 2 questions. So now that your unsecured loan book is sort of looking much better what it was a year ago, including MFIs, is the bank looking to target at least a 14 or 15% portfolio share from unsecured loans? And as a result, do you see this as a result of margins increasing again? My second question is about your IT spends. I just wanted to understand how much the bank is looking to invest in tech capabilities in FY27, considering that, the bank has also been talking hugely about infusing AI into your workplace functions. Yes, sir. These are my 2 questions.
Yeah, the first question on unsecured, if you look at it, essentially 4 large products, credit cards, personal loan, unsecured business loans, and microfinance loans. I think we are very happy that we have started growing all of it now. And at a quarter on quarter and year on year, we'll see steady growth. Looking at the cards, business loan, and personal loan, the focus is to do more with our existing customer.
There you go. So that's the word coming in from Kotak Mahindra Bank, and they've talked about everything right from the succession and the change of guard and the timeline that they're expecting on that, the reasons for it, and when it comes to the numbers as well as the growth path going forward as well. But it's time for a very quick break. More news and updates on the other side.
जानते हैं मैं एलीट मैट्रिमोनी क्यों रेकमेंड करता हूं? 17 years of experience, largest database of elite profiles, or 100% confidentiality. Elite Matrimony, India's most successful matchmaking service for the elite.
First of all, my compliments for NDTV to bring back the leadership awards, and in terms of both award categories and nominees, it's a very well defined process they followed, and it was pretty difficult for us as jury members to choose only one awardee among the nominees, and my compliments to the team.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
India Inc.'s most respected names chose India Inc.'s best and brightest.
These kind of awards from the jury lineup, you are truly giving it the right weightage. I think it's heartening to see talent that there is across India Inc. We should be awarding companies and individuals who have focused not only on growth but also on bringing good governance. Be part of jury and vote on the people, the men, the women, the companies in India who have the right stuff is a great opportunity for us. For us, the biggest thing is trust. That's what we provide. We need leaders in India that can help take India being a global superpower.
We got a fantastic jury and we've left all decisions to the wisdom of the jury.
Who will earn India's top business honors? Find out at the NDTV Profit Business Leadership Awards.
The news, Ayush. Since when do we do scripts? Fair point. Picture this. The biggest stage. Floodlights. Wow. 4K. The works. Where's the hook? There's going to be celebrities and guaranteed eyeballs. Where's the hook? Think about this. Front page advertisements and hoardings. Bro, where's the hook? Cross-platform, digital first, virality. Without a hook, no way. The message is clear. It's 2026. You gotta be real in a world of reels. You gotta be original in a world where everything seems generated. That's it. That's what we're looking for. The best campaigns, the hottest trends, the smartest brand moves on our new show. But wait, what do we call it? The hook.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. When the headlines move,
welcome. You're watching NDTV Profit. I'm Mahima Vachrajani, and today we thought of doing something interesting and exciting. We're going to talk about, of course, everybody knows that Odyssey has been released today, and there's a lot of interest coming in for this movie, and we'll try to understand as to what trends are looking like, what are theaters experiencing in terms of bookings, how has the booking flow been like, what is the pipeline going ahead in terms of where Bollywood stands. All of that we're going to talk about in this episode, and to talk about this and take this conversation ahead, we are now joined by Ashish Mishra, who's the head of commercialization at Cinepolis India, joining us now. Ashish, thank you so much for taking out the time. A pleasure speaking with you. I'll start with asking about Odyssey first, because that's where the interest is right now, right? How big is this? I mean, what is your expectations in terms of what box office could this hit, and what does this mean for theaters as a whole?
So of course, this is a big one, right? We're seeing that there's a lot of hype, there's a lot of chatter about this movie, and of course, this is directed by Nolan, right? So he of course comes in with his own, you can say, the things that he has done in the past, the movies that he has directed, and this seems to be just carrying forward that legacy of him. And it's already tracking as a big blockbuster. And these are the kind of movies which basically transcend from just being a movie to becoming something far more cultural. Right. So what we are expecting is that this would be one of the biggest opening weekends for Hollywood in this year. We are expecting it to be opening at about close to about 22 crores.
Okay, all right. And do you think that this is the kind of movie that brings back people to theaters? Because nowadays we've been talking about this as to how
who's with us for opening remarks. We also have with us our Deputy Managing Director, Kaizad Barucha. After the opening remarks, we will straight go to a question and answer session. With that, Sashi, over to you, please.
Thank you, Srini, and thank you all for joining on this Saturday for the Q1 results. I would like to first thank the people, our people and our stakeholders as we navigated over the last few quarters. Our people have kept steadfast focus and on customer needs and further built the franchise. I'm proud of them. A sincere gratitude to the board for their guidance through these quarters, and also to Keki Mistry for standing in as the interim chairman of the board until now. A hearty welcome to our new chairman, Mr. Rajiv Kumar. Looking forward to taking the franchise to the next growth stage. With the appointment of Mr. Rajiv Kumar, there is a sense of stability and clear signal to minimize uncertainties in a very short time period. Coming back to some of the accomplishments, our deposit growth has been relatively higher to historical Q1 trends. We continue to gain market share both on a stock basis and also from an incremental deposit market share basis as well. Our branch productivity continues to be best in class, and over the next 2-3 years, we should sort of realize the benefits of all the investments in distribution we have done over the last 5-6 years. Advances, as we had envisioned, I think we are on the cusp of pressing the pedal. Opportunities do exist, and there is a fair amount of buoyancy in what we are doing at this stage. The environment continues to be very healthy. Liquidity augmentation through FCNR and swap window is an opportunity that we are focusing on. We were in the first month of June and this part of July. I think a large part of our work was towards building necessary product approvals and documentation, both internally and with counterparties as well. I think over the next couple of months, I think we should see the momentum picking up. As you know, the government had flagged off the ECLGS scheme 5.0. And I think that's a great booster for us, and we will be a significant player in the mid-market as well. Competition continues to be very intense, both on the asset and liability side, but we are going to be here as we believe that we are at the cusp of offsetting some of these intense spreads through efficiencies that we will gain through better service turnaround time and also leveraging on technologies. Coming to the efficiencies, I think that is the most exciting part of what we are all endeavoring in terms of driving a certain sense of energy in the organization across length and breadth. Customer service continues to be top focus. It was always there, but now it is on a very heightened basis. Our first focus is to see how we can cut down and and reduce turnaround times on product and service deliveries. We are trying to resequence our technologies to have better adoption of digital journeys. We are embedding AI in our digital journeys to be able to fast track some of these into a virtually frictionless back-end touch. This is going to provide not only a great customer experience, but also sort of translate into efficiencies, which we'll start to see accruing over the next 2 to 3 years. Obviously, security is also one of the top of the charts in terms of focus, not just for us, but I'm sure at the country level and also globally, considering that we have seen a new set of AI-led attacks or potential attacks that may arise. I think we're also bolstering our security systems to be able to defend such AI-led attacks as well. Whilst the environment seems to be reasonably sanguine, we have seen a lot of macro challenges in the recent past, but I think the economy has been rather resilient to be able to withstand those kind of ups and downs in terms of liquidity, in terms of the West Asia conflict, in terms of the currency movements, in terms of the fuel movements. But I think the country has demonstrated, or macro fundamentals has demonstrated the resilience that we are very proud of. And so is in terms of the portfolio quality, not just for us, but also at a banking system level as well. So things remain reasonably healthy at a macro level and at the institution level, and we are at the cusp of having a different kind of energy over the next couple of years. And that's what we are all focusing to the medium and long term. Short term gyrations will be there. It is not something that is our focus area. It's the medium to long term in providing or getting the efficiencies and driving stakeholder returns is what we are all looking forward to. And let me pause out here and we take on any questions from all of you. Thank you.
Thank you, Shashi. Nirav, we can open it up and build the queue for Q&A. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A request to all the participants, kindly limit yourself to 2 questions per participant and rejoin the queue for a follow-up question. First question is from the line of Ritu Singh from CNBC. Please go ahead.
Thank you very much for the opportunity. Mr. Jagadish, I could start with your comment. You're saying you're on the cusp of having a different kind of energy over the next 3 years. Of course, there may be some blips along the way, but 2 of these concerns that have remained with investors since the merger, in terms of synergy play out. 1, margins have not come back to the kind of levels we saw pre-merger, and 2, the loan deposit ratio continues to be very high. Even in this quarter, your margins, if I'm not wrong, are the lowest that the bank has ever reported at 3.26%, and the CD ratio, at as much as 96%. On both of those fronts, I mean, when do you see a turnaround? What's really, continuing to pain the bank? And FCNRB there as well. Since you have this large presence overseas, what kind of target have you set internally for the bank to raise in terms of FCNRB? What kind of leverage are you offering? What kind of, impact could that have on the margins as well as you go ahead and raise these? And finally, Mr. Jagdishan, before, I get back, on the CEO reappointment, we believe the bank was waiting for the new chairman to take over, which has happened. What seems to be causing a delay, and when is this expected to be cleared by the board?
So let me take on the CD ratio. Number 1 is, I think not just, you may have seen the monetary policy in the past. It's very amply clear. The CD ratio is not an indicator that is going to be focused on, at least in the near future. It's going to be the liquidity coverage ratio. So that is exactly what we are also focusing. we are reasonably comfortable from a liquidity coverage ratio, and that's the metric. So CD ratio is not something that we will be focusing for some time. And that's number one. In terms of the margins, you want to...
let me take the margin. See, margin, there are two aspects of margin. One, the current margin that you're talking about, we will urge you not to look at quarterly. We have mentioned that in the past. At the minimum, you should look at annually in terms of margin, because quarter to quarter, there are several customer needs that we will meet. If we start to focus on short term, we will not be able to meet the customer needs and appropriate franchise growth for the medium to long term. So we will not we will urge you not to bother with anything to do with quarter. That's one. Second, you touched upon in terms of longer term, right? Whether the margin post-merger and from then when you will get to pre-merger and so on. So that aspect of it continues to remain an opportunity space that we pursue, both from a cost of funds as well as yield. Cost of funds is the mix of the borrowings and deposits as well as the CASA, depending on how the household savings move. Irrespective of what goes on in household savings, that is the kind of investment we saw through a few years ago and started to expand the distribution. We are in 4,100 towns and cities for a reason that we want to make the unit economics work, because you and I will maintain savings account balances only to certain level. We are not going to have disproportionate level of savings account balances. If we have, we will go and make other investments. And so the way to operate, which we have envisaged and we are executing to, is the unit economics, which means we need more kind of a base. We are a little more than 100 million, 102 million customers, and per branch we keep adding almost. Last quarter was 1.2, 1.3 million liability relationships. We keep plowing this to get that unit economics work. And when we do this, we're cognizant of the cost, because you know that once you play the unit economics, it could result in disproportionate cost increase, which is where we try to keep that lid for efficiency, both branch productivity and people productivity in our side to drive that. So that's from a liability side, from a mix of products on the liability side. On the asset side, the margin lift, the margin opportunity remains to be in the mix of products. Today, we have 52% of our book is retail. Or long term, we have been at a 60%. We envisage to get there because India's GDP composition has got 60% of consumption spending. In order to be moving in tandem with how the economy is moving, we need to be 60%. And that's part of the journey, and it is not something that goes in a hurry, but that's part of our annual plan, and the strategic plan is to get that mix up over time. So these are the two play on the margin.
As Ritu Kaizad here, as regarding your question on the reappointment of the CEO, as you alluded to, the new chairman has just taken over, and which is, as recent as yesterday and today. The GNRC and the board is seized of the matter, and they have been, it's work in process. As soon as they are able to conclude, we will come out and inform all of you people and the exchanges as to the outcome of the exercise.
My questions on FCNRB have not been answered, and Mr. Jagdishan, if you could also add on in terms of loan growth, incremental loan growth, where that's coming from. Of course, we're seeing this, corporates coming back to banks, away from the bond markets. That's a trend we're seeing across banks. But for you in particular, where do you see the opportunity? And FCNRB, what's the target?
Okay, let me answer this FCNRB, and then Kaiza will answer on the loan part of it. Number one is there are three streams of FCNR that we are targeting. Number one, at 6% plus, is extremely attractive even for someone in different parts of the world who are probably getting a 4 to 4.5% as well. So there is, even without leverage, it is a very attractive, and you'll be surprised how small ticket NRI customers are also lining up to this kind of, opportunity. So we are focusing on that. We have raised a substantial amount even in just the last few days. The numbers we don't want to declare at this juncture, but you will see over the next 3 months at the right time when the issue closes. I think we may put it up in the public domain. The number two is on the leverage part of it. There are two types of leverage. Number one is our own leverage, and number two is the leverage that our customers can take from foreign banks in certain jurisdictions. The own leverage is a function of how much we get in as an inflow through our borrowings. And as you know, we have already raised about 750 million, maybe the first to begin with. And we do have plans to raise further borrowings to be able to provide own leverage to our best set of customers. And that is a work in progress. And that is, in terms of leverage, obviously, since the amount is rationed, so we would want to provide, at this juncture, somewhere around 9 times leverage is what we're contemplating. If at all there is a need to step it up, we will re-examine and recalibrate it going forward. As regards the third stream, which is the customers going and taking leverage from our counterparty banks where we have tied up, obviously the leverage ranges between 9, 12, and 15 or 19, depending on the jurisdiction. And this is something that is dependent on the country regulations and also the counterparty banks, the thought processes, etc. Therefore, we had a fair amount of relationship which we are harnessing with counterparty banks to be able to provide this kind of leverage to our customers. And all in all, I think the momentum will start to pick up now. It is just a matter of time. I think we have time till September, and we should be, whilst I'm not going to disclose the number that we are aiming for, but I think it should be a very healthy number vis-a-vis what the system is going to be mobilizing over the next couple of months. Thank you.
Thank you very much. Ritu, may I request to kindly come back for a follow-up question, please? Thank you. Next question is from the line of Hansini from Money Control. Please go ahead.
Hi, good evening. A couple of questions. I'll start with the one on FCNRB. Dubai is turning out to be an important center for the entire Indian banking system. There is a ban on HDFC as far as new bookings are concerned from DIFC. How are you mitigating that aspect? How are the flows from Dubai particularly been? That's one, and I'll come back for my second question, sir.
No, absolutely right. I think we do have a little bit of a handicap there in that particular region. One is the kind of embargo that we are seeing from the UAE regulator. Two is there is a kind of advisory by the Central Bank of UAE on all the rep offices in the region itself. So these are some of the constraints, but we are not sort of necessarily waiting and for that. We have alternate strategies which we are deploying in terms of even sort of reaching out from India, which is allowed as product specialists, and that is what is happening today. And we may have other strategies as well to reach out to some of the customers within the realms of the regulations as well. You're absolutely right in terms of the restrictions and the constraints, but we do have Plan A, Plan B, and Plan C as well.
That's assuring. Now that Bank of Baroda has looked at settlement for one of its old pending litigations, what would HDFC Bank stand on be as far as the 81 issue is concerned? Would you be open to offering the bondholders some settlement? This is more as a continuation of the first question. Let me also put my second question here. Sashi, I'd like to understand from you how has it been between you and Mr. Kumar? I'm presuming this would have been the first board meeting, full-fledged board meeting that he sat through. Did the NRC meet ahead of today to discuss your reappointment? As we're getting closer and closer to October deadline, we're getting a little anxious whether it's going to be you unopposed or would your board recommend you plus as well? Some bit of color on that, Sashi, would be extremely helpful.
I will do the first part, Sashi, in terms of the bonds or whatever, right? First, that's very hypothetical in terms of what is it, claim or settlement or whatever, because there is no established missell or anything of that sort, right? So let's be very clear. And so that question is very hypothetical, and let's not get into conversation of things that are up in the air or just theoretical. With that goes to the
Okay.
question.
On the second question, you spoke about the fact that yesterday and today was the first day of Mr. Kumar chairing meetings and also sort of presiding his first ever board meeting today. I think I talk on behalf of the other board members. I think it was very well received, very refreshing. And he's done a lot of homework, and we're very eager to see a great partnership between the board and the management over the next years. And we are very confident about the next stage of growth. As regards, it'll be unbecoming if I were to talk about myself in terms of whatever the questions that you asked. So it is much better that if I leave that question to Mr. Bharucha.
Shashi, thanks. Himanji, as I already clarified in the response to Ritu earlier, the GNRC and board is completely seized of the matter, and this is work in process. Once we have a decision from them, we will certainly let all stakeholders know of the outcome of that decision. So, is it something that is been worked upon? Answer is yes, and we will come back to you shortly on it.
All I can tell you is that this being the first meeting, obviously, you need to give a little bit of a time. But my hunch and feeling, and I'm sure Kaizad here will also share echo the similar thoughts, that his demeanor and his endeavor is to minimize uncertainties in a very short time period. So that is a signal that came about, and I'm sure, as Kaizad is mentioning, just give it a little bit of time for the NRC and the board to sort of conclude on some of the milestones that they have given themselves for all the necessary actions to be taken in the near future.
Thank you very much, Hamsin. Can I request to please come back for a follow-up question? Thank you. Next question is from the line of Piyush Shukla from NDTV. Please go ahead.
I wanted to ask you, Mr. Bharucha, if you can help me understand, basis your commentary till now, the feeling that we are getting is that the bank is yet to recommend to the RBI for the reappointment of Shashi sir. Is that right, or it already has applied? You're saying the NRC will meet and then decide, but we are in July now and terms end in October. The RBI norms say you should submit before 6 months or so.
Headed, and just one clarification, you had earlier maintained that in FY27 you would grow ahead of the system, but did that change anyhow due to the West Asia war? If you could clarify that. Thank you.
Yeah, so Saloni, I'll first take the second part of your question in terms of the retail growth. If we look at the retail growth on a year-on-year basis, I think, there has been a significant movement in the way we have approached it. To demonstrate in terms of numbers, if we look at first the mortgages book, we have seen a good increase in the book in terms of our annual disbursements. Our disbursements on a year-on-year basis has grown at approximately 14%. If I further drill down into the other core retail books, which is our wheels business, we've seen a very healthy growth out over there, again of about 20% in terms of our annual disbursements. If I further take it to the personal and business loan segment, we've seen a near equivalence of 20-21% in terms of our disbursement growth out over there. We also have, introduced certain new products in our bouquet of retail offerings. This includes, the gold loans as well as the micro loans, which we call as the Dukandar loans. And both of that has also seen very good traction. Though coming off a small base, we have seen, our gold loan book grow at about 35% on a year-on-year basis.
So could you give me the size of the gold loan book?
So we have put it out in the pack. It is roughly as it stands as of 30th June, about a little over 25,000 crores. Okay, so that should give you a quick flavor as to how the whole retail momentum has been growing year on year across a range of our core retail products. And we see that demand continuing, and the momentum is very much there. If you then move to the SME segment, of which business banking is the largest component, you would see that we have grown on a year-on-year basis at over 22% in business banking, and on the whole small and mid-market, we've been at roughly about 18.5% to 19%. This certainly is, continuing on the growth journey that we've had in our MSME business, in as much as, today we are number one in 15 states in MSME, and we are in the top 3 in the 25 states in the country. You would also recognize that the ECLGS 5.0 scheme, which has been launched, with us being a dominant player on the landscape in terms of MSME, we are amongst the largest in terms of our disbursements under the ECLGS scheme, amongst the top 2, at sometimes 1, but it's a dynamic movement until the scheme is available till 30th of September. Or in fact 31st March. So we see that business continuing to grow and perform at the coverage I have mentioned. Then coming to the corporate and other segments, we've also seen a good growth that you would have witnessed in the last quarter, and that continuing in the current quarter as well. The corporate and mid-market segments, along with other wholesale, has grown again at about 18.5%, 19%. So that should give you a good flavor about the growth that we are seeing in the consumption side, representing the retail growth, the mid-market, as well as corporate. So all the 3 segments continue to perform along the expected lines and along the positive path that we see it continuing.
Sir, on corporate, is it capex or general working capital demand, and which are the sectors?
Okay, so it's been a mix of both. So, because markets had been volatile, you had seen some amount of bond demand shift from the bond market to the corporate loan market. So that led to a little more of term coming in. It's also been a good amount of working capital, given commodity prices had been elevated and people needed to draw on their working capital lines.
Alright, then there you go. So that's the commentary coming in from HDFC Bank as well. And you do have the management really flagging out that commentary coming in terms of commodity prices, working capital pressures as well, and largely strong headline numbers that you're looking at. Slight bit of core pressure that really remains, and that's the commentary coming in there. On that note, though, it's time for a very quick break. More news and updates on the other side.
जानते हैं मैं एलीट मैट्रिमोनी क्यों रेकमेंड करता हूं?
17 years of experience, largest database of elite profiles, or 100% confidentiality. Elite Matrimony, India's most successful matchmaking service for the elite.
The entrepreneurship in India is currently defined by innovation, technology, more customer orientation is something what is visible today. And those companies who innovate, collaborate more importantly, are the ones who are going to be more successful in the decade to come. And the formalization also had helped in terms of expanding the entrepreneurship across the geography of the country.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Let's try and understand from the management about a few other things. We've spoken to them earlier about the setup as it stood and the key performance of the margins. But I want to take a follow-up question to Aparna. And Aparna, my direct question is this. I understand you will try to optimize, but do margins stay stable? Do they inch higher? Or do they have a potential of galloping ahead? Because a lot of peers are saying they will gallop ahead for them.
Our endeavor would be to keep improving it, through the quarters. But like I said, it'll be a function of the investments we need to make. These could come also in the way of deals that we are contesting, we are looking at winning. So, it's going to be a function of growth as well.
Okay. Saurabh, can I get you in on manpower requirements? How are you hiring talent right now? And considering that talent has to be less expensive, but if it's AI-enabled talent, it will be more expensive. How do you juxtapose all of these factors and do optimum hiring?
So Neeraj, all the forces are in play. We'll have to make sure that we take care of our existing employees. We'll have to invest. Aparna and Srini spoke about it in future talent. Some of the AI skills are rare, so they are coming at a premium. So all forces are at play. We'll have to invest, grow, and make sure we maintain our margins. I think that's the way we look at it. Our overall headcount and hiring will be linked more to the demand environment, which is right now a bit muted. But I don't see a headcount going up drastically. I see that the gains of productivity, which we were talking about, will have a play as we move forward.
Okay. Srini, the Q2 guidance is muted. What needs to happen for acceleration in H2? Beyond the Olam and the acquisition tailwinds, what are the biggest organic growth drivers that you have which could facilitate growth in FY10? And considering this said that the demand uncertainty is already baked into the current guidance.
Absolutely, Neeraj. We have baked in all those aspects when we give the guidance because we just give a quarterly guidance. Having said that, going back to your question, and if I were to look at the three markets in Americas, I think, we talked about BFSI. We're seeing a good momentum there. Consumer, we have won some deals, and that's another one. Healthcare is somewhere due to the government regulations, especially in the payer and provider segment. We are working with the client to client in terms of the changes that they are going through from their side, which will take a little bit of a time. And if I look at Europe, clearly, the momentum is building up in energy manufacturing resources, which was traditionally very soft sector for us, and we have seen some good deal wins there, and that should reflect in that. BFSI continues to be strong in Europe, and specifically in few countries that like UK and Nordics region. And if I look at APMEA, it's a more secular because it's a much broader market. But having said that, in addition to the Olam deal that this market has won, they're also looking at country to country opportunities around AIDC, opportunities around sovereign AI, and so on and so forth, which is becoming more important for some of these clients in some of these countries as well, Neeraj. So overall, the deal pipeline is healthy, more skewed towards cost takeouts, including vendor consolidation. But there are a lot of deals on the AI side as well, which will be consulting-led and which will be more advisory and leading to data and cyber security and other aspects as well, which continues to create the momentum. Right now, they are much smaller deals, but as the client shifts to at an enterprise level, there will continue to be larger deals as well.
Okay. Srini, you emphasized a consulting-led AI-enabled approach. How much of that FY27 growth in pipeline is coming from AI, Gen AI deals versus traditional services? And any update on this embedded AI engagements as well? Also, maybe just a comment on the token cost versus human cost, and how are you baking that in client conversations?
Sure. So the way I see it, Neeraj, in terms of AI, our approach is AI first. We are pivoted to AI. So you have three types of conversations with our client. One is, I call it as run and operate, right? There, it's a traditional application management, infrastructure management, business process management. Here, every solution that we do is AI first approach. And for that, we have built a platform which is Wings, which gives us agents and agentification of the client's end-to-end process. So to me, you lead in with AI and you give in the productivity benefits for the client, and we bake that into our solution and our cost. The second part, Neeraj, is around software development lifecycle, especially the build AI, which we call it as that, which is also product engineering lifecycle and package implementation. There, I think the disruption is much higher because the productivity benefits that one can get in a software development lifecycle, specifically if it is a greenfield or a program like Python, you get a huge benefits in terms of productivity, right? Having said that, if the code is lot more complex, a lot of modernization that's required, how you deploy and take it to production, the complexity increases. There, the productivity is much lower. So that's how I see, because that's more of a brownfield. There are a lot of legacy applications. You got to be careful in terms of how you deploy. Now, both both the scenarios, Neeraj, it's going to be human plus AI, because human intervention will become very important. I'll tell if you look at software development life cycle, I'll break it into three pieces. The one is testing and coding, which is in the center. A lot of productivity benefits you can get from AI. But if the target environment is legacy, and if deployment and production has to be there, a lot of human intervention one needs to do. Also, business requirement gathering, user stories becomes very critical, because only then you know what is the right tool to deploy. So the productivity and the way we come into picture for our clients is around telling them what's the right tool to use in that aspect. The last part you asked is on tokenization. So what is happening, Neeraj, is that you don't need to deploy a high-end LLM for a simple workflow, because the cost is going to be prohibitively high, but the return on investment for that workflow will be much higher. Second, when you have to get the real return on investment from AI, you got to really reimagine your process, redesign your process. Only then you get the benefit. But if you do a piecemeal approach, you have the AI cost, you get the benefits in that piece, but in net you may not get the overall productivity. However, the token cost is sticking, right? So when do you use a large LLM, and when do you use an open source kind of an LLM? When do you think it better to continue with the human? The balance between the human capital and the token capital will become very intense as we move forward. And that's where companies like us, we have the depth of expertise, we have deep tech knowledge, but we also have the business context, the client context. We are able to stitch that and articulate that to the client in terms of what it should be as part of our advisory and consulting, Neeraj.
Okay. All three of you, thank you so much for joining in today and giving us your thoughts.
जानते हैं मैं एलीट मैट्रिमोनी क्यों रेकमेंड करता हूं? 17 years of experience, largest database of elite profiles, or 100% confidentiality. Elite Matrimony, India's most successful matchmaking service for the elite.
Now SEBI came out with BRSR, Business Responsibility and Sustainability Report. The important thing to notice there is that these are quantifiable numbers which can be compared. So these are comparable, these are quantifiable. So that is the more important thing. So an investor now can know how a company is doing, and he can make comparison between one company and the other, and also over a period of time. So far as the other players are concerned, the proxy advisory firms, they are also helping the investors in evaluating the companies, how they are doing. And in doing this, India has reached at a level today where we can claim that we are one of the best in the world.
India's unshakable news habit. NDTV.com is India's #1 English news website. India Inc.'s most respected names chose India Inc.'s best and brightest.
These kinds of awards and jury lineup, you are truly giving it the right weightage. I think it's heartening to see talent that there is across India Inc. We should be awarding companies and individuals who have focused not only on growth but also on bringing good governance. Be part of jury and vote on the people, the men, the women, the companies in India who have the right stuff is a great opportunity for us. For us, the biggest thing is trust. That's what we provide. We need leaders in India that can help take India being a global superpower.
We got a fantastic jury and we've left all decisions to the wisdom of the jury.
Who will learn in
Welcome back. Thank you so much for staying tuned in. It's time now to put the spotlight on the summation of all of the earnings, the gamut of earnings that we've received when it comes to the banking sector. And when you talk about the banking Q1 performance, largely you are looking at a mixed sort of set right now coming in terms of ICICI Bank leading with that strong growth as well, improving margins and stable asset quality. Kotak Bank, of course, delivering a strong recovery, supported by some of those lower provisions that you're looking at as well in HDFC Bank. That saw the profit growth that really stands out. When you talk about Axis Bank, a little bit of a challenge really coming in terms of the weak margins and CASA pressure, rising asset quality concerns as well, and PNB did continue to improve. Nonetheless, let's also get all of those highlights in greater detail when it comes to all of the banks that I've mentioned, and Piyush and Shivam are joining in with just that.
Yeah, that's right, Shreyansi. In fact, a whole host of banks, 6 odd banks have come out with the results today. We'll start off with HDFC Bank. They've had a decent set of quarter in Q1. The net profit is up 10%, essentially driven by, lower provisions was one of the factors the bank was able to actually post higher profit. The provisions actually fell sharply by around 79% to 3,060 crore rupees in Q1, whereas the net interest income, the difference between interest earned and expended, was up 6% at 33,530 crore rupees. The other income of HDFC Bank, in line with other banks as well, has actually come down by 41% to 12,820 crore rupees. On the NIM side as well, the bank's NIM is down around 12 odd basis point to 3.26%, and going ahead, the management has said that considering the macros at play and market in current way it is, the NIM are likely to improve going ahead. Now, overall, HDFC Bank continues to grow its deposit at a faster pace of credit. Deposits are up 15% year on year, and advances are up 12%. Corporate growth has been, quite good in this quarter. Fresh slippages, however, we are seeing some of the major banks reporting slight uptick in the fresh slippages, especially from the agri portfolio. So, 8,000 crore odd rupees of fresh slippages in current quarter as against 6,200 crore of fresh slippages in the last quarter. But Shivam, you were covering ICICI Bank today. What are the key takeaways from the Q1 results?
So ICICI Bank has posted a strong Q1 results, and starting with the few highlights, the net interest income has grown on the back of a strong credit growth. In terms of the other income, that has also seen a strong growth, and that was due to on the trading income basis. And if talking about the margins has seen a slight improvement. And also, as I said, the treasury gains, that has also seen a turnaround in this quarter and has moved to a positive territory. In terms of asset quality, the asset quality has also remained stable, and ICICI Bank's cost of funds going forward will remain range bound. And in terms of margin, to the management has said that the management is still expecting that the margins will stay in a range bound manner going forward too.
Now, when we come to look at Axis Bank, Shivam, the bank's net profit has risen handsomely around 26% I believe. But one major thing that we observed was that the provisions were also very low, 2,200 odd crore some provision as against, almost 4,000 crore of provision that the bank made last year. Overall, the Q1 results were in line with the estimates. The bank saw modest growth in its net interest income. The operating profit was mostly flat, and the trading income for almost all the banks this quarter has been lower. So it has affected a bit of profitability for all the banks. On the margin front, margin has continued to decline for the 5th straight quarter for Axis Bank, and the bank expects some recovery going ahead on the margin front at least. The asset quality, has declined. If we see YOY, the slippages are lower, but compared to last quarter, Axis reported higher slippages in Q1. And finally, the CASA, the perennial problem with some of the Indian banks continues. Axis Bank's CASA levels are going lower, and credit costs is sustained. It's mostly stable and expected to remain low at least for the coming quarter, is what the management commentary said. Shivam, back to you. PNB early today, how do you see the results?
The numbers were in line with the expectations, and if we talk about the net interest income, that has at least given a modest growth in Q1. And in terms of loan growth, that was mainly led by the RAM segment, and we have seen a substantial improvement in retail and MSME segments too. In terms of margin, it was led by mainly the better funding cost, and cost of funds and deposits have also improved on a quarter-on-quarter basis. In terms of operational efficiency, that too has improved, and we have also seen a strong decline in operational expenses, which has led to this operating efficiency. In terms of growth in PAT, that was mainly supported by the lower provisions, as you said earlier, and asset quality has also improved, as there has been a decline in slippages by 26 basis points. Apart from that, the management has also said that they are targeting a $2.5 billion FCNR deposit till September 30th of 2026.
That is good. I mean, Shivam, I think private banks are a bit conservative in terms of sharing these FCNRB deposit mobilization figures. PSU banks, put out the targets. They don't think that it's an internal one. At least that is the term that some of the private banks say, that this is an internal thing we can't really share with you. But moving on to Kotak Mahindra Bank, strong set of results, Shivam. The PAT is up 26%, led by, stable growth in both core income, net interest income, and other income as well. The net interest income grew by around 9% YOY to 7,928 crore rupees. The other income, on other hand, also rose by around 8% year on year to 3,383 crore rupees, 38 crore rupees. Provisions helped Kotak Bank's bottom line this quarter. Provisions were down 45% YOY to 668 crore in the reporting quarter, whereas the deposit growth remains strong around 14%. CASA continues to go lower, and the advances were up 15%. Again, the bank saw handsome growth in corporate loans. Now, fresh slippages, this is a good sign for Kotak. Both on YOY and Q on Q terms, the fresh slippages have come down to 1321 crore from 1812 crore, last year, similar quarter. So very interesting set of results, and it was a very heavy day for both of us today. Back to you, Shreyansi.
No, absolutely, and heavy day for me as well, Piyush. Thank you so much for joining in with that update also coming in terms of the summation as well. But let's also put all of this into context. In terms of the banking Q1 earnings, it's really highlighted a very clear divide coming in between growth leaders and banks also facing some of that margin pressure. You do have ICICI Bank that led with strong growth also coming in, stable asset quality. Kotak saw sharp recovery coming in. HDFC faced that margin pressure really coming through, and PNB continued improving. And Axis, of course, remained challenged with that margins and asset quality front as well, really being in focus. So key focus areas, margins, deposits, as well as credit costs. Let's also take the conversation forward and get you some more important insights. In fact, Parag Thakur, Head Fund Manager, Fort Capital, joins us on the show right now. Thank you so much for taking time out and joining us. It is a very interesting day, and I'm sure that you've been glued to your screen as well, trying to pass through all of those numbers, and quite a lot of numbers to look at. Parag, first things first, just wanted to get your first cut in terms of what's the summation of earnings as well. Where are you seeing pressure, and where do you think on Monday markets are going to be looking at things quite a little bit positively?
Yeah, thanks a lot. So I would say that when this result season started and business update started, luckily I said that ICICI Bank will be a complete outperformer in terms of when you compare it with all other banks, and they proved it, right? And so all kudos goes to, and all my great regards goes to Bakshiji and the entire team. I would like to wish them through your media that they have done a phenomenal job, quarter after quarter, I would say. So this year also, if you see, the most important thing which Mr. Bakshiji refers to, and which is very critical, it is PBT before X of treasury and X of dividend income. That has grown at 18.5% YOY for ICICI Bank. NII growth was 12.7%, right? So loan book growth was 20%. NIM actually improved quarter on quarter by 4 bips when other banks actually struggled. And in some of the banks, we saw double-digit NIM decline QOQ, right? So asset quality was stable. So nothing to complain about. Clear winner is ICICI Bank. You can say that stock has rallied from 1,225 to 1,440. And so there'll be some sellers always on Monday or Tuesday. They'll be doing profit booking who are traders. But from structural point of view, if you ask me, if you want to play India story, there is no other stock like ICICI Bank in the banking pack at least, and overall also, because it compounds your earnings at 18-19%. P multiple is just 12-13x. ROA is 2.49, by the way, 2.49% ROA. And if you exclude the subsidiary value, it is still available at 2 times book. So I would say that thumbs up to ICICI Bank. Of course, in the mid and small cap banks, we saw Federal Bank reported good numbers, but now the price has moved up too much for that. And in PSU banks, we saw Indian Bank reporting good numbers. So I would say ICICI Bank in large cap private sector banks, Indian Bank in PSU bank, and Federal Bank in small cap banks, they have led the pack this quarter.
And Parag, you called it just about right? In terms of just, sort of penciling in what the numbers are possibly going to be looking like when it comes to something like an ICICI Bank. It was one of the few banks to see margin improvement also coming in. At the same time, when you talk about some of its peers as well, HDFC Bank, Axis Bank, faced that NIM pressure that was slightly reflecting through. So what is driving this sort of divergence in your view? And you've, of course, outlined that as well. But which are the banks that are positioned for some of that margin recovery? Anything that you're penciling in on the margin recovery front then going forward?
See, one thing was very clear. The cost of fund was going up. When you see the banks were raising deposits in the month of May at the rate at which they were raising deposits in the month of March, right? Generally, that is not the case. Generally, in May, the deposit rates go down. This time, deposit rates were up. So it was very clear that there was likely to be a margin pressure this time. Going ahead, definitely we'll have to check with the banks and we'll have to go through their earning calls. Axis Bank call is just going to start. And where I would like to definitely hear from them that whether the margins have bottomed out for them. Kotak at 4.53% was decent. Kotak, the other good things about Kotak was, one, credit cost improved significantly, and second, OPEX as a percentage of assets, cost to assets also improved significantly, which they are trying hard to do, and the valuations are very, very attractive. So one thing which I would like to ask, of course, HDFC call has already happened. I think from here on, HDFC Bank margins should improve logically, and Axis, let's see what they tell on the call. Definitely, they should signal at margin bottoming out, because remember, Axis Bank's guidance is that through the cycle, they want to maintain 3.8% NIM. Now, this quarter, they are at 3.46. So it is a long way to go. Unless RBI starts increasing repo rate and so that variable loan rates go up and so their margins recover. Otherwise, it looks difficult, but let's hear from them in the earning call.
No, absolutely. And, we'll very quickly just go across and listen into that bit of commentary that you've also mentioned in terms of Axis Bank as well, and them responding to our question wherein we asked them on the gross slippages increasing during the quarter and a breakdown of the segments contributing to the increase. And we'll come back to you with some of those questions as well. Lots of insights that still remain, Parag.
I think you're referencing Q1 versus Q4. There is seasonality for the agri portfolio in Q1 that doesn't exist in Q4. If you look at Q1 last year to Q1 this year, our performance on slippages has been significantly better than where we were. Our gross slippage ratio stands at 1.79% in the current quarter, and it's lower by 134 basis points compared to same period last year. So Q1 and Q1 are apples to apples comparison, and we have improved asset quality meaningfully from that period.
Hi, Parag, Piyush here. I just wanted to get your sense on HDFC, taking you back to the HDFC counter. Today, the management did allude to the fact that the margins will likely improve going ahead. But I wanted to understand from you, will the markets, read into this? The bank has not really announced anything with regard to the reappointment of their CEO or on, new CEO appointment. Will this be a hang for HDFC Bank on Monday? And I have few queries on their financials as well, because the margin for HDFC Bank has gone down by 12 basis points quarter on quarter, and it is at a record low of 3.26%. How do you see these two factors, playing out on Monday?
See, I'll tell you, HDFC Bank, I have a huge respect for the management and the entire business. The point is that you have to, when one buys HDFC Bank, what is one buying? It is a huge proxy to Indian economy. They are careful and prudent lenders. They have a very strong deposit franchise, right? And these problems regarding margins and all these problems are because of various factors, external factors. Some of them are internal also, like merger. So I would say that logically, if I go by what they are saying, and the margins, this should be the bottom of the margins, and hence any negative reaction on Monday because of the 12 waves QOQ margin decline should be used as a buying opportunity from long-term perspective. I'm not recommending anything from short-term perspective here. The reason, as I said, like ICICI Bank, my target is say 1750. According to me, the intrinsic value is 1750, which is simple. 600 rupees is a book value for FY28. Yeah, their ROI is 2.49. So you give them 2.5x. So 1500 rupees of core bank value, plus you have 250 rupees subsidiary value. But the point is that market is market, right? So market, everybody makes profit and they book profits also. So I'm saying that Monday, what can happen, I cannot say. From medium to long-term perspective, if HDFC Bank corrects by 2-3% on Monday because of this NIM decline, which was not expected, 12 bips was a little bit too high. If it corrects by 2-3%, definitely one can invest from a long-term perspective. But it has to be really a medium to long-term perspective, not very short-term perspective. And regarding management changes and CEOs, so board recommending to RBI about Mr. Shashi Jagdishan's extension, I would not like to comment. It is up to board. But I would say that from governance perspective, I feel HDFC Bank is absolutely clean.
Right. The other thing that I wanted to ask you, because so many results have come out today, we have seen across some banks, there has been an inching up of slippages, fresh slippages in this quarter, especially HDFC, for example, has seen fresh slippages rise to 80 billion or 8,000 odd crore from 62 odd billion last quarter. We did see Axis also on a Q-on-Q basis, there was some rise. Is this like Q1 has this seasonality sort of impact because of agri loans? Is this that effect, or there are like we saw adverse cycle in the unsecured credit? Is that the case here? How do you read into this?
No, it is purely seasonal. In Q1 and Q3, you see this, right? In every financial company, you will see this. Because there will be rural agri-related slippages in Q1 and Q3. So whoever has a agricultural-related, rural-related portfolio, and definitely every large bank will have, we'll see some more slippages in Q1 and Q3. It's a seasonal phenomenon.
Parag bhai, one important thing, I mean, this debate has been going on for so long that CASA, banks are not able to gain CASA. Across banks, whether it is the large size ones, small size or mid size, the CASA continues to fall. Bankers are also now looking at, FCNRB deposits in a big manner. Do you feel that in just HDFC Bank's media call, the CEO said how the CD ratio is no longer important. There are LCR, there is NSFR, there are other liquidity metrics that are going to be playing an important role. Do you feel CASA banks will continue losing CASA and what other sources will they tap then to raise liabilities and subsequently fund its loan growth?
No, so basically, see, CASA is a universal product. It is going to continue for sure, because all the investors who are depositing money in current account or saving account have options to gain higher interest rates, right? By just converting them in that saving money into term deposits or sweep in deposits, right? So I would say that CASA is on a structural decline in my view. It might rise at some point, but I would say that one should not bank upon too much on CASA. As a lever for margin expansion. I know that, for example, Kotak kind of bank is saying that CASA is one of the levers. We'll have to see how it figures out. I'm a shareholder of Kotak Bank in my PMS portfolio, so I would wish that that happens. But I feel that's a wishful thinking. CASA growth is very difficult now from here on. It is about, how you balance your portfolio. And definitely, once again, I'll tell you, ICICI Bank is doing it so brilliantly, right? So brilliantly. Like in this quarter, to expand your NIM by 4 bips QOQ, and to show such a high good 12.7% NII growth YOY. I think it is amazing. One has to learn from ICICI. Nothing else. CASA is not going to show significant improvement in my view.
Absolutely, and one more that really gives out some more earnings as well for some of its peers as well. Let's also talk about this one in terms of the asset quality trends that are diverging. You do, of course, have ICICI and Kotak that remain largely stable. HDFC Bank and Axis Bank seeing some of those higher slippages like we've talked about earlier, right? So is this, in your opinion, a little bit of a temporary movement that you're looking at, or which are the banks that really stand out to you in terms of this really indicating a trend going forward? Do you think that this could be a blip coming in for some of the banks where you have seen some of those higher slippages?
No, as I said, this slippage, I will not look too much into it because Q1 and Q3 are agri slippages and HDFC Axis both might have seen that only. Of course, ICICI and Kotak has done brilliantly in this quarter also. But I would say that it is something which is seasonal. I would not read too much into it. See, I'll tell you, the asset quality problem right now is no longer there in at least the large cap banks. It might come if this West Asia war conflict lasts longer, if there is energy shortage in the country, or if crude oil spikes up above 100 again and stays there. That is where you have to start worrying about asset quality. Otherwise, up till now, see, during COVID also, for example, government gave that guarantee scheme, right? Where banks lended to SMEs 20% more than their working capital requirement, and it was guaranteed by government. At that time also, the slippages were very, very minimal. They were just 3% NPAs. While actually banks anticipated that they'll have to write off 30% and then they'll have to recover that from government. So even when everything was stopped, there was a lockdown, the NPAs did not spike up too much. So if energy prices go up, I don't think Indian SMEs will just, default. For them to default, it should be energy shortage, that they are not getting gas, they are now not getting oil, they are not getting power. And that situation lasts longer. And in that case also, government has come out with the guarantee scheme for 2.55 lakh crores. Right? So I would say that asset quality issues right now not there. It might come up, but if this West Asia war conflict lasts long, and if there is significant energy shortage, then only I anticipate asset quality issues to start.
And that's in line with some of the commentary that we've heard from the management as well. Let's also quickly recap the commentary coming in from Kotak Bank. That's one counter that's going to be standing out in Monday's trading session as well. Let's go across and listen into what the management had to say.
Vaswani sir, I wanted to understand, towards the start of the conference, you mentioned how you've got a on familiar personal reasons you took this decision. I just want to understand how do things move ahead. You did mention the bank has internal talent and will get the best of the best. But in terms of timelines, what are we looking at? Because we're in July and your term ends in December. So can we expect an announcement in the next month or so? And secondly, I would also want to understand, would you be able to share the amount, the quantum of FCNRB inflows that the bank has got till now, if there is any target on that front? And lastly, on the margins, if you could give some guidance on, because we've seen some moderation in this quarter, both Q on Q, YOY. How do you see the margins going ahead? Any sort of guidance you have on that front?
Yeah, on the management succession, there is a timeline which frankly the RBI lays out, and the board and the NRC is very, very confident that they'll meet those deadlines. So there should be no issue on that front. On FCNR, like I said, it's early days. We find it very promising, but we don't share, internal targets. It's not appropriate to do so. But we are quite excited and quite encouraged by the opportunity. And as far as margins are concerned, like I mentioned, margin literally has been pretty flat, 1 basis point up or down for the last 3 quarters. And, honestly, with all of these kind of variables like FCNR, like ECGLS and all of that, giving guidance will not be appropriate.
On ECGLGS, if I can ask you, sir, how many loans have been sanctioned under the scheme or disbursed? And is there any, headline figure that you're looking at to disburse under this particular scheme?
So till as of 30th of June, we have disbursed about 3,000 odd crores. Number of loans I don't recall. It's largely distributed given to our MSME and SME customers. So number of loans would be very large, but in terms of amount, it is about 3,000 crore. And there is no target. We are addressing the requirement of our customers. Whosoever asks for ECLGS facility and they are eligible, we are going ahead and providing it to them.
Right. Parag sir, moving back to you, we have discussed about growth, about margins. We have discussed about FCNR. One, interesting segment or one interesting trend that I saw in this earnings season is that banks have started reporting very handsome growth in their corporate loan book. The metals, Yes Bank CEO saying metals, oil sector is showing higher appetite. Exactly, because the sense was that corporates had moved to the debt market to raise funds instead of banks. So how are they coming up? Are banks giving them, is there a very good sort of rates that they are offering? And how do you see, will this corporate credit growth trend continue? Will this trajectory, will banks be able to continue reporting in double digit the growth in corporate loan segment?
So it is, corporates want cheaper loans, right? So it is very simple. When the bond market rates, debt market rates went up and the gap between bank borrowing and debt borrowing reduced, they were shifted to banks, right? So if that phenomena continues, the corporate credit growth will continue to look good. Of course, and one has to also have a view that this year was actually disrupted by tariff tantrum and then this West Asia war conflict. So the annual spirits of India's private sector has taken a backseat for a while. Now, if this comes back, and hopefully if this West Asia war conflict ends, say within 1 month or so, and then you have an excellent combination in India where corporates are under-leveraged and banking balance sheets are absolutely strong. You might have seen Kotak Mahindra Bank's Tier 1 is about 22%, right? Now, which bank in the world has such a high capital base? 22% Tier 1 is just too much. They are sitting on a lot of capital. So they have a huge room to grow, right? If the private sector capex picks up. So I would say that from near-term perspective, till this gap remains narrow between the debt market borrowing and borrowing from banks, banks will continue to see good corporate credit growth.
And thank you so much for taking time out and joining us this evening to decode all of those numbers. Quite a lot of numbers to really pass through as well. And that's the entire trend that is clearly emerging, Piyush, when it comes to some of those banks as well that are very much in focus. It's a very, very heavy day that we had coming in terms of some of those banking earnings. Quite a big fraction of the Nifty Bank, a lot of constituents that reported numbers in terms of weightage especially. Yeah. And quite a lot of interesting, takeaways to take away from in today's session as well, in today's show as well, to take to Monday's session, but that's all the time that we have on the show. Thank you so much for tuning in.
जानते हैं मैं एलीट मैट्रिमोनी क्यों रेकमेंड करता हूं? 17 years of experience, largest database of elite profiles, or 100% confidentiality. Elite Matrimony, India's most successful matchmaking service for the elite.
The stakeholders are becoming more important than just the shareholders or the majority shareholders. So things have changed over the last 3 decades. In that background, corporates in India who are more focused on stakeholders, who are more focused on sustainable business growth, that has been the focus of the jury. We are looking at people or organizations where the focus is on long-term sustainable growth rather than doing something by cutting the corners and making a one-off improvement and one-off wealth creation. The jury realizes that wealth creation is important. These are people who are creating wealth not only for their company but for the nation. But it has to be in a sustainable way, in a long-term way, without harming the environment and the climate.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business.
Hello and welcome to The Big Question. I'm Vikram Oza. After years of those negotiations that have taken place, the India-UK trade deal finally going live. Today, the 15th of July 2026, it has come to life. So, it is being billed as one of India's most ambitious trade agreements with a developed economy. And here is the big headline. 99% of Indian exports to the UK will now get duty-free access. 99%. That means a potential boost for Indian textiles, for apparel, for engineering as well, for marine products. Yes, footwear, also gems and jewelry. All of these get an impetus. The Indian government believes that this deal can help take bilateral trade between the two countries to $120 billion by the year 2030. But trade deals are all about give and take, aren't they? India has agreed to gradually cut tariffs on British products like Scotch whisky, like gin, also premium cars. So will consumers get cheaper imports here in India? Or will domestic industry face stiffer competition? Has India opened its market just enough to win big on exports while India protects those sensitive sectors like agriculture, like dairy? These are the sensitive sectors. The question also is, has Britain secured the bigger long-term prize, which is greater access to one of the world's fastest growing major economies? It's a big, real win as far as UK is concerned when you consider the size of the Indian market. And then there is the bigger question, can this deal create jobs? Can it attract investments? Can it strengthen India's manufacturing ambitions and make India a stronger alternative to China in the global supply chains? Or will the non-tariff barriers, the compliance costs, the future carbon taxes, will these factors blunt the gains? Which is why tonight we're asking this question. Even as we see the trade deal between United Kingdom and India come alive today, now the bigger question is, who is the bigger winner? And that's why we're asking our panel tonight. Let's take it across to them and let me introduce you to our panel this evening. We have Lord Karan Villamoria joining us. He is the chair of the International Chamber of Commerce UK, also a member of the House of Lords. and he is co-chair of the India All-Party Parliamentary Group in the UK Parliament. And of course, we'll have him join us in just a few seconds. With him, of course, is Vijay Kalantri, President of the All India Association of Industries and Chairman of the World Trade Center here in Mumbai. Saurabh Sanyal also with us, Secretary General at industry body ASSOCHAM. Gulzar Didwania is partner at Deloitte India. He joins us on the panel along with Mr. R.K. Vij, President at the Textile Association of India. Gentlemen, so glad you could join us on the big question. It's a momentous occasion now that we're seeing this entire deal come alive. Lord Bilimoria, let me come to you first since you're with us. Both governments are calling this a landmark victory. India gets duty-free access for 99% of our exports, and the UK gets unprecedented access to a $4 trillion economy. If you look at the deal in totality, who has negotiated the better deal? What would you say?
This is the biggest free trade agreement that the UK has conducted on its own since leaving the European Union. We have struck free trade agreements with Australia, with New Zealand, and now, apart from the 66 free trade agreements we rolled over from the European Union, which we now have in our own right, this is the big deal. And we started negotiating this deal in January 2022 when I was president of the Confederation of British Industry. It took 3.5 years for it to be concluded last summer, exactly a year ago in July, when Prime Minister Narendra Modi came over to the UK, to the UK Prime Minister's country residence, Chequers, and I flew across, I was abroad at the time, to be present for the signing of this agreement after 3.5 years of negotiation in my current role as chair of the International Chamber of Commerce in the UK. So this is really, really good news, but we've got to keep this in context. It's not about who's done better or who's got it. This is a deal that is beneficial to both countries. And we put this into perspective. At the moment, the trade between the UK and India in goods and services bilaterally is just under 50 billion pounds, 50 billion pounds. And India is only the 11th largest trading partner of the UK. How can India, the fastest growing major economy in the world, with the UK and India being the 5th and 6th largest economies in the world, have India as only the 11th largest trading partner? It should be one of the handful of largest trading partners of the United Kingdom. And I believe as a result of this free trade agreement, this comprehensive economic and trade agreement, trade between our two countries by 2030, within 5 years, will double to 100 billion pounds. That is the effect that this deal will have. And on top of the trade doubling, you will have an increase in investment bilaterally between both companies. You've got to remember, the firm Grant Thornton provides a tracker report of Indian companies investing in the UK and UK companies investing in India. And you can see year by year the growth in number of companies, the growth in investment, the growth in number of jobs created as a result of the investment in each other's countries that the bilateral investment is creating. And on top of that, you have the educational links with Indian students making up the largest international students to UK universities, which are the best in the world, along with the United States of America. And on top of that, you have mobility of professionals, increasingly so with Indian services being provided in the UK, and UK services, and UK is the second biggest services exporter in the world, provided to India, to the benefit of both countries. So, and on top of that, you have the Indian diaspora, of which I'm a proud member, nearly 2 million strong out of 70 million people in the UK, the most successful, and I say this with pride, ethnic minority community in the UK by far, reaching the very top in politics and business in every area.
So, Lord Bilimoria, when you say that 11th largest partner, trading partner for the United Kingdom, how quickly that changes with this trade agreement remains to be seen. But as a proud diaspora of India, right now, when we see the Indian industry perspective as well, and perhaps I can go across to Saurabh Sanyal for this, Mr. Sanyal, you think this is the first trade agreement in years where India is genuinely playing to its strengths? We are opening our markets for exports while we are protecting our sensitive sectors back home?
Thank you so much for inviting me. I think the time has come for a fresh momentum and commencing a new chapter in India-UK bilateral relations with the free trade agreement coming into effect today, that is the 15th of July 2026. It is in fact a historical and a momentous day for both the major economies. where both the GDPs are more than USD 4 trillion, and they have struck a chord for a broader horizon where India is aiming to be a developed economy by 2047, while the UK is looking positively for greater trade, lower tariffs, and strategic partnerships with India. Now, just to talk about the major things that are going to happen, as Lord Billimuria has already pointed out, that from the US dollars 58 billion in 2025-26, we will be going by 2030, our trade will increase to USD 120 billion, 100 to 120 US dollars. And this is ushering in a new era of economic cooperation between India and the UK. The 99% market access has been provided by India to UK. And similarly, 89.5% market has been provided to UK by India. So this itself goes to prove that both the trading partners are going to be in a win-win situation, and by 2030 we are going to increase our trade to $120 billion.
So $120 billion, if that is the kind of target that we are working towards, what about textiles and apparel? Those tariffs in the UK have fallen now, Mr. Vij. From 12%, they've fallen to 0 now. For a sector that employs millions of Indians, how does this deal help?
Thank you very much. I am first congratulate to the Piyush Goyalji, the Commerce Minister. From the last 3-4 years, they are working on the FTAs, and thank for our Honorable Prime Minister making the open economy. So I am just telling you that from now, as on today, the total market of UK market is around 21 to 22 billion. They export apparel and garment. Out of that, approximately 1.3 billion to 1.4 billion comes from India, and they export around 0.4 to 0.5 billion to India. Now, after coming this over the duty tariff was 8% to 12%. Now it becomes 0% on the 99%. Now, example, from a t-shirt, if from India a t-shirt is going at a $10 and there was a 12% of a duty, $1.2 was the duty, so $11.20 was there. Now it will be only $10 will be there. So this will be more benefited, and we hope that in next 3 years, over this 1.3 to 1.4 billion dollar will become touch to 1.9 to 2 billion dollar, and next 5 years it will be doubled. And but now,
yes. But Mr. Vij, I wanted to ask you, this is not about competition alone with local British producers for Indian apparel and textiles, but it's also against countries like China and Bangladesh and Vietnam. So I'm asking you if you think this deal is genuinely going to shift market share towards India.
No, I'm just telling you the major benefit will be there. As on today, we were not able to compete with Bangladesh, Vietnam and China. Now with the coming the duty down, it is a very open space will be there. Now we will be competitive to China, this Bangladesh and India. The major benefit will be there for the Indian industry. The Indian industry, because the man-made fiber will go, garment will go, over Tirupur unit will grow. Tirupur is the t-shirt, Panipat is home textile, Ludhiana is t-shirt fabric, Surat is fabric and garment is there, Coimbatore is the fiber filament is there. So our whole and DTY, FDY unit will have a more export, than the unit will grow, and then main time, it is a very good thing. Or the Bharat Textile Fair has started only yesterday.
It has.
And with this 15th of July, people are coming to take or to see our product. There are a lot of product we will export to UK. This will be create more jobs. This we were hoping from the last 3 years, and this is the one of the
now
biggest.
It's finally happening. Now it's finally happening. On the 15th of July 2026, it's finally coming into motion. But Mr. Didwania, bilateral trade now projected to touch $120 billion by 2030. You think that's realistic, or do you think these projections, which are headline grabbing, do they often underestimate the kind of challenges when it comes to implementation after the signing ceremony is all done?
For asking a very relevant question. So I think we need to actually see what it takes for us to double the bilateral trade between the two countries. Indian exports and UK and India bilateral trade has been growing at a CAGR of around 6% in last 5 to 6 years, right? And therefore today we are at around $60 billion give and take. For us to reach to $120 billion, we at least require to grow this trade by over 15% CAGR year-on-year basis. So that's I would say 2.5%, 2.5 times increase in the bilateral trade. And therefore we first of all need to map it to different sectors, the sector by sector. So for example, we talked about the textile export and textile trade with UK. So we have to go sector by sector. And therefore, every, I would say, sectoral representative trade chambers also need to work with the exporters as well as importers to make sure that how do we double the trade. Otherwise, it's very difficult to reach the ambitious plan of $120 billion. So that's one point I wanted to say.
Yes.
Second, on implementation, the beauty of this trade deal is self-certified origin declaration. So far, whether it is FTA with any other countries that we have right now, for us to get the benefit, whether on import or on export, we need to go to the government department for origin declaration. Now, this is the first time India is implementing self-certified origin declaration in India-UK FTA, and therefore it is a very important step towards trade facilitation. So I'm hoping that this is going to also increase the utilization of the bilateral trade, because currently some reports suggest that the utilization of FTAs by India is nearly roughly around 50 to 60%, whereas in the developed countries like Europe, it is over 90%.
Correct.
And therefore, the utilization itself needs to increase. And the reason for that low utilization could have been the processes around it. And therefore, more awareness with all the trade associations, with exporters and importers, as well as the implementation is the key. So I'm hoping that this is a very, very, very important step.
So yes, absolutely. It's one thing to have a deal, but for businesses to make best utilization, like you say, of the opportunities that the deal presents itself with is going to be an important ask. But Lord Bilimoria, the critics are saying that India gave away too much on the premium imports. The supporters of the deal are saying that Britain gave far more by opening almost its entire market. So when you look at the balance sheet of concessions, who has given more?
You've got to look at these free trade agreements as being facilitators of markets opening up. And the more you open up to each other, the more you facilitate exports, imports, and investments both ways. And this cannot be a question of one country winning and another country losing. Both countries win in their own way from these. As you very correctly said, the UK has reduced duties on almost everything down to zero, 99% of items. India's reduced 90% of items down to zero. Even the high tax items like Scotch whiskey from 150% duty is going to gradually come down to 40%. The cars, 100% duty is going to eventually come down to 10%, albeit on a quota basis. These are huge differences that make items more affordable to the Indian consumer and to the UK consumer, and make exports more competitive for both countries as well. And then you've got to look at the point of, look at the spectrum of this deal. It's a very comprehensive deal. You've got not only tariffs and reduction of trade barriers, but you've got movement of people, the movement of professionals.
You mentioned,
the ability
but on that point,
double pay taxes. But you've got also digital growth. You've got easier access for SMEs, for small and medium-sized enterprises. You've got science and technology.
Sure.
You've got financial and business services. You've got healthcare and life sciences. I mean, this is aerospace, manufacturing. It's absolutely fantastic, the range of areas covered by this deal, which benefits both countries.
But on that point that you were making about the reduction of duties on premium British cars from 110% to 10%, over a decade, of course, this will happen, but also the slashing of whiskey tariffs from 150 to 40% over a period of time. Mr. Didwania, you say this is a sensible trade-off, or do you think it could hurt domestic industry?
No, I think first of all, I don't think it could hurt the domestic industry, because there is a quota. So on the import of the duty reduction benefit that is offered to CBUs, completely built unit cars, it is given based on a quota system, right? So first year, let's say around 20,000 cars, moving to 24,000 a year two, and so on and so forth. So it's a gradual tariff quota based reduction. And again, premium segment cars. It is not going to impact the lower cars, which mostly I would say 95% of the people in India use. So yes, luxury car market. This is definitely even the all the big automakers are eyeing this as an opportunity to enter the premium products into India. And once they test the market, they would start manufacturing them in India. So I would say that the offering of a reduced rate of customs duty on the cars is just it will help open up the market for the luxury car, premium car segment in India. So that's on the car. On the again, the import of the reduction in custom duty on the alcoholic beverages. This is something that India needs to understand, that the benefit is right now offered on very premium brand or very premium and highly priced alcoholic beverages. And therefore, again, the market segment is very, very different, very, very limited. But there are companies who will then also make versus buy decision, that should we set up a facility in India altogether, or versus we continue to supply these from UK. So two different answers on two different sectors.
Yes.
But ultimately, it is the consumer who is going to drive the trend of whether the UK should invest into India, into manufacturing of all these products or not.
But also, when Lord Bilimoria was speaking, he spoke about the labor mobility factor. Could India have secured more on that count? You think this social security relief, should perhaps India have pushed further in easing movement for Indian professionals, you say?
Well, it is one of its kind, right? We don't have similar clauses in any other deals so far, and therefore it is one of its kind. UK also is testing how it is going to take place, and I think it's a very welcome move, because they are trying to avoid the double social security paid in India versus social security paid in US. They're trying to offset the two and make sure that it is not a costlier affair, and therefore it's a first of its kind move. One has to wait and watch how it unfolds, but definitely it is going to improve the mobility.
Saurabh, yes. I wanted to take that across, the point about social security exemption, to Saurabh Sanyal as well. Do you think social security exemption alone is expected to save Indian professionals and companies more than 4,000 crore rupees? Is that a significant breakthrough, you think, or does it fall short of what Indian industry has been seeking?
So it is the preferential access which will improve, as I believe, and the India's competitiveness will strengthen the value chains and generate large-scale employment for the Indian labor force as well as for the MSMEs to do business there. So more importantly, India has secured a protection for a majority of its steel exports to the UK under the India-UK Free Trade Agreement, and with 85% of outbound shipments remaining outside UK's steel safeguard measures. So therefore, this free tariff access and preferential access of the Indian labor force going to UK will have definitely a great advantage for India.
What about the services? They account for a major part of India's competitive advantage when you consider what we do globally. But has India secured enough for IT, Mr. Didwania? For IT, for consulting, for professional services, or you think this agreement has still tilted towards goods more than services?
See, I think as Lord Bilimoria mentioned, that this is just a mechanism to improve the bilateral trade between the two economies.
Sure.
Right now in UK, UK's FDI into India is just over $24 billion, right? Which is 1% of the total FDIs, outbound FDIs of UK. Now, UK is now looking into GCCs and also IT and ITES and financial services sectors related activities to be done out of India. So this is just a measure of a facilitation, increasing the trade between the two companies, since there are no taxes between the on services, and therefore mainly people talk about the duty, customs duty reduction, etc. on trade of goods. But including services comprehensively, whether it is mobility, whether it is IPR rights, is clearly a sign where it is going to increase the investment investment from UK into India as well as from India into UK. So I think it's a win-win for both the countries.
Vijay Kalantri is also joining us from the All India Association of Industries, the chairman of the World Trade Center in Mumbai. Good to have you as well, Mr. Kalantri. You know, India has kept agriculture and dairy. It has been largely kept outside the agreement, and we've included safeguards in sensitive sectors. So you think the negotiators have successfully protected the vulnerable domestic industries?
Yeah, this was the first thought which came to all of us while negotiating, that dairy products and our agriculture products should be safeguarded. And we should not get the dumping of those material into India at a cheaper rate, which is less than what we have. What happened, you know, earlier imports when we were doing from China and all, because of non-anti-dumping duty, we suffered, and many of the MSME industries closed down. So this is a good deal, well negotiated, and very balanced deal. You will see that the trade and investment will grow 20 to 30% in next 3 to 5 years, because we are not looking at short term, but in long term, we are beneficial in the trade, and we have more opportunities. Then UK could also be used as a hub for European countries and America and other countries for exports. Because once we get the access to UK market, we can supply our goods and raw materials there, and we can pack it there and send it to various other countries. Those opportunities people have not seen, but that will be tremendous opportunity which will come across.
But Mr. Kalantri, a lot of excitement surrounds exports. Could the bigger story actually be investment, which is being spoken about? Will this agreement materially improve investor confidence, bring more British capital into India?
No, UK has been in forefront for financial center. After US, UK is the second financial center. And many of us have seen that the investment, any big deals has happened through UK and in UK. And many of the Indians who are heading many of the funds, so they will look at India very seriously once we have good projects in place. And as you know, as India has been moving forward, ease of doing business, our PLI scheme, various Viksit Bharat, many of these schemes have been well accepted by the investors. And under these schemes, we will see that the investment comes in technology, in AI, in innovation. We will defense, automobile. Today they are talking about exports.
Right.
Tomorrow we will think of setting up factories in India to manufacture, like others have done it.
Right.
BYD, MG, and all have come and they have set up a factory. So now they will also do a factory. So we'll get a lot of jobs for our employment to our workers and all. And many, we will again become a re-exporter to many countries out from here.
You think we will be able to re-export from here? But if I were to give you 6 parameters, and perhaps Lord Willimore, I can come to you first. Exports, jobs, investment, consumer benefit, and strategic influence. If these are the 6 parameters, that if you're looking at this deal 5 years from now, which one of these will determine whether we've had success with the FTA between India and UK?
Well, actually, every single one of them that you can measure. The good thing about what you've just said is you can measure all these things very precisely. I mean, look at the jobs, for example. If you look at the UK companies in India at the moment, there are almost 1,000 UK companies. Grant Thornton, the firm, produces a tracker report both ways. UK investment in India, India investment in the UK. We just look at the UK investments in India at the moment, almost 1,000 companies. These companies are growing at almost 50% a year, and they've created over 500,000 jobs. I mean, this is fantastic. And I think with the CETA, this is only going to grow. And if you look at it the other way around, Indian companies in the UK, there are almost 2,000 Indian companies invested in the UK. They have created over 200,000 jobs. So just the job creation as a result of investment both ways, you're talking in total approaching 1 million jobs, and that's only going to increase. You'll be able to measure exports. You'll be able to measure every one of these aspects.
So you think we'll be able to measure each and every one of these parameters going ahead from here? Since I'm running out of time, Gulzar Didwania, I want one word answer. Today, who emerges the bigger winner from the India-UK trade deal? Is it India? Is it the UK?
I think it's a win-win for both. You are asking at different time, but the answer is the same. It is a win-win for both the countries. Idea is to double the trade between both the economies, and I'm pretty sure the aspirational CAGR of 15% can be achieved if we track each and every metric in a different way, in a minute manner.
Well,
That's
this deal
what I
is
would like to
clearly it's far bigger than cheaper whiskey or luxury cars. That's a given. The real test is now whether India can convert unprecedented market access into exports, into jobs and investment as well. That agreement is done. Now the hard work of execution begins, and it's always about the implementation. My thanks to Lord Bilimoria, Vijay Kalantri, Saurabh Sanyal, Gulzar Tadvania and RK Vij. Thank you very much for joining us with your insights. So, as we've said, trade deals by themselves, they don't deliver the results. What you really need is for businesses to find the opportunities and build on them. And that's what this FTA is all about. Will we be able to do that with the United States, with the European Union? That remains to be seen, but it's work in progress. I'm Vikram Oza with a big question. Thanks for joining us.
जानते हैं मैं एलीट मैट्रिमोनी क्यों रेकमेंड करता हूं? 17 years of experience, largest database of elite profiles, or 100% confidentiality. Elite Matrimony, India's most successful matchmaking service for the elite.
India's unshakable news habit. NDTV.com is India's #1 English news website. India Inc.'s most respected names chose India Inc.'s best and brightest.
I'm delighted to be chairing a committee of such distinguished fellow businessmen, bankers. It's just lovely to be back on this NDTV jury. I have been a fan of NDTV for a long time.
Many of the nominees are extremely close together in terms of what they've done.
I think it's also important that how they are reshaping the industries, commercial activities which they are into. And it's a very judicious mix of people to choose from. My compliments to the team.
Welcome. You're watching the Editor's Cut, and we've already started all of our banter before we've hit roll, but we'd love to include you in it. We have Gautam Trivedi, co-founder and managing partner at NIM Capital, joining the table today. Gautam, welcome. This is going to be exciting. So here's before we get to all of our questions and what you think about the market, just for our viewers, here's what we're going to do. We have 3 propositions that we are presenting. All of us will be presenting, and then we have a debate on it, on what you think one way or the other. But before we go to number 1, the bigger question is how markets have really ended this week and shown a real sense of faith in what India can do, isn't it?
Yeah. No, I agree. I think if you look at from the start of the war, 20th of February, and then up until the 30th of March, if I remember right, where the market actually, the drawdown was about 13.5%. If you look at that drawdown versus previous global accidents, if I can call them that, it's been the best. So in spite of oil, as in Brent doubling, rupee crashing as the way it has, we've come out actually pretty strong, and the market's rebounded about 8 to 9% since, which I think has been a great outcome. Results are starting to come in, which are so far pretty good, including IT, which I'm sure we'll talk about later. But I think I'm pretty impressed with the way the markets handle this. And I think, and we'll get into this in more detail, but I've always sort of said that you've got one side, you've got the economy, the other side, the stock market. And sometimes for a very long period, the two are not connected. This is definitely one of them.
You're saying the economy is not going to do well, but
No.
the markets is doing well?
I think the economy, earnings growth for FY27 started off with about 15-16%, which they always start off high at the beginning of the fiscal year. But because of the war and the absolute impact on raw material costs, and this is across industries, they're now being pruned down to about 10 to 12%. I mean, we're a collateral damage from the war. We've got nothing to do with it, frankly. But it's unfortunate. Otherwise, this could have been a great year for us.
That's true. Let's get started on the first topic, which I think is front and center, right? We've seen the headlines: a guardian of the Strait of Hormuz, a 20% charge to ensure protection. So the question that we're asking is, are Indian markets developing a little bit of a thick skin? Because through the week, you saw a little bit of resilience, didn't you? I think that is in fact the case. And the fulcrum, as we've been saying throughout this conflict, for Indian markets is crude, and crude at 85 is not a bad deal for India.
It is a bad deal for India.
It's not, relatively speaking, right?
No, so this is a continuation of what we were discussing last week, where
I knew she would say this.
Of course, because I said it last week also.
You like to say I told you so.
I'm not saying I told you so,
but Trump is very unpredictable, so we don't know how this particular war will really continue going forward.
But he's predictably unpredictable. I agree with you, but the fact that he's predictably unpredictable, here's the thesis that I want to present. The more you say weird things, the less people take you seriously. And so you look at what happened with that 20% fee that he talked about. First, everyone panicked, and then he came and said, okay, actually, I will not take a fee. I'll make you invest instead, and then became the Gulf states who are investing. And he says, I'm the guardian of the Hormuz. And Iranians say, we've always been the guardians of the Hormuz. It's like a bad superhero movie because no one asked for a guardian. But then if you ask me that question, my contention is we're developing a thicker skin. I'm not saying it can't get worse. It can. Just the tolerance levels have shifted higher.
You reckon?
Yeah, I think so. I think every week we have a new, or almost sometimes many times in a week, we have a new guidance from the White House of where they position. From war, we've gone to ceasefire, back to war, which is obviously very unfortunate. So I think the markets have started to get a little bit tired about it. And they're putting money to work. And as are we from our fund, irrespective of what's happening in the broader spectrum with respect to the war and global impact of that.
Right. So if I can, present one particular aspect, while you stated that the economy and the economic reality is because of this war and the markets are a little decoupled, I would say that the economists had been penciling in $80 per barrel as an average for this particular fiscal year to come to all sorts of macro data. Now, till that is crossed, there won't be a mayhem, and therefore the markets will not react adversely. And the last few weeks where we got the crude oil prices below about $70 per barrel has given us a headroom of this 80 and above up to 90 for a short period of time. In my mind, that is the calculation that is playing on the market's mind.
Yeah, so let me just address the market part, which you said about decoupling. Let's understand who's playing in the market and what's driving the market per se. It's all fund flows. Let's get real. Okay, so FIs since the beginning of last year, since January 2025, have sold almost $50 billion worth of stock in India. All right. Where does India stand today from an overall perspective? I think with relation to Asian peers, it's the worst performance on a relative basis in the last 30 years. Okay, of course, the two outliers there are Korea and Taiwan, so they've completely moved the average up. But the reality is that the domestic flows are just incessant, relentless. Okay, so we saw $88 billion of, I'm dollarizing everything, so we compare it to the FPI flows. $88 billion last year, $51 billion already this year, so far, as of I think yesterday's close. So if you look at the absolute numbers from the domestic side, they don't care. There's a war, there's inflation, crude going to 150. They seem to be just putting money into the market as if everything's hunky-dory. Now, what's causing that? Let's understand that. I've done some deep dive on that. Did you know this, that 5 states in India account for almost 48 to 49% of the 130 million or 13 crore unique investor base? I'm not counting demat accounts, I'm just counting the unique investors. So all 5 of us are unique investors. We may have multiple demat accounts. So I'm not counting those. The top 10 states account for 73% of total number of unique investors. What does that tell you? The equity penetration in this country has not even reached the halfway mark. Okay, and you'd be surprised if I look at the top 5. You'd be surprised with number 5. And I shouldn't say this. It's a BJP ruled state, but I want to say it.
Please say 1, 2, 3, 4, 5.
I'll say 1, 2, 3, 4, 5, and this is on the this data is in the NSE database. Number 1 is Maharashtra. That's not a surprise. Number 2 was Gujarat. Now it's Uttar Pradesh. Number 3 is Gujarat. Number 4 is Rajasthan. Number 5, I've given you a hint, which is it's now a BJP state, West Bengal.
Yeah.
So my point really being, I mean, I'm not talking about West Bengal being number 5 as being important or not important, but the point is there's so much more money still to come.
Sure.
The 3 legs to the stool is the way I see it. FPIs, domestic flows, and the third leg, which is not counted in the domestic flows, are family offices, AIFs like myself, PMS, and investors who go directly into the market via discount brokerages. So that leg and that amount of money, I don't have data on that, how that's doing. But the FPI number, of course, has been usually negative. We just said 50 billion of selling since the start of last year.
Yeah. I personally think that it's a great time for folks like Gautam, simply because the FI selling happening at the large cap end keeps the Nifty subdued. But the bottom-up identification of businesses, I mean, he grounds his shoes to go to the plants, etc., in remote India, which are small caps, and he's able to identify this is a business for the next 10 years, buys into that, and makes money. The FI can't do that. So I think it's a great time for people who are doing bottom-up.
And a lot of these companies are relatively insulated, right? One can argue that, yes, okay, to a certain extent, inputs in a lot of spaces do get affected. But equally, you have a situation where they're strong enough, or the system is strong enough to allow for a significant amount of pass-through as well.
What's the answer to the question? Gautam has answered, we have answered, both of you haven't.
No, Who is both of you?
Alex and Neeraj.
I said at the start, I think that
You
there
agree.
is really...
Gautam focused on the penetration bit, but
Yeah.
I would still say that we still need the FIIs to come back, with rupee again depreciating so sharply in this particular week is a cause of worry. Therefore,
to the specific question about whether we're getting
Developing
more
a thick-
immune,
thick-
developing a thicker skin, you said only till crude is at that average of below 80.
So my view is at 85, we might be looking like that. If crude were to go to 100, if it does, then I think things will change.
Okay.
That's my view.
Okay, let's go to question number 2.
Okay. Question number 2, and it flows in beautifully with the point that Gautam was making, is the Korean market volatility a boon for India? Right? Now, I have some points to present here very, very quickly, right? If you saw 2 things that have happened. One, the 3x leverage SK Hynix ETF is down 90% from its peak just a month ago, 36 to now 4.5, 5, right? The 2x one is down 70%. And after being down 70%, the AUM in it is over $6 billion. This is serious leverage money out there, which is now getting eroded and eroding investor confidence. And 2, volatility itself in the Korean markets. So the KOSPI volatility index or volatility number is some 80, 81.
Had a peak of 98.
98. And the bottom was 28.
Or 23 or something like that.
28. And at least in Jan was 28. And last point here, the 2 stocks, which is SK Hynix and Samsung, at times account for 80% or 85% of the total trading volume in a single day. This is serious concentration. And if this is unraveling, maybe, just maybe, foreign investors might prefer slightly more benign markets like India. Maybe.
Sorry, you want to take that?
No, please make a point.
So, here's the thing. Is there a case for FIs to come back to India, given how much they've been selling? September 2024 was really peak interest in India from FIs, and they've been selling, of course, non-stop, with the exception of the month of February. We saw about 2.4 billion of net buying that came in from FIs. So look at where we were in September 24, which was the peak. Our weightage in the MSCI emerging market index, which is obviously the benchmark for global mutual fund and asset allocators, was as high as 20.8%. We're now down to 11.3, so almost half. Okay, that's 1. 2, foreign ownership of the Indian equity markets, and that mark-to-market number as of last week was $720 billion on a base of a denominator of 5 billion. So that number is now down to about 14.5%. Again, that's a 10-year low. So we've seen a lot of selling that's eroded the FI participation in this market. The hope is it doesn't get any worse than this. And to your point about whether it's Korea or Taiwan or even back in the States with respect to the tech, the dependence on tech for incremental capex, for incremental growth. So for the current quarter, i.e. the second quarter numbers which will come out in the US, for the S&P 500, the growth is supposed to be 22%, as high as 22%. But 60% of that 22% is AI hyperscaler capex and infra. So huge dependence on tech and AI. We don't have that because we don't have tech and AI. We have IT services, which is not strictly tech in that true sense. So yes, there is a case to come back to India, and I hope they're paying attention, listening, watching this show. Please make sure it goes global, and everybody from San Francisco to Hong Kong is watching this.
Very well mentioned, because all the foreign money is right now chasing AI. And today, as we speak, Xi Jinping has made an announcement in the AI conference, and he has said that we'll be the global leaders in artificial intelligence. We will beat the US. So there is this big momentum where India seems to be lagging behind. And also we have our import bill, which is a big worry for the FIIs. So putting both of these factors together, whether we'll benefit from any other emerging market being down, is a serious question.
So you don't agree?
I don't agree.
I second that in that sense, because even with everything that's happened with the cost pay, I think from the start of the year, you're still 60% up on that index.
I think now, well, as of last Friday, it was 108% dollar return. This is in spite of the fact that FIIs out of Korea sold $100 billion worth of stock. So, obviously they were regretting it until last week, but this week's been a completely different story.
So you've not slid back entirely.
No, even 2024 is a banner year for Kospi, right? Per se. So there's no taking away that fact. The question is only this, and I'm just hoping more than an assertion that what could be woes for the AI trade could actually be beneficial for an anti-AI trade like India.
No,
that's my submission.
So the reason I'm making that point is I think the AI trade, people have gotten a little skeptical about it, but they've not gone off it yet.
Hopefully happens
that inverse correlation will take place only if serious investors start saying that, okay, this AI story is looking really flaky. I think we're ways away from that. Unless you have great corporate results which make valuations look more attractive in India, and then that's a different story. You have the SIP investor story that Gautam was talking about. That's still a wall of money that's going to keep valuations elevated. Maybe they'll stop selling as much, but I don't know if it's going to be a Korea versus India binary.
And it's not a binary. It's not a binary. It's just an AI trade versus anti-AI trade. I'm hoping that turns out to be true.
I think our big IPOs will actually attract more, foreign money because it's locked in as anchor book and one company. I think they are doing, and the roadshows are also much more focused. So I think that will attract a lot of money for us. But overall, we'll be more self-sustaining with more domestic participants having much more faith in the Indian thing. And just one more thing, that AI thrust, the use of technology in manufacturing is slowly seeping in. And our big thrust is towards manufacturing. India is good at manufacturing, low-cost manufacturing. If AI technology is utilized there, that can be a tipping point for the next wave of investments to come into India. At least that's what I gather from a lot of investors.
No, so I'll quickly make my point, right? So a lot of the flows that come through, and we've spoken about this in the past, from the outside in, are not active, they're passive. And so therefore, the view from the outside will be generally to look at valuations as a collective and not at individual stocks. And it's not reached the point where vis-a-vis other potential targets for foreign institutional investors, we've come out so substantially that it becomes lucrative enough for foreign institutions to say, I'm going to rebalance right now. Will that happen? I don't know. You could have a time-wise correction from this point. We've seen pretty much that take place for quite a while. What could also take place is an earnings re-rating, and I don't know if that's going to happen very quickly based on what we're seeing, right?
Just said 12%.
So therefore, if anything, I think that might have to be revised downwards if this conflict continues, because you will have certain pockets that will have to take a hammering, which they have not done in the first quarter. EBITDA margins to a certain extent might get scrimped a little bit, though you see the revenue uptick that takes place because consumption has been broadly okay. But in the second quarter, that is not going to happen.
So while we paid so much attention, Neeraj, you have something to wrap this discussion?
Gautam, if you can, 30 seconds. Do you think that's becoming India Inc.'s kind of response that when pushed to the wall, they bring that best foot forward, show margin resilience? It happened in COVID. It's happened in quarter one as well.
It seems to be happening so far. We haven't seen the play out of the results as yet. But I think to the point about the AI trade, we've been playing AI in India through our fund, through power.
Okay.
And that's the only way to do it because there aren't enough data center companies listed as yet. 2-3 years down the line, you'll see more companies getting listed. And, we produce 20% of the world's content, 3%, and we have only 3% of the world's compute power. So that's going to be a massive, and what I've said in the past is the entire ecosystem, the two ecosystems we're looking at right now, we've heavily invested. So power as a percentage of allocation is the highest for us. So we're 21% of our AUMs are in power. So we're taking a big bet. And the second highest is, I think, is definitely financials, which I think is about 16 or 17%. So that's how big. I mean, who would have thought 5 years ago somebody would be putting as much as 21% into a single
But is it generators? Is it transmission companies? Is it equipment manufacturers?
I'm glad you asked that. So within the generation, transmission, and distribution, the weakest link actually is transmission. And component manufacturers within the transmission space. That's the big, big capex that's coming. Again, data center capex. We've got a bunch of small cap names which will become large caps over the next 3 to 5 years.
Right. I'm glad you mentioned about the artificial intelligence because our next question that we are debating is the Indian IT services sector really living up to the AI challenge really coming in? What's your view on that?
I've been asked this question time and again, and we do discuss it every now and then that I won't name the stocks, but the stocks have fallen as much as they have. Well, if I can talk of TCS, great company, ticks all the boxes, no debt, super management. Stocks down 55% since January of last year. The Indian IT index is down 40% in the last 2 years. So is now a good time. And TCS, I can keep going back to that, but TCS is now trading at 13 times FY28 PE. Wow. I mean, it used to be 3 years ago at about 26, 27 times. So it's, halved from there as well. And yes, 55% correction. So math adds up.
Gautam, enriched by the earnings season, and we have pretty much all the companies really doling out the numbers and also putting out good narrative on the artificial intelligence thrust. So how do you now assess after being enriched by the recent announcement? Because in the last quarterly result, they actually got a taste from the market that we need that AI thrust. And this time, a lot of that work is being done by the companies.
So if you look at the narrative that's coming from TCS, they've said their AI transformational work projects have the ARR is $2.6 billion, okay, which is about 8.5% of total revenues. But these are all short-term projects. They're not your traditional long duration projects. So that 3, 4, 6 months, or even 9 months, I think in some cases. So I think it's early days to start re-rating these stocks. Would I buy some of these stocks at this price if I had a large cap fund? The answer is probably yes, because I don't think you can get any worse from here. They're smart people. I mean, TCS, we don't own TCS for the record, just want to make that clear. But the fact is they've, put $7 billion as a commitment to put money in the data center business. That's great news. At least they're pivoting in the right direction, which is where India needs capital. The others haven't really expressed or seen. HCL, I think HCL Tech announced something as well.
But 1,500 crores.
Yes. So, yes, it's a good step. It's not as big as TCS, but the fact is, if they start pivoting in this direction, it's the right place to start going into, given the amount of cash they're sitting on.
Just a quick question on that. So the tendency has been to look at these IT companies and judge them on a quarter-on-quarter basis. And you look very closely at their margins as well. So if they're pivoting from a services business to a data center business, then you're going to have to be okay as an investor to say, the margins are not going to be what we're used to. There's going to be erosion.
That's one company.
I'm saying,
So if you look at the remit of the question, will Indian IT service sector live up to the AI challenge? My two bits would be yes. but would that make them as valuable and as interesting and as important in the Indian ecosystem as they've been? Perhaps not. Remember, everyone was excited about the Indian IT service sector, apart from an investor valuation metric, because these were the companies that flew our flag high. They created those high value jobs. It gave that pride of, India is sort of the data center for the world. All of that will also change. So the way you look at these companies will also change. They'll then be one of many trying to live up in that AI race. Will they fail at it? I don't think so, because I'm a little sentimental also about the ability of some of these companies.
They will live up to that challenge, is what
they will live up to the challenge, but will they then be as valuable as they are now? Because they were earlier able to provide something not everyone was.
Right.
That might change.
Yeah. I think they'll be more valuable than they are now. They may not be as valuable as they were 3 years ago. Because the multiples have to expand from 12 times to...
From years they will recoup, basically.
That's clever answer.
Let me just, before Alex says something, let me add something to what you just said. The fact is, if Indian IT companies figure out a way to get more and more embedded within the AI space, even if it's 10 to 15%, but of revenues, they're not there yet, but I'm saying if they start showing that, and the ability to actually get to a higher number over the next 5 years, these stocks will get significantly re-rated. I can guarantee that. We have a small cap company, I don't want to get into the name, but that's until now it's still making hose pipes. But that hose pipe now has a completely different application, i.e. liquid cooling of the GPUs. The stock has ripped.
Yeah.
Their revenues haven't even started as yet in the data center business, but the market's already foretelling what it's going to be. The management thinks in 3 years' time it'll be 50% of revenues. Okay, 50% is a high bar for some of these companies that have a pretty big base, but I would think there would be a significant re-rating of these stocks by the market if they start demonstrating more penetration in the AI space.
Alex, what's your verdict?
I think that there's going to be a separation of the wheat from the chaff. There's going to be a few winners in this story, and those that are going to get their bets right at this point in the next couple of quarters in terms of mobilization of funds and reorientation are going to win the fight.
There will be a segregation between winners and losers. There will be a change of pecking order, and I would say collaboration with already existing AI capabilities is the way to go. Those who are doing it, like HCL Tech with Sarvam, and there is a buyout happening in several other companies also. If that collaboration happens, because the two scripts are totally different.
Commentary is getting definitively positive on AI, say in the last couple of weeks, than it has been for a while. So that is something to go by. Before we wrap up, very quickly, quick poll. How much will you pay for first access to Trump Media and to Truth Social posts? Because this is the strangest story I have seen all week.
So I will pay whatever it takes so that they don't take away my US visa. Okay, so I'm a big fan of Trump.
That's what we'll end on. We've absolutely run out of time. Thank you so much for joining us on this edition of Editor's Cut. We'll be back same time, same place next week.
जानते हैं मैं एलीट मैट्रिमोनी क्यों रेकमेंड करता हूं? 17 years of experience, largest database of elite profiles, और 100% confidentiality. Elite Matrimony, India's most successful matchmaking service for the elite.
India Inc.'s most respected names chose India Inc.'s best and brightest.
These kinds of awards from the jury lineup, you are truly giving it the right weightage. I think it's heartening to see talent that there is across India Inc. We should be awarding companies and individuals who have focused not only on growth but also on bringing good governance.
Be part of jury and vote on the people, the men, the women, the companies in India who have the right stuff is a great opportunity for us.
For us, the biggest thing is trust. That's what we provide. We need leaders in India that can help take India being a global superpower.
We got a fantastic jury, and we've left all decisions to the wisdom of the jury.
Who will earn India's top business honors? Find out at the NDTV Profit Business Leadership Awards. India's unshakable news habit. NDTV.com is India's #1 English news website.
From a PwC standpoint, we actually set up criterion for each of the categories that we discussed with NDTV. A criterion was set up. Different KPIs were adopted for different categories. These are, of course, discussed, internally. We challenged ourselves, etc., and we made sure that the data sources were all very robust, so that the trust could be built in. So I think that's what defined, and of course, we eventually went through the jury process, and I'm glad the KPIs, if I may call it so, for the winners were ratified by the jury. In some ways, that's a ratification of the choice that we made.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
The news, Ayush. Since when do we do scripts? Fair point. Picture this. The biggest stage. Floodlights. Wow. 4K, the works. Where's the hook? There's going to be celebrities and guaranteed eyeballs. Where's the hook? Think about this. Front page ad.
Across the globe, climate patterns are becoming more extreme. Erratic rainfall, prolonged monsoons, rising temperatures and warmer winters are reshaping ecosystems. And as the planet changes, so do the organisms that thrive in it. Viruses, bacteria, fungi and disease-carrying vectors are adapting, expanding their reach and altering long-established disease patterns. Diseases that were once seasonal are becoming less predictable. Outbreaks are lasting longer, appearing in new regions and recurring more frequently. From dengue to influenza, the rules are changing. Climate change is no longer just an environmental crisis. It's a growing public health emergency. The question is, are we prepared? The impact is already visible. Dengue, once largely associated with the monsoon season, is now being reported across longer periods of the year and in more regions than before. Globally, dengue cases have surged to record levels, with more than 14 million cases reported in 2024 alone. In India too, the rise has been dramatic, from around 28,000 reported cases in 2010 to nearly 2,89,000 in 2023. And dengue is not the only concern. Influenza viruses continue to evolve while changing weather patterns are influencing when and how respiratory infections spread. Today we look at what climate change means
for infectious diseases. Why dengue and influenza are becoming harder to predict, and what our doc on call suggests India must do to prepare for this new normal. With the monsoon now underway, health experts are on alert, warning of a potential surge in dengue cases. The disease map is shifting. From Kerala's extended rains and record spikes in Maharashtra to early cases in Delhi NCR and infections emerging in hill states, dengue is reaching new geographies. And it's not just dengue. Changing climate patterns are also disrupting flu seasons, leading to more unpredictable and sometimes intense outbreaks. Now the bottom line is that diseases are spreading further, lasting longer and appearing in places where they were rarely seen before. Now what's driving this surge? Rising temperatures are helping mosquitoes breathe faster, live longer and spread the virus more efficiently. Erratic rainfall and prolonged monsoons are creating more stagnant water, the ideal breeding ground for dengue-carrying mosquitoes. The Aedes mosquito is adapting, thriving in both urban and rural areas, breeding in tiny water collections and biting during the day. Dengue is expanding its footprint, with cases now appearing in regions that were once considered low risk. We have with us Dr. Sabine Kapasi, Global Strategy Advisor, UNDAC, UNDRR Emergency Response, also CEO and MD NERA Consulting and co-founder Ropan Integrated Care Private Limited. Thank you so much for joining us today.
Thanks a lot, Amrita, for having me.
Dr. Kapasi, what was earlier a seasonal issue, right? It was a phenomenon we used to see once in a while. The phenomena is now become like it's something which we can't predict. In your view, when we talk about in your clinical practice, do you see a shift on seasonal diseases change? That pattern, is that changing?
The easy answer is yes. Climate change is affecting disease patterns and drastically so. So not only have the occurrences changed, but the way diseases are presenting themselves have also fundamentally shifted. So, for example, now flu looks far more different than it used to 10 years ago or 20 years ago. Dengue is far more dangerous and far more, unfortunately, lethal than it used to be. So is malaria and so is cholera. A lot of these are either vector-borne or diseases which are impacted heavily by climate change and are infectious in nature. Similarly, the patterns of their occurrences have also changed. Earlier, we used to have seasonal patterns which were predictable, and hence preparedness for that was easier to be done by administration and people also. Today, those patterns have been disrupted. We see bursts of these diseases occur in different geographies where they never occurred earlier, and we see that happening far more erratically and far more outside of their normal schedule and normal routine. So unfortunately, we need to be far more cautious and far more vigilant today, and the preparedness needs to be far more perennial than year-round.
I mean, now that you've confirmed that yes, we are seeing a shift. Of course, we see the numbers of going up. Like, let's take dengue for example. You know, earlier it was few thousands, and now cases are in lakhs, right? We also see the impact is more across, like you said, different geographies, different time periods, different patterns. How does one differentiate? You know, just for our viewers to understand between a viral fever, a flu, or something more serious like a dengue or a chikungunya.
So, I'll just clarify for our viewers here. Flu is a virus, and most flus are caused by viruses, different kinds of them. Dengue and chikungunya are also viral fevers, right? And so there are different kinds of viral fevers that happen. There are fevers that also occur because of bacterial and other kind of infections as well. Now, in most cases, let's categorize them very quickly into two. One, if you have consistent low-grade fever, meaning fever which is less than 101 degrees Fahrenheit and happening not dependent on whether it's morning or night, but happening all day long, right? In that case, it's mostly the HN kind of flu, like H1N1, H1N2, H3N3, so on and so forth. If you have fever which is either spiking in the day or spiking in the night and associated with, and it's still something which is low grade, as I said, less than 101, then in that case it could be dengue, malaria, chikungunya, one of those. And associated symptoms could be pain, associated symptoms could be change in dietary patterns, eating or defecation and so on, or associated symptoms like vomiting and so on. So those are generally more serious problems and should be addressed as soon as possible. So 3 days is your mark where you either see an improvement or go to the doctor immediately. Second kind of fever is high grade fever, which generally is either spiking 2 days and then going down, in which case it might be a different kind of virus which we haven't really categorized, or it could be bacterial in nature where it is spiking more than 101 and it's staying high, and it's only going down when you are taking something like a paracetamol or an ibuprofen. So in that case, again, 3 days is a mark. If the symptom do not go down in a high grade fever, then please go see a doctor. In most cases, that's bacterial in nature, bacterial or pathogenic in nature.
And now we are in July, right? Any preventive measures that you would like to share with our viewers?
So,
especially for dengue, I mean, that's where the season is. I know it's through the year, we've already spoken.
Yeah. So, a couple of things. Make sure that your immediate close surroundings, your home, your office are clean. Try to use natural remedies if you are in low risk areas. Like, for example, areas where mosquitoes are not very prominent are low risk areas. Southern India is an epicenter of mosquito bites and dengue, unfortunately, and that is a high risk area. For low risk areas, keeping your surroundings a little more pristine and making sure that you are infusing your surroundings with eucalyptus or a camphor can suffice. In can, you can always have a higher solution, which I'm talking about now. In southern part of India, using UV-based mosquito repellents or mosquito deterrents, sound-based mosquito deterrents, or even all-out and others are genuinely useful. And even though they have their own side effects, it's better to use them than risk getting bitten by a mosquito. And when you are outside, please ensure that you wear full clothing. And even though Odomos is not the best skincare routine, please ensure it's better to have a dengue-free or a malaria-free life. So please ensure that you stay protected in both ways, and keep your family protected.
So the key here is, of course, protection from getting bitten from the mosquito.
Yeah.
But also, if I can ask you this about platelets, right? There's so much. That's the biggest fear one has if one gets dengue, right? Keep a watch on the platelets. Can you tell us a little bit about the platelets and what should people really watch out? When is it a red flag or an emergency situation when they need to rush to the hospital?
No, as we spoke right now, 3 days is the mark, right? If you have low grade fever day in, day out, and that is something which is lesser than 101 degree Fahrenheit, it's not going. It's not going on its own. So ensure that you go see a doctor, because dengue will affect your platelets, but it will only affect your platelets when the counts of the virus in your blood increases a lot. And for you to be able to prevent it is very much feasible by prevent from the counts increasing in your blood by a lot by adhering to the 3-day mark. So if you are able to monitor it and see that the fever is actually not going away and it's already 3 days, then please go to the doctor. It may be nothing, but if it is dengue, then that's the time that you catch it and solve it without any damage to yourself.
Okay, and there's an increasing conversation on vaccines for dengue, right? What really is the reality for India on that?
So, globally, Brazil and others have done successful launches. In India, Panacea has a very, very successful phase 3 trial, and Bangalore showed amazing results where both hospitalization cases and intensity of hospitalizations were reduced and almost no death in their trial data. and right now they are in regulatory, so fingers crossed we should have them in the market very, very soon.
So then that's the preventive angle. Quickly, if I can ask you about the natural remedies, what you hear of dengue, right? Papaya leaf juice, giloy, those bitter things which you're having, goat milk. How effective are these? Coconut water?
Coconut water is a good electrolyte, but it's not a cure for dengue.
And the other things?
Well, I would say stick to the normal course of treatment. Most of the natural things do not really have a hard, harmful situation, but they are not really sure. They are not something which is either a treatment or a management tool. To the best of our knowledge today, or the best of the data we have today. Tomorrow might be a different story, but today we know that that's not a cure. Secondly, when we come to dengue, please ensure you drink enough water. So be it coconut water, lemon water, howsoever it is. In any form of fever, please, your body is burning up. It is generating heat, and when it does that, it also consumes water, right? It basically evaporates a lot of water. You are dehydrated. At that time, please drink a lot of water, irrespective of what medication you are taking. That will always help.
So hydration. And lastly, if I can quickly ask you about influenza. Right, influenza, the different kinds. Are you also seeing a shift in patterns on different kinds of virals and influenzas? Because now you hear that one is getting flu, cold. There's no fixed pattern again. Like earlier it was closer to the winter we used to when we were growing up, right? But are you seeing that shift as well?
Yes, very much so. And we also see flu presenting in several more different ways than it used to earlier, right? So I think the number of strains that we see active today are far, far more. So the clinical presentation and the way it presents in your body is more. Sometimes it's headache, sometimes it's body ache, sometimes it's respiratory, sometimes it's gastro symptoms, sometimes it's urinary symptoms. So it is presenting in very, very varied different ways. And that is why it's better to have your immunity overall managed. Eating the right diet, eating clean food, eating a balanced diet, and ensure that your micronutrient proteins is in place, because that will make sure that whatever infection you get, you can fight it off effectively and bravely.
I think that's a really key point which you've given us, an important advice that we need to ensure our immunity can fight against the virus and the disease, of course. And together, I think we need to understand that how climate change is just not about the environment. Of course, it is a huge issue we all need to work towards, but it's leading to many, many medical issues as well. Thank you so much, Dr. Kapasi, for joining us today.
Thanks a lot, Ambika.
जानते हैं मैं एलीट मैट्रिमोनी क्यों रेकमेंड करता हूं? 17 years of experience, largest database of elite profiles, or 100% confidentiality. Elite Matrimony, India's most successful matchmaking service for the elite.
India Inc.'s most respected names chose India Inc.'s best and brightest.
These kinds of awards and jury lineup, you are truly giving it the right weightage.
I think it's heartening to see talent that there is across India Inc.
We should be awarding companies and individuals who have focused not only on growth but also on bringing good governance.
Be part of jury and vote on the people, the men, the women, the companies in India.
Myth. Dengue happens all year round. It happens more during the monsoon. Myth. You can have mosquito bites from any other location also. Oh, definitely a myth. It could be chikungunya, it could be malaria, it could be so many other things. Please be more careful than that. No, myth. Dengue can be dangerous. Platelet count is just one of its markers. It can have other symptoms which can be very, very, very severe. So please see your doctor immediately. Myth. Papaya leaf juice actually is not known to add any benefit when it comes to dengue.
Now, when it comes to dengue, prevention is still the best cure. These lifeline hacks are simple, practical steps that can help protect you and your family. Hydrate smart, not just more, because dengue doesn't just drain fluids, it depletes vital electrolytes too. Hydration heroes are ORS, the gold standard, coconut water, natural electrolytes, clear soups, which is fluids as well as nutrition, fresh juices, vitamin-rich hydration, water, sip consistently. Please skip alcohol, excess caffeine, soft drinks and energy drinks. In dengue, the right hydration can be as important as the medicine. The next lifeline hack is stop the bite before it starts. Now the catch here is dengue mosquitoes bite during the day, especially in the early morning and late afternoon. So your protection toolkit should have repellent creams and roll-ons, liquid vaporizers, mosquito bats, bed nets for children, elderly and patients, repellent patches and bands. The next one is the 10-minute dengue audit. Spend just 10 minutes every week checking buckets, plant trays and flower pots, coolers, water tanks, pet bowls, old tires, construction sites. Well, our lifeline super hack is fight dengue with the 3P formula. Protect yourself from bites, prevent mosquito breeding, pump up hydration early. Because the easiest dengue case to treat is the one that never happens. The NDTV Lifeline prescription is to avoid self-medication, because taking any medicine without medical advice may increase bleeding risk in dengue. Test early if fever persists beyond a day or is accompanied by body ache, rash or severe headache. Hydrate well, ORS is your best friend. Prevent mosquito breeding by clearing stagnant water weekly. Protect yourself with repellents, vaporizers and full-sleeved, light-colored clothing. Seek urgent medical care if you have severe abdominal pain, persistent vomiting, bleeding, unusual drowsiness or difficulty in breathing. The message is clear. Climate change isn't a distant threat. It's already reshaping our disease landscape. From dengue and chikungunya to unpredictable flu outbreaks, the risks are cruel. Prevention starts at home, but the larger battle is one we all share, because protecting the environment is ultimately about protecting human health.
जानते हैं मैं एलीट मैट्रिमोनी क्यों रेकमेंड करता हूं? 17 years of experience, largest database of elite profiles, और 100% confidentiality. Elite Matrimony, India's most successful matchmaking service for the elite.
India's unshakable news habit. NDTV.com is India's #1 English news website.
I got blooded in the stock market in the early 90s when Narayan Murthy and Infosys went public, and forever after that we've been spoiled. We look for businesses run by entrepreneurs like Narayan Murthy who have boldness, who have vision and a great sense of corporate governance. So some of the qualities that we admired in the stocks we invested, we also look for those in the entrepreneurs that we invest in.
Welcome, you're watching NDTV Profit. I'm Mahima Vachrajani, and today we thought of doing something interesting and exciting. We're going to talk about, of course, everybody knows that Odyssey has been released today, and there's a lot of interest coming in for this movie, and we'll try to understand as to what trends are looking like, what are theatres experiencing in terms of bookings, how has the booking flow been like, what is the pipeline going ahead in terms of where Bollywood stands. All of that we're going to talk about in this episode, and to talk about this and take this conversation ahead, we are now joined by Ashish Mishra, who's the head of commercialization at Cinepolis India, joining us now. Ashish, thank you so much for taking out the time. A pleasure speaking with you. I'll start with asking about Odyssey first, because that's where the interest is right now, right? How big is this? I mean, what is your expectations in terms of what box office could this hit, and what does this mean for theatres as a whole?
So of course, this is a big one, right? We're seeing that there's a lot of hype, there's a lot of chatter about this movie, and of course, this is directed by Nolan, right? So he, of course, comes in with his own, you can say, the things that he has done in the past, the movies that he has directed, and this seems to be just carrying forward that legacy of him. And it's already tracking as a big blockbuster. And these are the kind of movies which basically transcend from just being a movie to becoming something far more cultural. Right. So what we are expecting is that this would be one of the biggest opening weekends for Hollywood in this year. We are expecting it to be opening at about close to about 20-22 crores.
Okay, all right. And do you think that this is the kind of movie that brings back people to theaters? Because nowadays we've been talking about this as to how a lot of platforms like Netflix, etc., have kind of taken away that vibe or taken away that joy of going to a theater and watching a movie. Do you think these are the movies? Because it is a movie that needs to be experienced in the most premium way possible, right?
Yeah, absolutely. It is that kind of a film, right? And one thing that I would like to point out that, of course, audiences have a lot of choices today, but there are certain movies which feel absolutely unmissable on the big screen. And today we have one of those kind of movies coming in and made for the big screen experiences. Nolan has been very vocal about how important the theatrical part of the business is and how important that it is to him that he delivers a film for the big screen, and has come out again with a fantastic film. We've already seen the initial reviews come out and all of them are glowing, and we do expect that this would be a movie which would be shattering all records here in India. One thing is that it's not just that Netflix's or the OTT platforms are impacting this cinema attendance. We have had many movies. I mean, Durandar is a recent example where we saw of late. We have seen Obsession in Hollywood do really well. We have seen Welcome to the Jungle, and even movies have been doing well recently. So what I feel is that the common thread which joins everything is not really the language or the genre. It's basically the promise of that experience that you can't just recreate at home or in a small space. So the films and the communal experience that the films bring is just another example which we are seeing today in form of Odyssey.
Got it. The other aspect, Ashish, was to understand as to how important are these, Hollywood tentpoles, because we've seen how, good Hollywood movies have come in, swept in and seen a lot of traction, right? So how important is it for the theatre business and for Cinepolis India as well?
So very important, right? Hollywood currently contributes about 10 to 15% of the overall box office for the country. For multiplexes, it's slightly higher than that percentage, but Hollywood is very critical, right? It has now, of late, what we have seen is that the reach of Hollywood has gone beyond just the metros and the tier 1 cities. And as India is becoming more and more contemporary, we do expect that this share will increase.
Okay. The other aspect, Ashish, is that, we've seen as to how things have fared so far. Just want to get a sense as to, if at all, if you can give us those numbers as to how you've done in FY26 and how you plan to grow in FY27. Anything in terms of where numbers go, top line, bottom line, margins, etc.
So we are a privately held company,
Correct.
so we're not... I'm not the right person to share any kind of public information, but we continue to grow. India is a key market for us, and we will continue to expand in India. It's something that I would like to say at this moment.
Got it. And what is competition looking like then? Do you think that, because it's ideally essentially a duopoly right now, right? So how is competition shaping up, and how is it that you are showing strength to us?
So I think like any industry, competition is healthy, right? It motivates each and every player to do their best, and we don't see it any differently in this industry. We want to grow and grow profitably, and that's what I would like to say at this moment.
All right, just one last question, Ashish, from my end, and that's with regards to the release calendar. What is it that you're looking forward to? How strong is it going forward for the calendar year 2026?
So the release calendar looks pretty promising when we look at the kind of movies which we have seen right throughout the year, not just one genre, multiple genres performing, and that's something that really sets the ball rolling for us in this year. And going forward, what I do expect is that August is looking good with a couple of biopics in form of Prahar and Ita. Apart from that, we also have Batwara and Avarapan 2. In August, we also have Toxic, which is going to be a big release. So that's something that is setting the pace from August and going till December, where we would have King coming in, and in between of that we were going to have probably one of the biggest Indian films for the world, which is Ramayana, which we feel has the potential to be the biggest ever Bollywood film, which is releasing in this year.
All right. Yeah.
Talking from the Hollywood point of view, of course, we have Spider-Man come up, huge anticipation for this movie as well. And we have got a consistent lineup towards the end of the year. So we do expect that 2026 is on track to be a record year for the Indian box office.
For sure, and I look forward to speaking to you once all those box offices are hit and that your numbers fly. Thank you so much, Ashish, for taking out the time and speaking with us at NDTV Profit.
Thank you so much for having me. Thank you.
जानते हैं मैं एलीट मैट्रिमोनी क्यों रेकमेंड करता हूं? 17 years of experience, largest database of elite profiles, or 100% confidentiality. Elite Matrimony, India's most successful matchmaking service for the elite.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Access to capital, faster regulatory pathways, and market acceptance to create value. And if we get the pieces right, I think we can move from being the pharmacy of the world to being the most innovative lab of the world.
India's unshakable news habit. NDTV.com is India's #1 English news website. India Inc.'s most respected names chose India Inc.'s best and brightest.
These kinds of awards and jury lineup, you are truly giving it the right weightage.
The eminent juries who are here, and that itself speaks for the commitment towards highlighting the advantage which India is having. What I am looking for in this is that we should be awarding companies and individuals who have focused not only on growth but also on bringing good governance.
Be part of jury and vote on the people, the men, the women, the companies in India who have the right stuff is a great opportunity for us.
Who will earn India's top business honors? Find out at the NDTV Profit Business Leadership Awards.
the news, Ayush. Since when do we do scripts? Fair point. Picture this. The biggest stage. Floodlights. Wow. 4K. The works.
The National Pension Scheme. It's proving to be a fantastic investment, and it's not just because of the tax advantage, though that is a significant part of it, especially now that you can cap your contribution to the Employee Provident Fund to 1,800 rupees and ask your employer to contribute to the NPS instead. The thing is, there are a lot of things that people don't understand about how it works. And that's what we're going to fix on this episode of MoneyWise. Joining me today is Nikhil Kothari, Director of Etica Wealth. Nikhil, thanks so much for taking the time.
Thank you, Alex.
And welcome back on MoneyWise. Let me start with asking you a very basic question, which is that if somebody is contemplating investing in the NPS, which is the National Pension Scheme, what should they be considering?
Okay, so first I'll say every salaried employee should look at NPS as their one of the first investment to be done for their retirement.
Okay.
Okay. So every salaried employee should talk to the employer that whether they can opt for NPS or not. First of all, it gives you tax benefit. Second is that it's a forced saving. And today, one of the most important goal for every one of us is our retirement.
Right.
And that helps you to save for your retirement. Otherwise, most of the time we don't save for long term. But this is by default, it's planned in such a way that you save for long term. And the third advantage is that major part of your money can be in equity oriented funds, right? With the active allocation you can select up to 75%, or even if your life stage thing, when you're young you can start with 75% of your equity exposure, so it gives you compounding benefit. And last and most important is the very least cost. So all the benefits, if you look at it, it's a great investment tool for every person who is looking for creating a kitty for retirement.
Okay, so that's excellent, and we'll delve a little deeper into each of the points that you've just mentioned. But Nikhil, from what I remember about the launch of the National Pension Scheme, it was introduced for people who could not contribute to the EPF, right? Because the Employee Provident Fund, which is run by the EPFO, was primarily for salaried employees, and this was created for people who were professionals who were not employed by anybody, so that they could also save for their retirement. But now you're saying that all salaried individuals should consider doing the NPS.
Exactly. So as you rightly said that earlier there was the EPF option.
Yeah.
So they created that, okay, professionals who want to invest for their long-term retirement kitty, they can look at NPS. That's why they started with a very low fees on the management of the NPS account. But over a period of time, they've given so many tax benefits that it has become extremely beneficial for salaried employee that apart from EPF, they should offer NPS also, okay, to plan for their retirement.
If I remember, I can't remember if it was Arun Jaitley who started the ATCCD, which is the additional 50,000 benefit. But anyway, it was many years back in the old tax regime, right? So let's start with the absolute basics of the NPS, which is there's an account 1 and account 2, tier 1 account, tier 2 account.
Right.
What does that mean?
Okay, so tier 1 account is the main NPS account.
Okay.
Where basically if you are a salaried employee, okay, and you want...
Or any other individual.
Any other individual who wants to plan for the retirement, who wants to hold their money till the age of 60, okay, and want to contribute every month on month or every year on year, and also want to get the tax benefits, right? So they all invest in tier 1 account. Tier 2 account is basically a self-contribution that I want to save for my retirement apart from tax benefit. So there's no tax benefit in tier 2 account. In tier 1 account, you have a lot of tax benefits which you can discuss in detail about it. So tier 2 account is basically again for individual who wants to invest for long term, okay, want an investment which is like a where it can be auto selection, where you can say X amount should go to equity and remaining in debt based on my age bracket, so that you can select an option and you can continue investing in that part of it. Again, the fees are very low. And in tier 2 account, you can withdraw whenever you want to do it. There's no restriction in terms of withdrawal. Whereas in tier 1 account, you have a restriction in terms of withdrawal. Okay, you can only withdraw X amount of money. You have to hold till maturity, which is or 15 years or 60, age of 60. You need to hold on that. And after that, there's you can only withdraw up to 60%. Okay, remaining you need to take an annuity. So all this
Isn't it 80% now?
Now it's allowed to 80%, but again 60% is tax free. 20% is that you have to pay taxes on that income, so that doesn't make sense. And remaining 20% you have to take a mandatory annuity.
I just want to be absolutely clear with this, right? So the tier 1 account you're saying is where you get all the tax benefits. And what you're essentially saying is now in the old tax regime, if I remember correctly, there is an option available. Is it part of ATC? It's not part of ATC.
It's not part of ATC. It is the ATCCD.
Which is 50,000 rupees.
50,000 rupees additional contribution where you get tax benefit.
That is in tier 1.
That is in tier 1. But the new tax regime doesn't give you that benefit of ATCCD.
Yeah.
Right? But it gives you benefit of employer contribution.
Employer contribution, right. So up to 14% of basic.
Up to 14% of the basic. So basically what happens is that if you are a salaried employee, okay, you can offer EPF where the employer contributes 12% and you also contribute 12%. So the employer contribution of 12% reduces the tax liability because that's not considered as your income.
Yeah.
Over and above this one, what you can opt for, it says up to 14% of my basic plus DA can be contributed to NPAs, and that whole amount becomes tax free.
Interesting.
In terms of investment.
So potentially as much as 26% of your...
So 14, so if you combine EPF as well as NPS, yes, it's going to be 26% of your basic plus DA. You can contribute for long-term investments and the whole money is not taxed in your hands.
So that's very interesting. There's also a limit to that, right? There's 7.5
There's a limit of
lakh.
7.5 lakh rupees overall. So that's something, it's basically meant for people. It's not for people who have got a very high salary.
Sure.
Right? Because in that case, your EPF contribution itself contributes more than 7.5 lakh rupees, then it becomes taxable. But for those people whose salary is not, so I'm just giving, if your basic salary is only up to a lakh of rupees. Okay, so if effectively in that case, 12% goes to EPF, which is 12,000 rupees, and another 14% can go to NPS, which is another 14,000, all 26,000 rupees. 26,000 into 12. Right, so effectively 3,10,000 rupees, 12,000 rupees is completely tax free in your hands.
Interesting.
Right.
So and now and we spoke about this, I must tell you, in the previous episode of MoneyWise, which is that the EPFO or rather the government has come out with a gazetted notification to say that you can now cap your EPF contribution to 1,800 rupees. Of course, that was already there in the amendments. They've clarified that.
That's true.
And so as a result of which your employer also contributes lower.
Right.
If you don't ask them to contribute to the NPS instead, there is a tax implication.
There's a tax implication, right? Because they're only saving 800 rupees.
Yes.
So that's something you should make sure that the 7.5 lakh capping, that where your EPF contribution, your NPS contribution, as well as superannuation contribution, which is very rare now. So combine all three cannot be more than 7.5 lakh rupees. Till the time you're not breaching that 7.5 lakh rupees, every salaried employee should offer both EPF and NPS.
Okay.
So it gives you a lot of tax benefit to that.
The only drawback to that, though, Nikhil, is that it brings down your in-hand significantly, and people, particularly in your metro cities, they're counting every rupee, right? Ultimately, so if you're saving for your future, of course, it's important, but at what cost? You got to feed your family right now.
So I'll put it slightly different, Alex. One of the most important goal for every one of us is own retirement.
Yes.
Right. So if you're not contributing for retirement, then it's going to have a huge dent in your financial life future.
Sure.
So of your basic contribution,